with Julie Hyman and Brian Sazi. Let's take a look at where futures are trading right now ahead of the opening bell. Not a whole lot going on with any of the major indices. This coming after we saw the S&P 500 close at a record during Wednesday's session. So once again, any green close for the benchmark index will be another record high. Well, COVID outbreaks continue. COVID-related deaths hitting a record in the U.S. on Wednesday. CDC Director Robert Redfield warning that this winter will see the most challenging months in a public health event in American history. And stimulus talks continuing. Treasury Secretary Steven Mnuchin saying that President Trump would sign Mitch McConnell's latest proposal for additional aid to businesses and households. We'll have the latest on that coming up in just a couple of minutes. But we begin our program today with one of the biggest stories in markets in 2020, and that, of course, is the SPAC boom. Luminar Technologies set to make its public market debut on the NASDAQ today, trading under the ticker LAZR in a combination with Gore's Metropolis that will value the startup at $3.4 billion. And we're joined now by Luminar CEO Austin Russell. Austin, great to have you on the program. Thanks for stopping by today. I'd love to begin maybe just a quick outline for the viewers who aren't as familiar with your company on what you do, where you sit within that autonomous driving tech stack, and sort of the vision for the company over the next several years.
Absolutely. Thanks for having me here, and great to be on it. You got a great crew. So with Luminar, we build really LiDAR, sensing technology and software for autonomous vehicles. It's really the key enabling systems that can allow these vehicles to see and understand the world around them reliably and accurately. It's easy for these cars to work, 99% of the time in autonomy to do that, but it's all about that last 1% when you want to get these things out of R&D and into production, and that's exactly what we do. So the differentiator here is we built our technology entirely from the ground up, all of our own components, going into this to really solve this core problem. And it was an 8-year journey leading up to the listing here. Certainly an exciting one. We've had a very intensive development process through this, but we've achieved the first and only sensing system to meet the required performance of seeing out 250 meters very reliably in the distance, having the resolution, and having the economics to make it all work while pairing it with the software. And now as well, for the first 5 years, we spent development coming out of stealth in 2017. The last few years, we've continued on that trajectory while commercializing it. We're now working with over 50 major commercial partners, including 7 of the top 10 largest OEMs. Most recently, just this year, we've announced a few of the first production deals for autonomy when it comes to initially with Volvo Cars, getting this out there in consumer vehicles. So they're a lead partner on the passenger vehicle side. The other major verticals, you have autonomous trucks. We have Daimler Trucks, which is the largest producer of commercial vehicles, as a lead partner in that domain, ultimately to bring this to market here. And equivalently, we have a new ecosystem partnership with Mobileye for their AV series solution and also their internal robotaxi fleet they're deploying globally. So exciting times.
Exciting times indeed. And Austin, we should mention, you talked about that 8-year journey that you embarked upon. We should mention you started that journey when you were 16, which is pretty remarkable. So talk to me about the journey from here then. You've got all those partners you were just talking about. I know that you expect to actually start to see vehicles enabled with this technology, in 2022, if that's correct? So what does the next year then look like for Luminar? What are you going to be doing on the ground, especially with the proceeds that you've raised by doing this deal?
No, it's a great question. I think that's absolutely right. A timeline for series production for the models that were designed into rolling off the line in 2022. And these are cars that you can actually buy. This isn't just an internal program with someone. So that it makes all the difference. And for us, in going through this journey and kind of what's ahead, of course, there's a lot of intensive effort leading up to this stage where it's possible to be designed in working with these major OEMs. But going forward, for us, it's really all about execution. We're seeing when you take a look at the different factors that go into this type of business. there's of course the core technology which is the foundation, but that technology problem is in large part for us it's solved. We meet the requirements, we meet the spec, we solved it. It's easy to put some numbers, so to say, on a slide or in terms of what a target is, but that was the intensive process that we had to go through over those 8 years with our 350 team members and $250 million invested to make that work. Now, really, as we move forward, we're continuing to commercialize it with all of our different partners and progress through the phases there. I think it's really more a matter of when, as all of these automakers progress than if. But of course, shouldn't be understated. We need to continue to execute. That's really what, in large part, this influx of capital is for. So we're looking at here as part of this transaction, raising or what we've raised now. Gross proceeds of nearly $600 million to further accelerate that growth and the trajectory of execution along with our partners, and be able to have new high ROI investments that are really going to be paying out over the course of the decade.
Austin, I'm really fascinated by what you're doing with Daimler. Now, Daimler is an investor in Luminar. How long before we see self-driving semi-trucks as part of that deal? And then how disruptive is what you're doing going to be just to the really, I would say, boring transportation industry?
Yeah, so when it comes down to it, and talking about the Daimler deal there, I think that's absolutely in line. It is really a breakthrough as an opportunity to be able to work with one of the largest, or I should say by far the largest, trucking OEM to be able to get these out on real roads. And again, having that direct relationship is key. So in this case, I do believe actually the trucking and logistics industry is going to be one of the largest and also one of the most overlooked, frankly, opportunities in this larger industry. It's nearly $1 trillion a year in the U.S. alone, and it's really a huge portion of it is up for grabs for whoever solves this problem. And so far, we've been leading the charge, working with nearly every major autonomous trucking effort out there, and powering those systems. So in this case, though, I think when it comes to these things and the timelines here, these kinds of deals, they don't come out of nowhere, right? We've had to work, extensively hand in hand for these companies for years prior, generally a couple of years, before it gets to the stage where you can start to get it out there towards a production deployment. And generally, what we're seeing for the automakers is anywhere from between a 2022 to 2025 timeline for series production of the vehicles that we would be or are designed into here. So our product is fully ready to go for the first launch models for 2022, and actually we surpassed a huge milestone of already shipping our series production product and the initial samples of it. We're now live, up and running on Volvo vehicles, which on the consumer side, they've really taken a huge lead.
Austin, I have to ask you the requisite SPAC question. Which is, why did you decide to do a deal with Gore Metropolis to come public versus doing an initial public offering versus just staying private for longer?
Yeah, no, it's a great question, and ultimately we had a few different opportunities on the table, a large strategic opportunity, going down the route of going public either through IPO or by way of SPAC. I think really that the thing that we've always thought in our head, this has always been ultimately on our roadmap to go down the public approach. And by the way, I think the approach that a lot of times people set their businesses up as is, more of an acquisition target or, kind of a more short-term play. We're absolutely all in for this for the long run to be able to work with all these different automakers and see this technology through into the real world at scale. So with that, though, the key catalyst that we always saw as an opportunity that made the most sense for a company in the autonomous vehicle space to go public was whoever is able to win the first production deal to take this stuff out of R&D and bring it into the real world. And that's really where, following the Volvo win that we had and the first to be able to do that, that's where we started to get a lot of heightened interest altogether to be able to do that, because you get a lot of strong forward-looking visibility on revenue, and that makes all the difference. It's how we've been able to build out a now estimated $1.3 billion forward-looking order book for the business from all these different types of volume estimates from the deals that we have.
All right, Austin Russell is the CEO of Luminar Technologies, making its debut on the NASDAQ right around 20 minutes from now. Austin, congratulations, and we hope you'll come back and talk when those quarterly results start rolling in. Big responsibility, as you know, being a public CEO. Congratulations. Look forward to talking in the future.
All right. Thanks so much for having me. Talk to you guys later.
Talk to you. All right, let's turn our attention now to the pandemic, which continues to rage across this country. COVID-related deaths hitting a record on Wednesday. This as vaccine news continues to roll in, but also seeing a rollback of some opening plans here in the U.S., particularly in one of the largest counties in the country, L.A. County. Anjali Kamlani joins us now with the latest on all of the COVID news. Anjali, let's begin with that news out of Los Angeles and sort of the significance of that as it relates to the nation's view on where things could be headed in the next couple of months.
We've been watching some of these major cities across the country, implement a number of different types of restrictions or stay-at-home orders in advance, really, of some of the statewide rules that end up coming out. So right now, what we're seeing is a Los Angeles City yesterday announcing stay-at-home orders, which don't exactly mirror what we saw as sort of the very strict lockdowns earlier this year. Retail is able to stay open. Schools are still going to be in person. A number of, a variety of gatherings are still allowed, but they do advise that you stick to just people within your own household. So that's something that we know is something that California, the state at large, is looking at. And Los Angeles County did also implement similar rules earlier this week. So that's where that stands right now. And looking at across the country, to your point about how hospitalizations reached a record number yesterday, 100,000 individuals in hospitals right now, and that is an absolute record. We've never seen that, not earlier this year or in the summer. New record there. Also, for the second time, surpassing 200,000 cases daily yesterday. So this is really going into that peak time of year. The thing that health experts have been warning about since the very beginning, that if restrictions aren't followed seriously, if people aren't careful, we could continue seeing this trend. And of course, we're expecting even more the numbers to get even higher as the fallout of what we know was a very active Thanksgiving holiday come to fruition. Miles?
And again, we heard from CDC Director Robert Redfield, who we talked to on this program just last week, saying that the months ahead likely to be the toughest public health event in American history. All right, Anjali, we'll talk to you later on this week. Let's turn our attention down to the Capitol now and talks regarding additional fiscal stimulus. We have seen this movie many times over the last several months, but this week beginning to sound a little bit more constructive. Treasury Secretary Steven Mnuchin yesterday going so far as to say the president would sign off on Mitch McConnell's latest proposal. Now, this is slimmed down from the report we had earlier this week, nearly $1 trillion. Jessica Smith joins us now with the latest. Jess, on where things stand, and I guess people continuing to talk about it is good, right? We had several weeks where no one said anything about stimulus, but it does feel like more of the same, of lots of talking and not a whole lot of movement.
Yeah, after things have really stalled over the past few months, we did get several different proposals this week. And you mentioned that Secretary Mnuchin said that President Trump would sign Majority Leader McConnell's proposal, but it's not clear at this point if Democrats will get on board. They do not like that skinny proposal. It's even smaller than what he had proposed twice earlier this year that Democrats said was not enough. So what the newest development here is that we're all kind of waiting to see how it plays out is Speaker Pelosi and Minority Leader Schumer have said that they will back that bipartisan proposal that we saw rolled out earlier this week, that $908 billion proposal. They'll back it as a starting point for negotiations. They want to use that as a framework to start negotiating with the Republican Senate, with the White House to try to move forward on a deal. We don't know yet what McConnell's response to that is going to be. But Pelosi and Schumer said, of course, we and others will offer improvements, but the need to act is immediate. And we believe that with good faith negotiations, we could come to an agreement. So that's a really big concession from the Democratic leaders who have held out for that $2.2 trillion package that they had been pushing earlier in this year. McConnell has poured cold water over that $908 billion plan. He says that he wants to take up something that the president will sign, and he thinks that is his smaller proposal. That proposal, the roughly $300 billion that he's pushing, doesn't have enhanced UI. It doesn't have state and local aid, some really key things that Democrats would like to see. It does have liability protections. It extends those unemployment insurance programs that are expiring at the end of the year. It extends them for about a month. So we'll see what happens here, but it seems like both sides are not are still far apart, honestly. It seems like they're still pretty far apart, but we did see that big concession from Democrats. So we'll see if that moves McConnell at all or moves the White House in the coming days.
Yeah, just as you outlined the numbers there, right? The bipartisan proposal still 3 times larger than, basically 3 times larger than what, McConnell and Mnuchin are talking about. And I know there's been a lot of talk around, we won't leave for Christmas without some kind of a deal. But on the other side of Christmas, it's only 20 days until Joe Biden will be sworn in as the next president. And he said just a couple days ago, any package passed would be, quote, just a start. So a long way to go here. We all know where we stand on how much this is needed for the recovery, but we all know where politicians stand on actually getting something done. All right, Jessica Smith with the latest on all of that. All right, we're off for a short break. On the other side, we're going to talk to Gabriela Santos about everything going on in the markets here. Stocks at record highs. What does 2021 have in store for investors? We're back with that in just 2 minutes.
We've got futures this morning pointing to a slightly higher open, but of course, all the major averages are still near their record levels. So what should you do now as an investor? Let's bring in Gabriela Santos. She's JP Morgan Asset Management Global Market Strategist. And Gabriela, I know one of the places you're looking, I'm going to start in a bit of an unusual place here. One of the places you're looking is outside of the United States. If we continue to see this sort of cyclical rotation, you say maybe you can get more bang for your buck by looking outside of the US. So walk us through your thinking on that.
That's right, Julie. So the U.S. market is actually a very defensive market. Only 1/3 of the S&P 500 is made up of so-called cyclical sectors, whereas international markets have over 50% of their exposure in cyclical markets. So when you have a cyclical recovery like we expect in 2021, it's really international's time to shine. And we saw this in November when we got that first little step of the cyclical rotation. International really outperformed the US by about 3 percentage points. We also expect to be able to get an added little boost from a weaker dollar, which we also expect to continue in 2021. So we think it's really important for investors to have a balance between US equity exposure and international exposure as well as we go into the year of the vaccine or 2021.
Gabriela, as part of that international call, what component, when you're out there, when you're modeling your expectations, what component reflects perhaps just lower trade tensions between the U.S. and Europe, between the U.S. and China, with President-elect Biden coming into power?
That is an important component, Brian. So it's the vaccine and the cyclical recovery, but it's also the outcome of the U.S. election and a Biden administration, to us, representing less uncertainty about foreign policy. And this is really important for countries and regions outside of the U.S., which are much more dependent on trade than we are, and which had been hindered by the trade war during 2018 and 2019. So this should be a more supportive environment for trade, for global growth. And this is also part of the reason why we expect a weaker dollar in 2021. So it's the combination of both of those things, the vaccine and the Biden administration.
Gabriella, I think the biggest debate right now happening in U.S. markets, at least, is valuations, what they mean, how important they are, the height of them, do they make sense? What kind of questions are you guys getting on that front, and how does that factor into the way you're thinking about markets next year? Certainly, it sounds like you find international markets more attractively priced, but do valuations scare you out of the U.S. at all?
So we have been getting a lot of questions. And when you just look at the forward next 12-month PE, it's at 22 times right now. It's some of the highest valuations we've seen since the tech bubble. So we do get a lot of questions around whether this is a bubble. And we say three things to that. The first is we're still looking at a next 12 months of some pretty strange earnings with the pandemic effect. If we look at valuations in 2022, a more normal year, then valuations come down a bit to about 18.5 times. The second thing we say, it's also a relative game. So it's also comparing equities versus what you can get in fixed income, which has incredibly low yields, hence very expensive valuations in fixed income. So equities are still a bit better option. And the third thing we say is that it does, of course, take a little bit of a bite out of our return expectations for the next 10 years out of the US. We think we'll only be able to get about 4.1% annualized return out of the US. And that's why another reason why international is so important, because it does have a more reasonable valuation starting point. We do expect to be able to pick up between 200 and 300 basis point extra annualized return from developed and emerging international equity markets.
Gabriella, I wanted to ask you about another wrinkle sort of in trade and relations between various countries, which is the news that the House has just voted to approve a bill that would put some constraints on Chinese listed companies in the U.S., might even make it impossible for Chinese companies to list in the U.S. And I know you can't speak specifically to big companies like Alibaba that are listed here, but in general, what does that do to how you invest? I mean, for an institution like yours, presumably, it's just as easy for you to invest in those stocks in Hong Kong or Beijing as it is to invest in them in the US. But is there a bigger market effect?
I would say two things to that. The first is that, to me, this is a symbol that being tough on China or competing with China is truly a bipartisan issue at this point. It's not just about the Trump administration. And it's really reflecting a change in sentiment here in the US and overseas. Populations now have a much more unfavorable opinion of China than they had just a year or two ago. So this competition with China will continue probably for the entire rest of our lifetimes. It's just that with the Biden administration, we can have a more predictable competition rather than unpredictable, which is what we've had for the past 2 or 3 years. But the competition remains. The second thing I would say in terms of investing in China directly, we still think it's one of the biggest growth opportunities of the next decade. So for us as investors, we don't have to choose between the US and China. We want to have both in our portfolios. And more to actually get that China exposure, we have to go directly to the source, as these companies are already dual listing in Hong Kong or in mainland China stocks in anticipation of this bill passing. So it's not a reason to completely give up on the China story. It's just that we have to be a bit smarter about it.
Okay, Gabriella, thank you so much. You're going to stick with us through the opening bell. Gabriella Santos of JP Morgan Asset Management. We'll be right back in just a few moments with the bell.
All right, we are about 3 minutes away from the opening bell here on this Thursday morning. Futures pointing to a bit of a mixed open, not a whole lot going on after we hit records for the S&P 500 yesterday. We see we are up less than 1 point, so we'll see where things shake out as the trading session goes on during today's session. All right, let's talk about that story we were just mentioning with Gabriela Santos at JP Morgan just a few minutes ago, and this news that Chinese companies listed in the U.S. are now going to be forced to comply with U.S. accounting rules. They're also going to be forced to outline that they are not controlled by a foreign entity. And I think that this is kind of maybe closing the barn door after the horse has left, right? We go back in time, 8-10 years, and there are dozens, hundreds of Chinese-based companies listed on the U.S. If you follow the work of someone like Carson Block over at Muddy Waters, it seems like every week he's uncovering a new U.S.-listed Chinese-based company that he essentially outlines has no business at all, or is completely making up all the data that they publish in their SEC filings. And so, as Gabriela was mentioning, certainly indicates that U.S.-China tensions are a bipartisan issue. Also, maybe looking at the next phase of how the U.S. and China, quote unquote, level the playing field, probably more financialized, Julie, than the maybe industrial sort of policy that we heard, coming out of the Trump administration in the last couple of years.
It makes sense. I also thought it was interesting, Gabriela saying a big institution like hers is going to go wherever they can buy the shares of a company that they think is worth investing in, whether it's here in the U.S. or abroad. I want to turn to some other companies that we're watching this morning because we had some consumer names reporting earnings. Dollar General is one of them. The company's comps actually rose by 14%. Revenue was up by about 17% here. But the shares have been trading a little bit lower. It did not give any kind of forecast. And so that might be maybe what's responsible for that. The company also said it was paying out an additional $75 million in what it calls appreciation bonuses to its workers and its stores. So the total payout on that front for the year is going to end up being about $173 million. Also in grocery, we heard from Kroger. That company's comparable sales were up 10.9%. Overall sales, though, did miss estimates. So it looks like that's why the shares are down, even though the company raised its full year comp forecast. Now is looking for a gain of 14%. I mean, both Dollar General and Kroger, part of that wave we've seen of essential businesses that stayed open throughout the pandemic, saw a lot of traffic from people buying basics and buying groceries. One of the things, of course, that is not basics, clothing, at least not in the same way. Express is one of those retailers that probably was not in great standing going into this. It still remains sort of in a weak position, and those shares are down by more than 20% right now after it reported a wider than estimated loss. It also said it has to take liquidity measures. It's cutting 10% of the staff at its corporate headquarters as a result of that. So going to watch that as we watch that opening bell here ring on the New York Stock Exchange here this morning. In terms of some of the other headlines that we're watching, Brian Sazi, I know that you're taking a look at a company that reported after the close yesterday.
Right, Julie, I'm watching Snowflake. It was down about 3.5% pre-market after the company reported earnings. Keep in mind, this is probably one of the hottest, or was one of the hottest IPOs in the entire stock market this year. Coming out with earnings, revenue up 115%. That seems to be towards the low end of some of the buy-side expectations out there. The company did also guide fourth quarter sales up 103%. That also a little bit below the buy-side estimates out there. But Miles, I point to this quote from Deutsche Bank this morning, and this one is right up your alley. Deutsche Bank pointing out, quote, growth is suggestive of a very large TAM and a clear product fit. And Snowflake really is doing things in the data cloud that no other company is doing. In fact, they were able to raise their prices in the most recent quarter by 7%, according to her 10Q. But we'll talk to Snowflake CEO Frank Slootman tomorrow. I'm looking forward to it because, Miles, this is one hot company doing a lot of things right, probably not reflected in the stock price today.
I love TAM, total addressable market. The bigger, the better. Simple way to invest in all of these tech companies. All right, let's go to Jared Blickery now for a look at how things are trading as we get today's session underway. Jared, right now, S&P sitting at a record high.
Yeah, so well, set for a record close, I would say, not an intraday high just yet. But tell you what, we've seen a lot of strength in this market, and we're just inching higher and higher every day, reminiscent of previous sleepy Decembers. And that's kind of what we want to see, right? So we can see the Dow is up 19 basis points, 23 right now. S&P just barely in the green. Nasdaq up about 0.3%. Well, let's take a look inside the Nasdaq 100. And we can see some broad-based leadership here. One of the standouts is Tesla. That's up 3.8%, above $600 per share. Just got that street high rating upgrade on the price target by Goldman Sachs. Facebook under a little bit of pressure, down 0.7%. Alphabet and Apple just in the green by a little bit. Looking at some of the losers here, Splunk. What a disaster after its earnings. Looks like it's particular to the company, which is good, not to the industry, but it's down 24%, giving up most of its gains for the year. Costco down 1%, T-Mobile down 1%, but not really seeing any big rotational factors. Nice to see, let's take a look at the sector leadership. Nice to see energy, industrials, materials, discretionary outperforming once again. Looks like tech is also outperforming, but to the downside, we have utilities, communication services, and staples. So the defensive names in the red here. Let's check out the travel space because we've seen a lot of movement in that recently, and we see mainly greens sorting by performance. We got, looks like Spirit Airlines is one of the best performers, up 3.5%. JetBlue up over 3%. To the downside, Trivago's down over 2%. And then we have the EV space. We mentioned Tesla before, but we got to track some of the others. Workhouse, which had a very difficult time yesterday, up about 3%, 4% here, still up nearly 600% year to date. And I just want to bring in Gabriela Santos. She's JP Morgan Asset Management Global Market Strategist, because it's time to talk bonds. And we got the 10-year inching closer towards 1%, and we have break-evens at 18-month highs here. So what's your take on the bond market, and what are the implications for equities here?
So we did have a big move up in 10-year yields on Tuesday, on December 1st, in line with a very risk-on start to the month. But we still see the 10-year having a very hard time breaking above 1% on a very consistent basis. And I think this really speaks to the change in the reaction function of central banks. We can have good news about the vaccines. We can have good news about the recovery in 2021. But we know that central banks are not going to overreact to this. They're going to keep rates extremely low for the next few years, the first few years of the recovery. We're very interested here in the last Fed meeting that we will have in a couple of weeks. And we're specifically interested in what they have to say about their QE program. Are they looking to perhaps extend the maturity of what they're buying? Are they going to give us a little bit more forward guidance? And I think that's what's keeping a lid on the 10-year as well, is the expectation the Fed is ready to step in if 10-year yields start drifting higher. So this is why you can have a huge improvement in risk assets without actually having 10-year bond yields drift too much higher from here.
And, Gabriella, I guess related to the Federal Reserve, we've heard from a number of folks on Wall Street. They're quite excited that Janet Yellen will be leading Treasury in the next administration. Does that appointment change anything in your view on how fiscal policy might evolve next year, how Fed Treasury coordination could evolve as we get through this crisis?
So I do think investors were excited by the appointment of Janet Yellen as Treasury Secretary for a couple of reasons. The first is she's seen very much as a moderate person, so that removes any sort of uncertainty there might have been that we could have had a more progressive Treasury Secretary. And number two, Janet Yellen is certainly someone that understands the risk of removing support too early. So she will really be the driving force here of more fiscal policy support in 2021 as we have the slow recovery from the pandemic recession. The issue, of course, is that you still need to get any sort of fiscal package through Congress. And we do still expect to have a split Congress after those last two Georgia elections on January 5th. So it's important to have that driving force for the fiscal policy conversation, but it still comes down to how much fiscal policy Congress is able to approve. We still expect something to the tune of $1 trillion in early January once we get past those special elections.
All right, Gabriela Santos with JP Morgan Asset Management, global market strategist over there. Gabriela, always great to get your thoughts. Thanks so much for joining the program today.
Thank you so much. Nice to see everyone.
All right, we're going to have more coming up here on Yahoo Finance Live after a short break. Again, stocks in the green to start today's era. S&P down. It's flat. All right, we won't try to top tick the market here or follow it tick by tick as we go along. We're back here with more in 2 minutes.
Well, we've got U.S. stocks here trading a little bit higher, but drifting around a little bit, and even in the pre-market, sort of bouncing between gains and losses. Let's check on what's happening in European markets. However, Kumada Ramanathan is joining us right now from the UK. So what's the latest? What stands out to you in today's session?
Well, it's actually been a rather subdued session, Julie, here in Europe. Now, markets are very much bracing for the massive vaccine rollout. In the FTSE, specifically in the UK, we're also dealing with the extension of Brexit talks. But going back to the vaccine rollout, looking at the FTSE exactly, it was flat today. CAC 40 was also down, as well as Germany's DAX. Now, European case counts have stabilized in Germany, in Italy, as well as the UK as well. Now, one of the big issues we have here, of course, is Europe is famous for ski resorts. So governments are trying to coordinate their responses and overall are saying that they're going to keep them closed to keep the numbers lower. And European Medicine Agency, that's the one that's regulating vaccine rollout. They say that they could have a decision and rollout overall across the continent as early as December 29th.
And as we look at the rollout of the vaccine in the UK, Boris Johnson has made some comments about that it's going to be tough to do.
Absolutely. Logistically, this is not going to be an easy process. Largely, that is because we know that the vaccines need to be stored at very, very low temperatures. So you can't necessarily just walk into a pharmacy and get it done. So what he has said is that the priority groups, that includes people who are vulnerable, that could be the elderly, that could be frontline workers. They are going to be the first to access the vaccine. And then after that, we're going to be looking at the other groups. But he says it could still be a few more months before the vaccine is rolled out to everybody. And as that happens, logistically, hopefully the vaccine will be passed on to pharmacies as well as family doctor offices. So it will be easier to access. So definitely lots of hope there, but lots to watch for.
Indeed, and managing expectations there on the part of Boris Johnson. Thank you so much, Camilla. Appreciate it. When we come back, a lot of people are getting warnings about delivery delays going into this holiday season. We'll talk with one company whose job it is to get you your packages, and it's also going to be splitting into two. XPO Logistics is next.
It will be an extra busy holiday season for our next guest, Brad Jacobs, who is the CEO of XPO Logistics. Besides dealing with the crush of holiday e-commerce orders, he has decided to break up the company he has founded. Brad Jacobs, join us now. Brad, good to see you. I've been following this journey since we talked back in January when you announced you were exploring strategic alternatives. Why are you doing this now, splitting up the company into two? Walk us through it.
Good morning. Good to see you again. So we did start this journey around January, beginning of the year, and we just got very frustrated with our multiple. We saw that our multiple was under 10, and most of our competitors were over 15. And we said, well, what's wrong with this picture? And we did an honest assessment where we talked to all of our different stakeholders.
Do a squeeze back.
Can you hear me?
Well, go ahead, Brad. Yes.
Yeah, sorry, there's some noise coming through. So we did an honest assessment of what the multiple, why was the market giving us this lower multiple? Because it's very substantially. And we heard two themes. This is what we learned. We learned that the company's too complicated. You just simplify it, and you need to get to investment grade. And if you do those two things, the amount of demand for the stock would be vastly more. And in addition to the financial benefits, there's a lot of operational, business, commercial benefits from having two pure plays, very focused organizations with a currency that can be used for compensation, currency that can be used for M&A. So there's a lot of good rationale for doing this right now, having one company that is a leader in transportation, moving things from point A to B. It's an outsourcing play, it's a tech play, and another company that's the second largest contract logistics company in the world, things that happen in warehouses, that's smack in the middle of this massive e-com explosion. Because we do, these days customers want more, they want shorter lead times, they want faster fulfillment. And retailers just aren't set up for this by and large. And even many e-com companies can't do it as fast as we can do it. So they outsource it to us. And it's also play on automation, because if you go to our warehouses, you'll increasingly see more and more robots because it's more and more automated, and customers want to outsource to companies who can do that.
Brad, I've watched you build this company from the ground floor through a series of acquisitions. How much, can you just isolate for investors, how much you think that logistics business could be worth on public markets as a standalone company?
Well, I can tell you what the markets today value our competitors. So if you look at contract logistics, there really is no pure play contract logistics, but the four ones that have the most amount of contract logistics in them are DHL, Kuehne+Nagel, Clipper, and DSV. And they all trade for around 15 times EBITDA. And then when you look at the transportation side of the business, the LTL business, the best two competitors to compare us to an LTL, where there are very clearly defined pure plays, are Old Dominion, which trades at 19 times EBITDA, and Saia, that trades at 12 times EBITDA. And then on the brokerage side, it would be Robinson, C.H. Robinson, the biggest truck brokerage company in the world. We're number two. And they trade at roughly about 15 times EBITDA. So you hear all these numbers, they're all double digits and well into the teens. So we do think by separating the companies out, investors will be able to understand the company better. They'll understand the superior margins, growth profiles, return on capital that we have. And we'll get at least, I hope we will get at least those kind of multiples. Having said that, if we do, the stock price would be vastly higher than it is right now.
Brad, it's Julie here. And just to further explain for our viewers, in case they don't know, LTL stands for less than load, which is when you have smaller bundles of things that you're putting together to fill up one full truck. There's a lot of those trucks moving around right now because, as you mentioned, there is a boom in e-commerce right now. It's going into a very busy holiday season. And already some of the big shipping companies like UPS are warning about potential delays. They're putting certain limits on their retail clients. What are you experiencing from your perspective?
Well, this was the mother of all peaks. It's not only the mother of all peaks, it's an extended peak. So usually peaks are very, very specific for a few days. This is just dragging on and on. So it's an interesting time. There's a lot of bad things going on in the world with still the COVID crisis still happening, but the industry's coming back. And we're seeing that in our volumes. We're seeing that in our LTL business. Delivery times are okay. So I expect it to continue that way till the end of the year.
You know, Brad, it's Miles here, and you mentioned delivery times are all right now, and you go back to the spring, and I mean everything kind of froze for a variety of reasons.
Yep.
What kind of learnings do you think that you as a company in the industry had at large with that sort of surge, or was it the kind of event where we hope there's only one pandemic and we're not going to worry too much about what did or didn't get out the door in a timely fashion in late March?
Well, I actually credit the transportation industry a lot for, first of all, continue to go to work when most people were working from their home or not working. And our truck drivers kept driving, and our warehouse workers kept picking and packing, and our LTL workers kept going to the dock every day at risk. And we mitigated that risk by taking very extreme measures to protect the safety, the health of our employees. But still, they were right on the front line. And I do believe after healthcare workers, these kind of frontline workers in the supply chain should be towards the beginning of the queue for the vaccine to come out. Not us corporate people, but the people on the front line in the field. They really were heroes during this whole pandemic. And they kept the supply chain moving, not just our company, but our competitors too. People did get all their PPE. People did get their food. People did get their supplies. So I feel good and proud about our industry. I think it really stood tall during this year in a very, very challenging and strange year.
Brad, for those not familiar with XPO Logistics, how are you going to play in the delivery of a COVID-19 vaccine?
Well, companies producing the vaccines are our customers, all the big pharma companies. Our expedite line of business is transporting vaccines the last several weeks in temperature-controlled trucks. And there's a big secondary market in vaccine-related freight, not the vaccines themselves, that we've been benefiting from. So think syringes, saline, styrofoam packaging, dry ice, refrigerant, temperature-controlled packaging materials. So this is look, rolling out several billion doses of anything is a big logistical upburst. There's a lot of activity as a result of that that's already started, even though the official rollout hasn't happened. It's a lot of practice dry runs going on. So this is a good thing for our industry, and it's a good thing for our country. And it's a good thing for the industry as a whole. It's good. I believe over the next few months, once we get past the unfortunate tail end, which hopefully the tail end of the pandemic, I think this rollout of the vaccine could be right up there with maybe one of the most important accomplishments of humankind. I really do.
Yeah, absolutely. It's certainly critical that we get this. We'll leave it there for right now. XPO Logistics founder and CEO Bradley Jacobs, good to see you. Good luck this holiday season and good luck with the split. We'll talk to you soon.
Thank you.
All right, do stick around. Much more ahead on Yahoo Finance Live.
This is Yahoo Finance Live. We are seeing stocks slightly higher, the S&P up very marginally right now. We were just talking with XPO Logistics CEO Brad Jacobs about some of the challenges of this holiday season, although he seems like he's confident the companies are on top of it. But as I alluded to, Brian Sozzi, UPS has now said there are going to be some limits for some of its retail partners.
Right, Julie, and Brad Jacobs at XPO saying, calling this holiday season the mother of all peaks, and he's really, he was right on the mark there, because a lot of these shippers and retailers have never even seen demand like they're seeing during this holiday shopping season. And keep in mind, this comes before they're going to have to deal with demand because of a COVID-19 vaccine. But specific to UPS, we are seeing reports out there, first reported by the Wall Street Journal, that UPS is not necessarily taking packages from a select group of retailers. Gap is mentioned, Macy's. Now, a source does tell me that this relates primarily to unplanned shipment volume. So basically, UPS has worked out the shipments it could take from a lot of retailers before the holiday season. What they're doing now is saying, just because the demand is so strong, unplanned purchases that they did not agree upon cannot be taken. Consumers will get their packages, maybe just a little delayed.
You know, Sozzi, it's an interesting story, along those lines, as you're hearing, where this is essentially, let's call it like a drop ship type model, right? Like, the supply chain doesn't really have excess capacity to deal exactly with that. And I think it also goes back to a retail story we've been discussing all through the holiday season, which is that there's now an expectation from retailers themselves that consumers are going to be more deliberate, space things out. People aren't going to be kind of doing a last second surge. And it's, in a weird way, it sort of shows how fine tuned the whole operation is, right? I mean, if you're planning on a smoother rollout and all of a sudden you get an influx of 1%, 2%, 3%, the volume of orders above what you expected, now your shipping partner says, hey, we didn't agree to that, or we don't have that kind of space to meet that promise that you made, whether it's overnight shipping, 2-day, 3-day, whatever it might be. And I think it's just it's interesting to see in real time maybe all of our habits just sort of getting streamlined and containerized, as it were, as we go along here.
I think it's interesting to me, the real challenge during this holiday season is not necessarily going to be, can they get your package to you in the time you want it? It's how do they communicate about that? For example, our producer was telling us this morning, he ordered something and was already told it won't get to him until early January. So to me, as long as these companies can be transparent, can predict well that supply chain and logistics and how it's going to look with their customers, that's going to go a long way toward helping this process. The problem is when you order something, you expect it to be there by Christmas or by Hanukkah, and it's not. So we'll really see how well they have fine-tuned, if you will, the transparency and predictability of the whole process. We shall see.
And I'll leave you all with this this deep thought on this Thursday morning. And Miles, you could probably appreciate this. You're a longtime Buffett watcher. This indicates what you're seeing today from UPS and FedEx, really how the wide moat around these businesses. Retailers are relying on these companies like never before. It also indicates prices are going to go higher for UPS and FedEx in the new year. They have raised prices, but really expect more increases. Why? Because they can.
Good point. All right, Sazi. Hang tight. We're going to be back in just a few moments talking more about what is going on in these markets. And we're going to continue to talk retail and holiday shopping with the CEO of Curate. We'll be right back. It is 10 a.m. here on the East Coast. This is Yahoo Finance Live. I'm Julie Hyman with Miles Udlin and Brian Sazi. We are seeing a modest increase in stocks here today, most modest for the S&P 500, which is up a less than 0.1%. The Dow up about 0.25%, and the NASDAQ is up about 0.4%, just about a half hour into the trading session. It looks like we could potentially, depending on where we end up, have closing highs for the S&P and the NASDAQ. The Dow has not yet surpassed its intraday high. It's still below 30,000 at this point as we continue to watch some economic data that we're going to get to in a moment, as well as the latest negotiations on stimulus. Coming up this hour, we're going to be talking more about the tenor of the holiday shopping season with the CEO of Curate Retail. That is Mike George. We'll also be hearing from an exclusive interview with Paul Tudor Jones that our Julia LaRoche conducted. So stay tuned for that. But first, we want to start with what is going on the stimulus front and whether, in fact, there is a more real chance this time around that we will be getting imminently some kind of stimulus deal. Our Rick Newman has been tracking that. I don't know, once bitten, twice shy, fool me once, I don't know, whatever phrase you want to use. Are we really going to get stimulus this time around before we seat the next Congress? What's the deal?
Be skeptical. I guess that's my way of thinking about it. So it does seem as if the two sides have made progress here. There is this so-called bipartisan agreement on a bill of around $900 billion. And the key thing that has changed here is the two Democratic leaders, Nancy Pelosi in the House and Chuck Schumer in the Senate, say they can accept this as a starting point, which I guess means they think this is in the ballpark. But the problem remains, Senate Majority Leader Mitch McConnell just does not seem to support this bill. He is sticking to his guns. He wants a smaller bill that's only around $500 billion. He does not want, these are the two kind of poison pill issues for Democrats. Mitch McConnell says he does not want that additional funding for states and cities, and he insists there must be liability protection for businesses, which Democrats are just not likely to sign on to. So even though they seem closer on the number, there's still reason to be skeptical they're going to get a deal here.
Rick, I'm curious as more and more sort of mainstream Republicans have come out and acknowledged that indeed Joe Biden is the president-elect, legitimately so. And as we move past the sort of Trump era, what do these negotiations tell us about what things are going to be like in Washington between the two sides? Are we just going to see more of what we have seen over the past 4 years, and to be fair, the prior 4 years to that? Or is there going to be any kind of reestablishment of ties, of openness, of cordiality for that matter?
I guess you could have cordiality, but that does not mean that much is going to get done through Congress. And we've talked about this a lot. Much rides on the outcome of those two Senate races in Georgia on January 5th. And if Democrats can pull off wins in both of those races, they will have a one-vote majority in the Senate. But that does not mean Democrats are going to be able to do whatever they want. Democrats will still have a tough time getting their own legislation passed because there are a couple of conservative Democrats who aren't going to sign on to everything. And for many votes, many laws, you still need 60 votes to get over the filibuster in the Senate. So we're just not going to see a lot getting done in Congress. There could be cooperation. Maybe Joe Biden as president will get along better with Mitch McConnell than Obama did. We're just not going to see much happen. Just to go back to the stimulus for a minute, I don't want to encourage complete despair on the lack of a deal. It is possible that we don't get a big deal, but we do get some continuation of parts of the stimulus bill, such as some of the unemployment aid. That could be extended on its own or as part of the spending bill that might happen next, or has to happen next week, actually. So we could see small pieces of legislation getting done, but these big deals are going to be tough.
Gotcha. Rick Newman, thank you very much. Well, turning to economic data now, we just got the November Institute for Supply Management Services index. It fell to 55.9, which is pretty much in line with what analysts had estimated. 55.9 still a relatively robust level. Remember, 50 is the line between contraction and expansion. To talk about that data point as well as the other numbers we got this morning, including jobless claims, we are joined by our Emily McCormick to break it down. Emily.
Hi, Julie. Well, I'll start with that report that we got from the Labor Department on new weekly unemployment claims, since we did see a bit of an equity market reaction to that report. Now, taking a look at that figure, we saw the first decrease in new jobless claims in 3 weeks. Remember that we did get those back-to-back increases in mid-November as COVID-19 cases hit records in the U.S. and new business restrictions came into effect. So taking a look at those top-line numbers, we had initial jobless claims for the week ending November 28th coming in in at 712,000. That was lower than the 775,000 that had been expected, and also lower than the upwardly revised 787,000 we saw during the previous week. Now, by state, we saw two of the most populous states of California and Texas reporting major drops in unadjusted new claims last week, with those falling by about 39,000 and 16,000 respectively. But we did see really broad-based declines across the vast majority of states. Now, taking a look at continuing jobless claims for the week ended November 21st, that hit a 9-month low of 5.6 million. That was also better than expected and down from the just over 6 million reported for the previous week. Now, while this week's jobless claims report was stronger than expected, I do want to note that some of this could be due to the difficulty in adjusting for seasonality factors around Thanksgiving. And then looking ahead to the rest of November, there are some factors that we will have to keep in mind here, because at the end of the month, we are going to see those federal unemployment benefits authorized under Congress's CARES package actually expiring. And a couple of those programs do have pretty high numbers of individuals on them. These include the Pandemic Emergency Unemployment Compensation and Pandemic Unemployment Assistance programs, which together provide benefits for more than 13 million Americans. So seeing how those stimulus negotiations we were just talking about with Rick play out is going to be important for the rest of this month. And then finally, I do want to turn our attention to the Institute for Supply Management Services Index. We just got that economic data point out a couple of minutes ago. As you mentioned, Julie, that did come in slightly higher than expected at 55.9 versus the 55.8 that consensus economists had been looking for. A slight moderation here from October's reading of 56.6. But at the same time, this was the 6th straight month that we saw the services industry, or the services sector rather, actually hold in expansionary territory with a reading over 50. So still holding up pretty strongly here, even in light of the surge in new COVID-19 cases we've seen throughout the month. Julie?
Emily, thanks so much for that comprehensive look at that economic data that we got out today. Appreciate it. Let's talk about how all of this feeds into the markets, right? Because we have had this economic data that continues to show some level of strength in the economy. We're actually now seeing the Dow at the moment at the highs of this young session. The Nasdaq's up about 0.6% as well. We bring in now Keith Lerner. He is Chief Market Strategist at Truist SunTrust Advisory. Keith, it's good to see you. So as we get these economic numbers, I know that you're looking at perhaps a sort of pause phase in the markets through the end of the year, because one could argue perhaps that the market's already priced in a pretty robust economic recovery. What do you think?
Well, first, great to be back with you all. We're still generally positive. I mean, obviously, we had a huge month in November, over up 10%. When we test that out historically, when you look at 12 months, that's still very positive. And you tend to see double-digit gains looking out 12 months. On a very short-term basis, sentiment is getting a bit hot as far as expectations have moved higher. So I think, just some type of digestion period would be perfectly normal after such a big move. But overall, even if we see a little bit of a slowdown in the economic trends, I think the market is getting this right as far as thinking about not just the next 2 or 3 months, but what does the next 9 to 12 months look like? And in general, we think the economic, economy continues, and it is positive insofar as that, there's a lot of debate about this fiscal stimulus right now. From the prior fiscal stimulus, we still calculate almost $1 trillion of savings out there still to help, help households get through this, short-term uncertainty.
Keith, when we talk to your peers, strategists on Wall Street, everyone is quite constructive on the outlook, and we can, we all know those reasons why. I'm curious what the incoming is like right now from your clients. Is there still skepticism regarding why stocks have gone this far, this quickly? Because that was a feature, right, all through the spring and the fall. A lot of questions about why. Is your client base starting to get on board, and does that maybe change how you're thinking about sentiment at all?
Well, we've been calling this a bull market since May, and we've been positive, as you know, as a whole. Our clients, there's still some uncertainty. I think the COVID numbers is hitting home a lot closer to more people as those numbers rise. So I think there's some angst on that side, but they're also looking forward and seeing that vaccine on the other side. I will say just some interesting, things as we look back over the last month. Going into the election, there was just such a high amount of tension, anxiety. And we mentioned, when we talked to you last, that VIX level was twice the level as normal, so a lot of tension. What's really interesting, In November, the VIX decline in that 1 month was the greatest decline in the history of the data back to 1990. So we had about a 45% reduction in the VIX. And what that tells us is that was a big release of some of this tension. Now, I think what the market has to look forward to is, okay, what's the next catalyst? We think because we're still relatively early in this economic expansion, the next catalyst is simply the business cycle working for the market. But again, I just think sentiment on a real short-term basis is a bit hot, but you don't want to become too cute if you think the big market trend over the next year or a few years is still positive, and that's our base case.
Keith, I'm curious on what camp you fall into. Do you think we will see on a global scale a growth boom because of the vaccine? Because I would argue that's what the market globally is pricing in today.
Yeah, and the way we're thinking about it is almost a tale of two halves for next year. It's still going to take time to get, as far as the logistics on the vaccine, but we do think we're somewhat spring-loaded in the back half and into late to 2022. And I think the other thing that has been underappreciated, which we've been really speaking about for several months, is earnings. We think on the other side of this that companies are going to be leaner and meaner. And if you think back to the financial crisis, when companies came out of that, profits came back much quicker, even though we were still in a relatively slow economy. On this side, with that spring-loaded economy, we think that earnings will ramp back up very, very quickly. And I think that should support the markets. But again, I think as expectations get up, you're just a little bit more vulnerable to unexpected bad news. And the whole vaccine process isn't going to just be smooth. We will have some bumps along the way. But again, you have to look at the main trend, which we still see as positive, Brian.
I'm enjoying all of the analogies we're getting over the past few days now. Spring-loaded, you just referred to. Somebody else said it's like when you hold a volleyball underwater and then it pops up when you let it go. Keith Lerner, looking forward to talking to you soon. Keith Lerner is Chief Market Strategist at Truist SunTrust Advisory. Thanks so much. When we come back, we're going to be, thank you. When we come back, we're going to be talking about the holiday retail season with the CEO of Curate. We'll be right back.
All right, welcome back to Yahoo Finance Live. Miles Sutton here in New York. Of course, we are in the thick of the holiday shopping season, just getting through the busiest weekend of the year. Joining us now to discuss how things went for their portfolio of companies is Mike George. He's the CEO and president over at Curate Retail. Mike, great to speak with you once again. I'd love to just start with an overview of what the last couple of days have been like for you guys and what trends you saw through the Black Friday, through Cyber Monday in this very different shopping environment.
It's good to be with you. And like everyone, we're seeing certainly this huge pivot to digital. So this Black Friday weekend was all about digital shopping, which we think we're well positioned to capture. So certainly record levels of visits to our websites, our streaming services, and also across all forms of social media, just enormous growth in Instagram, Facebook Live. So you definitely see a consumer trying to find alternatives to the store, trying to find other immersive shopping experiences. And so we think we're well positioned as she makes that pivot to speak to her on these various digital platforms that we've been investing in. So big trend towards digital, and then a big trend towards all things for the home. So what she's cares about right now is the home, it's nesting, it's consumer electronics, home fitness, culinary. So big shift to those categories.
Mike, you're good to see you here. It's Brian. You're also the head of the National Retail Federation. Put that hat on for us for a second. What are you hearing from your connections in the industry regarding shipping delays? It's a big topic. It's very much center state right now. Will consumers get their gifts on time? And what are some of the downfalls here? Because it looks like UPS, FedEx just can't meet this e-com demand.
You know, it's certainly a big area of focus for the industry, and we knew this was going to be an issue months ago. And so we've been working with the carriers. We've been working across the industry to first of all, to really encourage consumers to shop early. In fact, the NRF put out a big marketing campaign to that effect to just raise awareness to the importance of not waiting till the last minute, shopping early. And I think we did see pull forward into October and early November. And as you know, sales results were pretty strong during that time period for the industry. And then it's about just sort of staying on it, working with our partners to make sure we've got the right support. I think we'll be okay, but every retailer needs to know where they are with those shipping windows, and make sure they can meet their delivery promises. That's certainly our commitment to our consumer. We talk to UPS and our other carriers many times a day to make sure we're well situated to get these products out, and we think we'll do fine.
Mike, curious on what you're seeing within your super users. These are the folks that purchase more than 20 items a year on your platforms. Are they spending cautiously this holiday season?
I would say they're shifting their spending. This consumer has proven to be resilient. And it's an unpredictable season, so every day is a new challenge. But what you do see is a shift in spend. You do see this focus on the home. So she wants to stay fit. She wants to be able to entertain her family. She wants to buy gaming gifts, electronic gifts. And so those kinds of products are I would say, doing well. The Bose and Nintendos and HPs and those items for the home. Dyson vacuum cleaners are a strong category. On the flip side, she's not spending as much for herself. She's not spending on apparel. She's not spending as much on beauty. So you definitely see some pressure in those fashion categories. So we're trying to watch that every day and make sure we're continuing to adjust our assortments to be relevant to that super user, to speak to what she cares about in this moment.
Mike, on a related note, it's Julie here. Good to see you. On a related note, what about ticket? What about people's willingness to spend at this point, especially since we keep hearing about the so-called K-shaped recovery, right? Where the people who were probably doing well before maybe are doing the same or even better, whereas the people who have less are perhaps doing even worse.
I do think it varies quite a bit across the industry, to your point. Some families doing okay through this tragedy, others struggling more significantly from an economic standpoint. I think with our consumer, we're seeing a fairly stable ticket size. So I think the product has to be right for the moment. But if the product is right and the value is right, she'll spend. But it's definitely selective across the industry. Some of the data suggests that for the industry, the spend per consumer was down a bit over the Black Friday weekend based on our NRF surveys. So a little early to tell whether that's a pullback in spend or just a shift in timing, because again, the early part of the season, all the numbers for the industry look pretty strong. So I think we're still trying to navigate it day by day, but we're finding that if the product is right, the consumer is willing to spend.
All right, Mike George is the president and CEO at Curate Retail. Mike, great to get your thoughts this morning. Thanks for taking some time to talk to us.
Thank you. Good to be with all of you.
All right, coming up, we're going to have a lot more here on Yahoo Finance Live. Looking at stocks trading at record levels. Dow back above 30,000. On the other side of this break, we're going to talk to the CEO of Playboy. That's coming up in just 2 minutes.
Okay, Playboy is hot off a sexy third quarter of sales that could arouse investors as it heads off into public company land. Let's bring in Playboy CEO Ben Cohn for more on this one. Ben, good to see you again here. So your third quarter sales up 86%. Has that momentum continued into the holiday quarter?
Good to see you, Brian. The momentum has continued. We saw record sales in October on our Yandy platform. Sales were up over 40% year over year. And on Playboy.com, which we relaunched as a shopping site, the last 12 days of November, we did more revenue in the last 12 days of November than we did in all of the third quarter. So we're very optimistic going into 2021 and for the balance of the year.
Hey, it's Julie here. I'm sure you're going to get tired of talking about this, the sort of rebranded Playboy, right? That you stopped publication of the print magazine earlier this year. It's more of a focus on consumer products now. But talk to me about the breakdown of consumer products and what you are seeing as the most popular at this point in time, and maybe how that has changed over time, where the growth area is going to be going forward.
Sure. Look, we have product all over the world. We sell product in 180 countries. Consumers spend in excess of $3 billion buying our products today. And it's across 4 primary categories. Sexual wellness is about $55 million of revenue. Style and apparel, so it's Playboy branded apparel, whether that's PacSun, Misguided, our own, or in China, we are the largest men's fashion brand. That's about $74 million, $75 million of revenue today. Our gaming business, in partnership with micro gaming and Scientific Games, was up 19% in the third quarter, and it would have been a lot better had some of our properties not been shut down because of COVID. And then beauty and grooming. But overall, on a global basis, it's our Playboy branded apparel. But we're very optimistic about our sexual wellness products. We just launched our own benzocaine wipes. We have those in 10,000 stores and big box retailers. Condoms as well, and we just launched our own CBD line of products last month.
Mike, when you think, or excuse me, Ben, sorry, when you think about the future of this brand and just sort of where it's going with younger generations, as we see a lot of younger kids are not having sex as much, right? Sexuality is not really something that surveys say Gen Z is thinking of as a part of their identity. What does that mean for you guys as you look at, where you take the Playboy brand?
Look, we have such a diversified revenue base today. And when we think about it, it's really about enhancing pleasure in your life. And so we renamed the parent company yesterday to the PLBY Group, really focused on our larger strategy about delivering pleasure and leisure in people's lives. And so it's just not about sex. It's about all the other products that we have today across our 4 verticals. And so we're very optimistic based on what we've seen from a demo perspective with our consumer. Our average age has dropped over 10 years in the last year. And we've increased our female audience by over 70% since the rebranding of the company.
That is really interesting. And I have a follow-up on that. I think we were just actually showing one of your products that looked like a pride flag logo for Playboy, because I think at least my generation thinks of it as a sort of retro brand, sometimes in a cool way, perhaps sometimes not in a cool way. So how did you go about changing the image of Playboy where, for those of us who remember the original Playboy, sort of you picture the bunny and it's a very stereotypically male gaze kind of image of women?
Yeah. When I took over as CEO, I brought in largely a female team. And so over 50% of the employees today at Playboy are women. And if you look at our content team, it's almost exclusively women. And so what we're trying to do is tell the story from a female point of view. We have an expression internally that who's behind the camera is just as important as who's in front of it. I'm very proud that over the last 2 years, almost everyone we have used behind the camera has also been a woman. And this brand today, about 40% of our global sales are generated by women.
Ben, small
It's
nuance
really
here
about
before we
owning
go.
your own sexuality.
Yeah, sure. Ben, before we let you go, small nuance here. You did change the company's name, from Playboy to PLBY, and you did tease some potential M&A. Anything imminent, and where are you looking for opportunity?
Yeah, Brian, obviously we're restricted as to what we can say. What I can say is that since we announced our merger with MCAC, which is the SPAC, our deal pipeline has grown substantially. We have a bunch of stuff in the pipeline, and I would hope that over the next 2 to 3 months, we'll be announcing, if not one deal, multiple deals. The change to PLBY Group was the vision we set out 3 years ago, which was to really build the leading pleasure and leisure company on a global basis, really on the back of Playboy. Playboy's infrastructure, selling products in over 180 countries, and given the distribution points we have in those countries, really allows us to buy other businesses and other brands and leverage the existing Playboy infrastructure to realize synergies as well as enhance margins.
All right, we'll leave it there. Playboy CEO Ben Cohn, good to see you. Good luck for the rest of this holiday season, and we'll talk to you soon.
Happy holidays. Thank you.
Thank you. All right, it's going to be hard to top that interview, but we will try. Coming up next, Paul Tudor Jones joins Yahoo Finance Live. Stick around.
All right, welcome back to Yahoo Finance Live. Miles Udland here in New York. These days, it seems that everybody wants to talk about the market rally, but really wants to talk about Bitcoin. Paul Tudor Jones is no exception. Our Julia LaRoche joins us now to talk us through her recent sit-down with PTJ, Julia, where you touched on a number of topics, and of course, we know crypto came up.
Well, that's right, Miles. Paul Tudor Jones is CIO of Tudor Investment Corp, super well-known macro trader. We did touch on markets, events to watch in 2021, and of course, Bitcoin. If you remember, he put out an investor letter back in May, kind of outlining his thesis as to how Bitcoin really acts as an inflation hedge. So take a listen to what he has to say now.
Well, I think the stock market's it's on a combination of fiscal and monetary pulse that we've never seen before in history. Nothing like this. And of course, that's why you've got more companies with a PE over 100 than at any point, any other time in history. I think we're something like 50% more than we had in the top of the 2000 NASDAQ bubble. But there's, again, if you just compare and contrast, in 2000, we had real rates of about 250 basis points. We had nominal rates near 6%, and yet you still were able to achieve these lofty valuations for a variety of companies. Fast forward to where we are now, you've got real rates that are negative 200 basis points, nominal rates 0. And again, you can see why you've got Tesla at 900 times earnings, because of the fact there's really no real good alternative for your cash. And so what we're seeing is what you see normally in many post-election years, a redeployment of cash back into risky assets after the fears that are associated with presidential elections and change in parties and the uncertainty, and then knowing after they go away, irrespective a lot of times of even what the fundamentals are, risk capital comes back in the markets, and that's kind of what we're seeing now. And I assume that trend's going to continue.
Well, I'm hearing you on that and the surge that we've seen in risk assets. Certainly, I know you more as a macro trader, not necessarily an investor. You look at things from a trader's perspective. Are there any events on your radar, anything that could really change things or drive things in 2021?
Well, there's some things that I think are immutable, and then there's some things that are going to be very binary. It's funny, I'm actually speaking from Georgia right now. So I know this in Georgia. I think anyone that thinks that this election is forecastable is just wrong. So I think the Senate is a 50-50 toss-up. You've got 5 million voters, I believe, in Georgia that voted. That number is going to probably drop to 3 million, or it should drop significantly from the general election. That's what runoffs typically do. It's going to be about who mobilizes their base, and you got this brand new phenomena of mail-in voting, which clearly favors the Democratic Party. It takes 10 minutes to go ahead and fill out a ballot and mail it in, whereas most Republicans go to the polls, and what's that, 2 hours? So even though I think you would look at the numbers, you would think the Republicans have an advantage in this, there's just a lot of unknown events around this runoff. And so I think it's a coin toss, and yes, the outcome of that will have a lot of binary consequences, because we're back to it's going to be all or nothing. You're either going to have 2 blue senators, you're going to have 2 red senators, and they'll have significant consequences for some assets. So yes, that part I think is indeterminate. But then I think there are other things that aren't indeterminate. And that's, we're going to have a vaccine. The vaccine's going to bring us back. We're going to have an incredible growth rebound. I have 4 kids in their 20s, and it's like a horse at the beginning of a race. They're so ready to get to see their friends, to get to restaurants, to vacate. They're just ready to get out and go crazy like I think everyone else in the world. And yeah, I assume you're going to have a second quarter explosion, certainly at the retail level, at every level, and you're going to have this just massive boom. And the consequences that I think are pretty clear for fixed income. Fixed income will probably go down during that. Commodities will probably go up. And I think those are the two things that seem to me to be not influenced by what happens here in Georgia in January. Maybe there'll be an accelerant if you had a blue wave as opposed to a red wave. But I think we pretty much charted the course to some type of absolute supersonic boom come second and third Q2 and Q3 next year.
Irrespective of how Georgia goes, it sounds like.
Yeah, I mean, I think again, if the Democrats won, they're going to try another infrastructure bill. So you'd probably accelerate that growth path a bit. If they don't win, I think the vaccine by itself will again unleash so much pent-up demand that you're going to really see a lot of growth in the second, third quarters, and you're going to see commodity prices probably rally, see inflation come back. There'll be a whole suite of things that I think are pretty much baked in the cake.
Can we talk about inflation for a sec? I know you wrote this letter back in May, and I will preface it. I know you're not a flag bearer for Bitcoin by any means, but you did have a fascinating thesis. Would love to kind of get an update on that, especially at current levels, and how you're thinking about the cryptocurrency in the context of your portfolio.
Again, I'm not an expert on Bitcoin by any stretch. It's just with a market cap of 500 billion, it's the wrong market cap in a world where you've got $90 trillion worth of equity market cap, and God knows how many trillions of fiat currency, et cetera. So it's the wrong market cap, for instance, relative to gold, which is 8 or 9 trillion. The Bitcoin reminds me so much of the internet stocks of 1999, because the internet was in its infancy. No one knew how to value it because of the world of possibility that lay ahead. What you can be certain of is that probably 20 years from now, our kids and grandkids, whatever, all of us will be using some type of digital currency. Digital currency will be used by every sovereign. They may have their own digital currency, whatever. They'll be very, very, very commonplace at that point in time. Cash may be gone. And so in that world, where does Bitcoin fit in? As well as some of the other cryptocurrencies. Where does Ethereum or Tether? I don't know. I'm not smart enough to figure that out. I think that Bitcoin, if I really had to kind of guess what the future is going to be, it's going to be a lot like the metals complex, where you have precious crypto. That might be Bitcoin. It's the first crypto, first mover in a world that's so compressed. It has that historical integrity within digital currencies that it will always have. So that might, and again, because of its finite supply, that might be the precious crypto. Then you're going to have transactional cryptocurrencies along with the sovereigns. And they may be more like the industrial metals. So where you have gold as a precious metal, and then you've got copper and platinum and palladium, et cetera, that are industrial, lead, aluminum, industrial metals. You may have precious crypto and you may have industrial crypto. So what I do know is that it's no way possible today to know what the next 10 or 20 years are going to be like. And I know that if I had to again take a position on it, I'm gonna take the brand name, which is Bitcoin. I'm going to assume that it's the wrong price for the possibilities that it has. And I'm going to assume that the path forward from here is north. And again, we had no idea in '99 of how the internet was going to sort out. And there were some companies that obviously, if you owned in '99, despite the crash that came after that, did just incredibly well and ended up becoming dominant players in the world. That's what's going to, my guess is that's what we're going to sort through.
You can watch part 2 of our exclusive conversation with Paul Tudor Jones on Yahoo Finance. We'll be talking about wealth inequality, stakeholder capitalism, and the deficit. Miles?
Julia, a really interesting conversation there. I think when Paul Tudor Jones starts talking about the new metals complex, and kind of that's his vision for crypto, someone who views macro the way that he does, the trades that he's put on over the last couple of decades, certainly something to take note of. I also think his tech bubble analogy is quite interesting because the tech bubble, everyone associates that with a bad event, and sure, it's been bad for some crypto investors some of the time, but he's kind of seeing the positives that came out of that in some way.
I know there were several winners. Some of the big dominant players today were those .com names that he was referencing, or at least alluding to that theme that we saw in the late '90s, early 2000s.
And for someone with a risk tolerance like his, I think he's basically saying, hey, if you can stomach it, this might be as fat a pitch as you're going to get, and you only get a couple like this over the course of a 30, 40, 50-year trading career. All right, Julia, great conversation, and again, we'll have more coming up here later today on Yahoo Finance. All right, we're off for a short break. On the other side, we're going to talk a bit about Goldman's call on shares of Tesla, the firm finally getting on board. We're watching stocks here trading at record levels. We're back in just 2 minutes.
Shares of Tesla up 3% today. That means the market cap of the company $556 billion as it prepares to enter the S&P 500 on December 21st. Goldman Sachs is raising its rating on the company. That happened after the close yesterday. Mark Delaney is the analyst there. He raised his rating to buy from neutral. The price target is 780, which is the highest on Wall Street right now. And he basically said the shift toward battery electric vehicle adoption is accelerating, will occur faster than our prior view. What's also interesting is that he talked about not just the cars for Tesla, But the other stuff that Tesla does, I mean, we never talk about Solar City anymore, but it got wrapped back into Tesla. So it's interesting that he highlights that as a potential growth opportunity as well. Miles, you know, I don't know what Tesla could do wrong at this point that would dissuade people.
Yeah, it's funny you mentioned the note having comments on the other stuff that Tesla does. We're all old enough here to remember when the other stuff was the main thing to be excited about, and that wasn't as exciting a story. Now we're going back to they sell a lot of cars. I think it's interesting to see a projection out to 2040 from Goldman, 15 million cars a year by 2040. Sure, I mean, why not at this point? I think it's such an interesting story on a number of levels, and the level we're looking at Tesla on today is how do analysts make sense of a stock? They get a lot of questions on a stock that the street, some analysts have not been very right on the stock. Other analysts have been very right and are even more bulled up the higher the stock goes. But it's an emotional name, Brian Sozzi. Everyone has an opinion. Everyone has to have an opinion, it seems, on Tesla. And so I think to see a shop like Goldman come out and basically throw up the white flag on this thing at this point in time, right, as it's about to be included in the S&P. And as Julie said, I mean, consensus is what could go wrong, Sozzi, but that always kind of puts up your spidey sense, right? Maybe something will.
Well, Miles, listen, I know all the Tesla bulls out there on Twitter that love to tweet negative things to me. They're cheerleading this. They love this call. They see Tesla selling 20, 30, 40 million cars by 2050. And that's all fine and good. It's Goldman Sachs. They're going to cheerlead this. But can we just focus on the rating here? Neutral rating? Tesla has been, over 600% this year. And Miles, we've had these discussions in the past. As a stock analyst, you're paid big money, especially if you're working at Goldman Sachs, to make big calls or just get it right in some form. This analyst has clearly been out to lunch, which ultimately begs the question, can you put a lot of stock in what he's calling out now with regards to hitting 20 million potential vehicle sales for Tesla? I think this note happens to disregard some of the competition this company is going to see over the next 5, 10, 15, 20 years from very more established automakers, Ford, General Motors, you name it.
I mean, at the same time, when a company's price action can at times be so divorced from fundamentals and is really more of a sentiment stock, to be fair, it's hard to predict how something like that is going to do. I mean, it's really that X factor that is difficult to analyze, kind of to Miles's point about trying to get your hands around a stock like this. All right, we are going to take a quick break. When we come back, we'll be talking about meatballs, not real meatballs. We'll be right back.
All right, welcome back to Yahoo Finance Live. Miles Sutherland here in New York. We're about an hour and 20 minutes into today's trading session. Let's take a look at where the markets are right now, because we have the NASDAQ at a record level, the S&P 500 set for a record close here, the Dow back above 30,000. We hit that record on Tuesday. We, of course, coming off an amazing month of November. Yesterday sort of had a sleepy session, and things picking up steam here as we get today's trading session underway. One company we love talking about here at Yahoo Finance is Beyond Meat. Those shares are up about 2.5% right now. The company earlier today announcing that its Beyond Meatballs will now be in Costco's, $10 for 2 dozen, Brian Sozzi. Not surprising to see the stock up on this news. Anytime anyone can say, we're now working with Costco, we're now in Costco's, that's going to be a positive thing for the company. But in your story, you outline, as you'd expect, a nice bulk discount here for folks who are acquiring these at a Costco.
Yeah, Miles, it's not the first time that Beyond Meat has entered Costco. They originally entered in, I believe, in late 2019 with their Beyond Burger, but this is a bigger deal for them. These meatballs are good. They taste good. I eat them all the time. It's just the reality of the situation. But a lot of people have never even tried Beyond Meat products before, probably certainly not in Costco because they've never been there. So they'll offer that discount up front, try to drive trial, try to get people acclimated with the product. And this comes on the heels of them introducing 2 new lower fat burgers a couple weeks ago. Also inking a deal with Pizza Hut. We had founder Ethan Brown on, Beyond Meat founder Ethan Brown on to discuss. So they're ending the year on a high note. And for them, that's good because they had a challenging third quarter and the stock really got slaughtered.
Brian Sozzi, we've been talking a lot about Beyond Meat lately. We have not talked as much about Impossible, which of course is its privately held competitor. We haven't talked as much about Nestle, for example, and some of the other big food companies that are developing their own products on this front. But they're out there. I mean, when I go to the grocery store now, I see more selections, more choices than ever in the freezer case or in the fridge case where they have these types of things. So I still wonder about, yes, Beyond Meat probably has the best brand recognition, but I still wonder about those other entrants and those other competitors and how that's going to play out.
No, there's definitely a battle here, Julie. Beyond Meat is though, I think, separating from the pack a little bit, just in terms of the pace they have been able to go to ink some of these deals with the Yum brands, with the Costco, but Impossible Foods certainly right there. They're getting into a lot of doors, and you have companies like a Unilever. These companies want to play in this market. It's growing fast, but 2021 is going to be a big year. It's going to be an interesting year if Beyond Meat can see their growth rates re-accelerate after the challenging third quarter, in large part because restaurants been closed, but also because there's a lot more competitors on the market, to your point.
Yes, certainly a maturing space, to say the least, Sozzi. And I think the way that these companies try to, pull the levers of growth, as corporate leaders love to say, will be interesting to follow as we get into, sort of what we're expecting to be a roaring 2021 and perhaps a roaring entire decade. And just want to highlight something that we wrote about earlier today in the Yahoo Finance morning brief. Of course, you can get that sent to your inbox every day right around 6 a.m. And this is Wall Street strategists already revising their 2021 outlooks. Sean Darby over at Jefferies had a 3750 target on the S&P 500 for the end of 2021. That was published back on November the 6th, just a few days after the presidential election. And now he's looking for 4200 for the S&P 500 by the end of next year. And that's far from the most bullish that we've seen from any analyst on Wall Street. I really think Goldman Sachs, David Kostin, the team over there, set the tone for where Wall Street commentary is at with a 4,300 price target on the S&P 500. And so, Julie, I think we talked yesterday a little bit with Liz Ann Saunders at Charles Schwab about the exercise of putting a price target on the S&P, but ultimately it's kind of just the analysts showing their work on the math. We think that this is how much earnings S&P 500 companies are going to earn next year. This is how much we think investors are going to pay for it, and that formula gets you to a certain price target on the S&P. And I think maybe it all, and it's self-fulfilling, right? People see, 4,000 on the S&P. Right now we're trading just under 3,700. What's another 300 points between friends?
Right. I mean, to Liz Ann's point, she kind of said it's a fool's errand to try to put a specific exact number on it. Because as we all know, who have been tracking the markets for as long as we have, predictability factor is challenging at best when you're looking at these markets. But directionally, what actually tends to happen is that these guys undershoot frequently, especially in rally years when you don't have a shock, if you will, coming out of nowhere. And even in this year, when we had a shock coming out of nowhere, stocks are still going to perform better than many of these strategists had predicted. So maybe you take these and add another 300 points between Fred's Miles. I don't know.
Maybe. And, Brian Sazi, I think when you look at these big round numbers on all of these indexes, and we can, I don't think the public really cares if the S&P hits 4,000, right? But the public certainly knows the Dow is at 30,000. And all of these things feed together. And I think, again, I brought up the Costin point, the roaring 20s. That was great, I guess. F. Scott Fitzgerald seemed to have a good time, but we know what happened after that. And I think it'll be interesting to see how much that thesis plays out, not just next year, but, what's 2024 look like? Does 2024 look like 2018 again in a lot of ways, or does it actually take on some shape of, whatever the future might be?
I feel you, Miles, but I'm going hard right turn right now. Just exchange a follow-up email with Playboy CEO Ben Cohen, was just on with us. He says, quote, "We have sold so much, I need more inventory." I guess it's all about those benzocaine wipes over at Playboy, guys.
Yeah, forget about Gen Z not having sex anymore, Miles. I guess that puts that to bed.
Look, I'm young in my professional career. I try to keep it straight here. I was a little shook during that interview. I unfortunately called Ben Mike, who was the name of our prior guest. Look, you live and learn. You live and learn as you go through this job. All right, that's going to do it for us here. Yahoo Finance Live on this Thursday morning. Tomorrow, we're going to be up 8:25 Eastern. Jobs Day tomorrow. That's coming out at 8:30. We're going to have the numbers for you live when they break. Zach Guzman, Akiko Fujita will be with you for the next couple of hours. See you tomorrow.
It is 11 a.m. here in New York City. Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman, and we are seeing the markets firmly in the green to kick off this Thursday right now. The S&P 500 trading a little flatter than yesterday after hitting that record. We are seeing new records For the NASDAQ right now, up 50 points, and the Dow up 164. Boeing, one of the big movers there, up about 7% on reports. Budget airline Ryanair is looking to buy 75 737 MAX jets. We'll delve deeper a little later in the show on that story. But let's first talk about record coronavirus cases and deaths rattling states across the country. CDC Director Robert Redfield warning the next few months will be, in his words, the most difficult in the public health history of this nation. Hopes of a stimulus deal, new economic data, though, helping fuel some of the gains in the market today. Senate Majority Leader Mitch McConnell speaking just a short time ago, saying that he's a little more optimistic. His words, there are hopeful signs of a compromise on the stimulus deal by the end of the year. We've seen Treasury yields dip on optimism around these discussions. The 10-year hovering around 0.933 there. Weekly initial jobless claims pointing to continued improvement in the labor market, though the momentum is slowing. 712,000 Americans filing for initial unemployment benefits. That is a decline from 63,000 from last week. So let's begin with that data we got out this morning. Emily McCormick standing by for us for a walkthrough of all the numbers we got today. Emily.
Akiko, this was the first decrease in new jobless claims we've seen in 3 weeks. Remember that we did get those back-to-back increases in mid-November as COVID-19 cases hit records in the U.S. and new business restrictions came into effect. So taking a look at those headline numbers, initial jobless claims for the week ended November 28th coming in at 712,000. That was better than the 775,000 that had been expected, as well as a decrease from the upwardly revised 787,000 we saw during the previous week. Now, on a state-by-state basis, we saw two of the most populous states, California and Texas, reporting major drops in unadjusted new claims, those falling last week by 39,000 and 16,000 respectively, although we did really see broad-based declines across the vast majority of states. Now, turning to those continuing claims for the week ended November 21st, that's the number of Americans still receiving state benefits, those coming in at an about 9-month low of 5.6 million. That was also better than expected and an improvement from the just over 6 million we saw during the previous week. Now, while this week's jobless claims report was stronger than expected, I do want to caveat that this could be in part because of the difficulty in adjusting for seasonality factors around Thanksgiving. So will be interesting to see where things shake up in next week's report. And then just taking a look at the rest of December, there are some concerns to be watching for. At the end of this month, we are going to see those federal unemployment benefits authorized under Congress's CARES Act expiring unless another stimulus package gets passed. And those include programs like the Pandemic Emergency Unemployment Compensation Program and Pandemic Unemployment Assistance Programs, which together provided benefits for more than 13 million Americans, according to the report that we got out this morning. And then also want to highlight that this report on weekly unemployment claims does come as usual for each month at least, a day ahead of the Labor Department's monthly jobs report out tomorrow morning. And that is expected to show the smallest number of jobs added back since April's record drop in payrolls at the height of the pandemic. So consensus economists there looking for non-farm payroll gains of 475,000 with an unemployment rate ticking down just slightly to 6.8%. So likely to get another indication of a slowing labor market recovery in tomorrow's report. Akiko and Zach.
Yes, really not a good sign, Emily.
I just want to point out one thing here, Akiko, before we kind of wrap that, just being that we do always kind of look at state-by-state recoveries here as well, which is one of the points highlighted here in the Department of Labor report. When you look at unemployment rates in terms of insured unemployment rates, that's the ratio of people on unemployment benefits divided by the labor force. This is the first time that we've seen Hawaii not top the nation in terms of a state-by-state look since August. California, as we know, has been dealing with a rise in cases there. Now the worst uninsured employment rate in the U.S. at 7.3%. As Emily noted, though, that's still vastly better than what we saw earlier in the year when Hawaii was up above 20% in terms of that metric. So, I mean, we have seen improvement, but still Nevada, Alaska, Massachusetts, we talked about Nevada as being one of those economies still tethered to a recovery in their gaming sector and hotels as well. We'll dig into a little bit of what Hawaii is trying to do to boost that later on in the show. But let's dig more into what this means for the market and how investors should be playing that ahead of tomorrow's big jobs report. I want to bring in Tom Lee, Fundstrat Global Advisors, Managing Partner and Head of Research right now. And Tom, I mean, you've been pretty spot on all year in your calls here. Talk to me about what your expectations are now after we got the unemployment update today when it comes to that jobs report tomorrow.
Well, we work with this big data macro research firm called Deep Macro, and they've been calling for a big payrolls beat for November. Something in the million jobs range. And I think today's jobless claims really seem to support it. What they're saying is that the fill rate, the speed at which jobs are being filled is quite fast. So the labor market's probably a lot stronger than we think, especially given all the soft lockdowns taking place.
Tom, you've of course been highlighting, like so many others, this rotation that we've been seeing in the markets out of growth into value. A lot of that driven by some of the optimism around the vaccine news. When you look at some of the data that came out today, though, what do you think that suggests in terms of how sticky this is? Is this one of those things that continues even with the slowing momentum, at least in the labor market, just given the light at the end of the tunnel, or you think we could see a bit of a reversal?
It's tricky. I mean, we've kind of had many false dawns in value, and I've been fooled many times thinking the rotation's going to happen. So I think we all are kind of on rotation watch because it's been 14 years of growth, massively beating value. But there does seem to be some real underlying momentum in the economy, believe it or not. And I think it's the labor report's sort of evidence of that. But I think if it really is going to have traction, it's because all these cyclicals, which we call epicenter stocks, have become turnarounds. They had to cut costs so dramatically this year. They've reset their whole business model, cost engineering. I just think that operating leverage is what's causing these stocks to act so well.
Yeah, Tom, I mean, you've been talking about that rotation for a while now, and we've seen that, and you've kind of pointed it out when you look at the Russell value versus the growth indexes there, kind of the rotation, as you've been talking about outperformance and rollover that you haven't seen since going back to, 2008 there. So, I mean, there are concerns when I think about the cyclicals and some of those bankruptcy risks that are kind of, you could say, maybe being overlooked, maybe using the cruise stocks here as a proxy. Bloomberg was out kind of noting that companies, junk-rated companies that are losing money even before paying their interest payments doubled in Q3. That number went from 26 to 47. So, I mean, I guess when we talk about that, we know we're going to get back to normal at some point when these vaccines roll out. But don't you think that the debt burden on some of these cyclical stocks is going to be rather large and weigh on growth once we get back to that normal?
Yeah, I mean, we're in a tricky period. Because we can either rely on, the contemporaneous data we're seeing, like exactly what you're pointing out, or we can look at the signal from markets. And to me, if credit markets were telling us something, spreads are really tight, the volatility in credit indices are really low, and even the CDX, the credit default swaps are behaving. So they're saying that credit investors are not troubled by all the contemporaneous data you're pointing out, including rising bankruptcies. In fact, they might even be saying that we've already peaked in that cycle. I mean, it's something JP Morgan wrote about over the summer, that the credit cycle in terms of defaults is probably already peaked. And if that's true, then the equity investor shouldn't focus on the bankruptcies as much as the fact that credit markets are functioning really well and spreads are tight. And that's good for risk premium. So I think multiples are going to go up a lot. That's one I think people would be surprised at, is value stocks could get re-rated pretty dramatically. And that's why 2020 highs isn't the ceiling for the stocks.
Tom, how are you looking at some of these travel names that we have seen gain on the back of the vaccine news? You look at some of the airlines, for example, we saw a big uptick, of course, during the Thanksgiving weekend. But today we get this news from Delta also saying there is a bit of slowdown that's happening, also cancellations that are picking up as well. What do you think of some of those names as an investment? And is it worth putting your money behind that in hopes of things ultimately picking up, whether that's 6 months from now or a year from now?
Well, I think that a lot of travel businesses don't have long-term substitution. meaning, the pandemic is completely destroyed any ability for us to have normal lives and travel. But we have to think of, in the post-pandemic world, are there going to be competitors to cruises, destinations, to theme parks, to airlines? And if the answer is no, then these companies simply just have to reignite demand. And if we're talking about a 12-month period where we're in that gray zone where we don't know, that's the opportunity for investors, because I don't think there's intermodal substitution for any of these. And so that means they're going to come back, roaring back at some point with much lower cost models. But you're right, we're not buying it for next quarter's earnings, because they're going to be awful for the next couple quarters.
Yeah, and I guess, looking past those, as you pointed out just a bit ago, it does seem like investors are looking ahead to that recovery, but I don't want to look too far ahead. We had Morgan Stanley's Mike Wilson telling Bloomberg this morning that stocks look like they could be setting up for a correction at these levels. As I said, you've been right all year and kind of calling the levels to watch here. Earlier this week, you were pointing out the data has shown that when you've got year-to-date returns of 10 to 15%, generally through November, December is 100% of the time up, averaging about 3.3% returns for the month. So, when you look ahead here over the next kind of months timeline, what are your expectations of potentially working in a pullback here?
I think a pullback could happen. I think even this week was a little shaky, the start of this week, but our view is strong markets stay strong. So we were strong into December 1. There's no reason for markets not to finish strong. In fact, history, as you point out, really strongly supports that it's kind of sounds bad to say, but 100% of the time, December is an up month. And so 3,800 is a pretty reasonable level, which is a lot of upside from here. But I think part of the reason we could do this is in our clients with institutional investors and portfolio managers, we just meet a lot of skepticism. They're skeptical of the vaccine, that this is unusual to have a vaccine rolled out so quickly. The logistics, people point out about the temperatures required for the Pfizer vaccine or the unwillingness of people to take it. And they just think that everyone's too optimistic. But when everyone says everyone's too optimistic, that means everyone's skeptical, which is good.
Good take.
Means, yes.
Yeah. Not always agreeing to the take that's in front of you. Tom Lee, it's always good to talk to you. He is the managing partner and head of research at Funtrack Global Advisors. Let's turn our attention back to the coronavirus, because these are some really sobering numbers that we have gotten over the last 24 hours. More than 100,000 people hospitalized on Wednesday. That is nearly double the high point, the peak that we reached in spring, the largest death toll ever in a day, 2,760 people. And CDC Director Robert Redfield warning that 450,000 Americans may die by February if we continue at this rate. I want to bring in Dan Trigub. He is the former head of Uber Health. He is joining us today to talk about the launch of his new company, MedArrive. He is a co-founder and CEO there. Dan, this is certainly a timely discussion to be had, and we want to get to your new venture in just a bit. But I want to get a sense of how you are viewing all of these dynamics at play right now in the healthcare space. As somebody who is very familiar with the growth that we have seen on the other end of this virus with telehealth, with remote health, how are you looking at the huge uptick right now in the virus itself and the ability for healthcare workers to be able to control this?
Akiko, thank you for having me today. And I think we're in an unprecedented time, as many of us are saying right now. And I think from our perspective, from my perspective at MedArrive and my background working at Uber Health, I truly believe the next breakthrough in healthcare is not going to be necessarily genetics or therapeutics. It's going to be how care is delivered in this country. And we need to find more innovative ways to bring care into the home being the hub of healthcare of the future. And when we think about delivering the vaccination, we can't overburden our health systems, our hospitals. We have to find innovative ways to bring care into that home environment. And that's really what is at the core of our mission and what we're doing.
Yeah, I mean, it's an interesting time when we talk about telehealth getting so much of the attention here, but clearly there are constraints
Yeah.
in how much telehealth can do, especially when we're talking about rolling out a vaccine that's going to require in-person care. You guys are tapping into a network of more than 20,000 EMTs here. Talk to me about how that might be a huge boost when we discuss constraints for healthcare workers, hospital staff, especially when we have so many beds now in the ICU dedicated to caring for patients.
Yeah, we have to find these new innovative approaches. Telemedicine can't do everything. I mean, with the tailwind of the pandemic, telemedicine has been growing rapidly. But as we like to say, as we say at MedArrive, there's no humanity, no physical touch in telemedicine. It's just a digital screen. We hear from doctors and physicians, they love telemedicine because sometimes they can just look over the shoulder of their patient and see what's going on in the home. But there is no physical contact there. They can't physically be in the home. And for us, we believe EMS, EMTs, and paramedics are one of the most underutilized workforces in healthcare. And we can be that physical contact for that physician, for the health system in the home, leveraging this workforce and still use telemedicine, but really be the eyes, hands, the physical touch in the home on behalf of our partners.
Dan, what do you see as the potential, if we're talking numbers here, what do you see as the potential for telehealth, and to what extent do you think the pandemic has accelerated the growth?
Well, it has absolutely accelerated the growth. And we've seen staggering growth in terms of the amount of telehealth visits that are happening. Now, that said, the data shows that close to 30% of the population doesn't always necessarily trust telemedicine. And again, it's just a physical screen. There is no contact there. And what we believe is we need to find a bridge. We need to find a bridge between pure telemedicine and that physical contact. And that's at the core of what we're doing at MedArrive.
Yeah, I like the concept here for someone who's outside of the sector looking in at it, who might think that they buy your point that EMTs could have some time here in the downtime. How does it work structurally? How would you want to leverage that workforce here if they are supposed to be out there for emergencies? I imagine they would have to be distracted from helping patients, shifting back into emergency settings. So how might that actually work?
Yeah, for us, first to step back for a second, we think this is one of the most underutilized, undertapped resources in healthcare. EMTs and paramedics are everywhere. They're in rural markets today just as much as in large metros. The other thing is they're highly underutilized. A typical EMT paramedic works 3 12-hour shifts a week. They have extra days in that work week, and they're highly skilled in scope to do a variety of services. So what we're doing at scale for the first time is efficiently aggregating this labor force by partnering with local EMS agencies and national EMS companies, where we get that dedicated supply on our platform when they're not on the job, when they're not on the clock for their day job, driving an ambulance or going into the communities that they serve. They're using their own vehicles, they're off the clock, and they're on the MedArrive platform through this partnership-driven approach that we've built out. So it's really about accessing this labor force efficiently, and a labor force that knows the community, knows the local folks who live in the communities they serve, and a great opportunity for us to tap into that.
Dan, to what extent do you see MedArrive expanding its services beyond medical care? I know when you were at Uber Health, you were looking at, for example, food delivery for recovering patients as a way to sort of connect all the platforms that were within the Uber ecosystem. You've got MedArrive right now, and I know the focus is on EMTs, but what's your grand vision here? Do you see being able to connect the dots beyond just simply medical services?
Yeah, absolutely. This is just the beginning for us. We can tap into a vast array of labor and different forms of services into the home once we build out our platform. Just to be clear, at the core of it, we're a software as a service, we're an infrastructure, we're the glue connecting patients and health plan members to this efficient workforce through and by their health plan or their healthcare provider. So we're really building partnerships, more of a B2B approach. So we're not trying to have people come directly to us. We partner with a Medicare Advantage plan, a Medicaid plan, and we become that extension into the home. And certainly once we're in the home, there's a variety of services we can do. We're starting with EMS labor for a variety of reasons, but the future is endless in terms of the services we can feed through this platform as we begin to scale.
Yeah, it's very interesting stuff there. The CEO and co-founder of MedArrive, Dan, thanks so much for joining us today.
Thanks, Zach. Thanks for having me.
We're going to take a quick break here on Yahoo Finance Live, but when we return, the latest out of Washington, D.C. on the stimulus front, with stocks catching a boost after Senate Majority Leader Mitch McConnell says a compromise is within reach and that it can be reached here before the end of the year. I'll bring you the updates on that front right after this. Stay with us. Welcome back to Yahoo Finance Live. Moments ago, we had the Dow rebounding here to session highs off optimism being shared by Senate Majority Leader Mitch McConnell and his viewpoint that stimulus compromise is within reach here to get both sides to come together, perhaps agreeing to that $908 billion bipartisan proposal we talked about on the stimulus front earlier this week. Want to get to Yahoo Finance's Jessica Smith, who has the latest on that front. Jess?
Yeah, Zach, Majority Leader McConnell is still pushing his targeted relief bill, that roughly $300 billion proposal. But he says that he's seen hopeful signs in the past few days, and he thinks compromise is in reach if lawmakers agree and work on what they agree on and then put off the other more controversial issues until later. But Democrats have not been on board with that really targeted approach. Democratic leaders did say yesterday that they would start with that $908 billion proposal as a negotiating point, and that was a pretty big concession from the Democrats. So we'll see if that moves the needle at all in the coming days. But we are hearing just another example of how desperate the need is in some situations for more stimulus. The DC public transit system, Metro, is facing a nearly $500 million deficit for next year's budget. The rail ridership is down 90% because of the pandemic. And in response, they're proposing massive cuts unless Congress steps in. Metro's proposing cutting 2,400 jobs in addition to the 1,400 that they are already seeking to eliminate this year. So that's nearly 4,000 jobs lost there. They're also planning to totally eliminate weekend rail service, close 19 rail stations, significantly reduce weekday rail service, and cut bus service down to 45% of pre-pandemic levels. So it would be pretty devastating to the DC region. I talked to the general manager of Metro, and he told me he's never seen anything like this, and Congress has to help. He says this is not just a Washington, DC problem, but it's the same story you're hearing from transit systems across the country. Let's watch.
When you look at some of the major metropolitan areas, they don't work without us, is the reality. You know, they don't function. And not only that, but that's not, I mean, people have chosen that type of environment because of all those things it does, right? I mean, in the Washington region, the metro is part of our culture. It's what we, it's what we do. It's how we make financial decisions, the economy, the land use, where people choose to live, all that's driven around these systems. And to think that that all of a sudden goes away after having been here in almost 50 years for us, and in some other communities much longer, is just unimaginable.
He did say some of the proposed cuts could be rolled back if Congress does do something, if they do pass more stimulus. But the situation right now is dire, and he has to have a balanced budget, and he just doesn't know what Congress may or may not do. Zach and Akiko.
Okay, certainly still a lot of work to be done, even if this sort of bridge of a stimulus bill is passed this time around, at least this month. Thanks so much for that, Jess. We are off for another break, but coming up, one of the largest SPAC deals in history. The nation's #2 mortgage lender coming to market today, backed by billionaire Alec Goris. We'll talk to the CEO of United Wholesale Mortgage after the break.
Welcome back. We got the Dow trading near session highs, up more than 0.5% right now, but big movers to report in the software space with earnings coming from Snowflake, CrowdStrike, and Okta, among a few others. Snowflake delivering some impressive results in its latest quarter with revenue rising 119%. CrowdStrike also delivering some pretty impressive results as well. Big boosts across the cybersecurity stocks we're watching today. For more on that, I want to get to Yahoo Finance's Jared Blickery with the latest. Jared?
Yeah, well, let's take Snowflake first. It's up 14%, almost at a record high. And let's just take a look at the stock movement first, and we can see here is its record high from the other day, almost back there. So let's take a look at what some of the street is saying about it. Morgan Stanley is saying that the company's fourth quarter product revenue guidance was just in line with consensus expectations, which underperforms the big beat and raise cadence of similar high-flying recent IPOs. So Snowflake shares have climbed 168% since its September IPO. And over at Deutsche Bank, they're saying that the lower than expected guidance could prove conservative, meaning they could beat it in the future. Instead, the bank focused on Snowflake's year-over-year revenue growth of 119% in the quarter. All right, let's move on to CrowdStrike. This is another stock that is jumping. Big beats there on both the top and bottom lines. And we got some notes from the analysts on that one as well. RBC has a rating of outperform, raising their price target to 180 from 170, and they're saying that the results show important role of security transformation as precursor to digital transformations. All right, and so we're also looking at some other stocks here in the software space. Zscaler, real quick, up 300% year to date, 25% after really big beats on its earnings as well.
Okay, Jared, thanks so much for that. Another big earnings coming up a little later in the little later today, I should say, DocuSign. So we'll be watching those names too. We're going to take a quick break here. We'll be right back.
Well, you've heard that the show must go on, so too must the trial go on. Despite the pandemic we're seeing here in 2020, the trial for Elizabeth Holmes, the founder of now defunct blood testing startup Theranos, is going to proceed despite some strange, I guess, implementations to make things still happen here due to social distancing and face masks required as well. Our own Alexis Keenan has been covering what kinds of things have had to be put in place to get that trial to proceed here. And she joins us now with the latest on that. And Alexis, I mean, these things have to happen to get the trial to proceed.
They kind of have to happen. This trial has been delayed a couple of times already, Zach. And if you remember, I'll just take you back. The first indictment against Elizabeth Holmes, remember she raised nearly $1 billion for her blood diagnostics company that was set to be the next greatest thing, next leap forward in healthcare. Certainly something that a lot of people would need right about now with COVID underway. But the Justice Department filed its original indictment back in June of 2018. And this jury is supposed to be impaneled beginning on March 8th. So the trial should start shortly thereafter. Yesterday, the judge in the Northern District of California, federal court there, held a hearing to kind of get this trial underway and get things kind of put in place. Now, the district court was held by video conference yesterday. Holmes was in attendance along with her attorneys and along with federal prosecutors, but this was unlike any status hearing that I've ever attended, either as a journalist or as a lawyer. And that's because there are a lot of special accommodations that need to be made in order for this very high profile trial to happen. Actually, to pull it off, the judge talked about things like just what you would guess, the social distancing that has to happen inside the courtroom. There will be 14 jurors, and they will have to be spaced out at least 6 feet apart. And also there's going to have to be alternate jurors, more than usual. Usually there's about 2 or 3. This time the judge said, no, we're going to need more than that because look, people could fall ill, which is another problem. If there are principal parties that are required for this litigation to go forward, they are going to have to stop down if somebody is ill and needs to be, for example, quarantined. Also, the judge talked about clear face masks for witnesses so that they can be heard, and also their lips seen, really important in a trial. And, just emotion is really important in a trial to see how witnesses are behaving and the reactions to their questions. Also, though, unresolved is what exactly is going to happen for these participants who might fall ill. The trial is expected to take at least 5 months. I would say that's a really, really aggressive timeline given the hurdles that all of these parties are going to have to overcome. And let's remember, too, that Elizabeth Holmes has pled not guilty to charges for wire fraud and conspiracy to commit wire fraud through Theranos. Those are charges that carry up to 20 years in federal prison.
Yeah, the downfall of Theranos, very well documented. There's going to be a lot of interest in this one, Alexis, and I know you're going to be following that one closely. Thanks so much for that.
I know.
We are taking another break, but coming up, we're going to be speaking with the CEO of United Wholesale Mortgage, coming to market through what else? A special acquisition merger company. We're talking about SPACs, of course. Matt Ishbia is going to be joining us after the break. Welcome back to Yahoo Finance Live. SPACs, or special purpose acquisition companies, have raised more than $36 billion so far this year, according to numbers out from PitchBook. United Wholesale Mortgage, just the very latest to come to market through a SPAC, the nation's second largest mortgage provider, listing through a $16 billion merger with a blank check company backed by the Goris Group. This makes this the largest SPAC deal in history. Let's bring in the CEO of United Wholesale Mortgage, Matt Ishbia, joining us from Michigan today. Matt, congratulations on the listing. Let's talk about the timing of all of this. It has certainly, no question, been a very strong year for SPACs, as well as IPOs, surprisingly. Why now, and what specifically are you going to be doing with the money raised here?
Yeah, no, we're excited. We're having a great year here. Obviously, it's been a troubling year in the markets in America, across the country, and at a mortgage company, we feel it's really our obligation to make an impact by helping more consumers. And with rates low, we've been able to do a great job with that, and we're excited for the future as well. And so, we think that the opportunity to really level the playing field with us. We're the second largest mortgage provider in America, but helping educating consumers about that. Hey, this is the best way to get a mortgage through an independent mortgage broker, whether they come to us or another lender. We're going to help you get a great deal. And so part of the money that we're raising is to really educate consumers, to drive marketing, and hopefully, take our business from number 2 to number 1 here in the near future.
Yeah, number 2 to number 1, behind Quicken there in terms of wholesale mortgage lender in the country. Got about a third of the market share in that category. Talk to me. It's a very interesting time, I assume, to be in the mortgage business since we've seen interest rates so low. I mean, talk to me about kind of the growth that you've seen here as we've gotten into this environment we're in here with rates near zero. How do you expect that to change maybe over the course of the next couple of years?
Yeah, absolutely. These are the all-time lowest rates. And in our business, we've obviously had a great year this year, but we really shine in a purchase market where a lot of our refinance competitors, whether it's the largest lender in the country or other ones, they do a lot more refinances than us. We're really less cyclical. So in the mortgage business, we actually look forward to if rates do go up, we'll be able to help more people from a purchase perspective, actually grow our market share in that perspective. And so whether it's low rates or if rates are, if the economy gets a little bit better, which we all want in America as an American, we'll be able to really sustain our growth and hopefully even take more market share in a purchase environment.
I mean, even with that said, we have seen huge growth this year in the housing market, largely driven by those low mortgage rates. I'm curious what you have seen in the market. Has there been in terms of the shift that we have seen as a result of these rates? It seems almost so counter to what we're seeing in the rest of the economy. Part of it is inventory, but of course, a lot of it is driven by rates.
Yeah, really low interest rates, everyone can save money. And so the benefits of the economy is if you're paying a mortgage right now and you could probably save $100 a month, that saves a lot of people money and you can use that for other things in your life. And so, 30-year fixed rates in the 2s, if you're not in the 2s, you're refinancing. And if you're buying a house, you used to be able to afford a $300,000 house with a 3.5% rate, but now you can afford a $320,000 house with a 2.5% rate. So it gives more affordability. So it's more buyers are in the market. And obviously people that are refinancing, you got to find an independent mortgage broker to, get you a low rate, close the loan fast, and really a seamless process with the technology that we have and some other lenders out there.
And Matt, Zach alluding to the fact that you're the second largest wholesale mortgage lender right now. You haven't been shy about your ambitions here to become the number 1, topping Quicken. I mean, how do you differentiate yourself, and what do you think is your advantage in the market that takes you to that number 1 spot?
Yeah, no. So to be clear, we're the number 1 wholesale mortgage lender in the country. We've been for 6 consecutive years, but we don't do retail. Quicken is the number 1 overall, retail and wholesale combined. And so what's going to take us to number 1? It's really just educating consumers, because when people realize that the best way to get a mortgage, it's cheaper, faster, and easier to go to a mortgage broker. So you go to findamortgagebroker.com, you find a local mortgage broker, and they shop. They send you to me at UWM or to Quicken or whoever the best deal for you is, but you get a lower rate. Our 30-year fixed rates in the month of November was 2.76, which is lower than the rest of the market. And so cheaper, faster, easier through a mortgage broker. And so when more people understand that, they'll go through the broker channel and we will continue to grow and eventually become the number 1 overall mortgage company along with the number 1 wholesale lender.
Yeah, and Matt, what's interesting here too, and I don't want to overlook this because originally we had you on last year, we were talking about the culture at UWM here and why it's such a nice place to work. For millennials specifically, we had you on about the holiday party and gifting some employees Cadillacs through raffles. You had the chain smokers at your holiday party. How much of the culture do you expect to change here, maybe as you become, a publicly listed company here, and what might that do to change it? Because the other part of this, your story here, you started the company back in 2003, company founded by your father. You worked your way all the way up now to be running it. Talk to me about maybe how it changes now as a publicly traded company.
Yeah, so when I joined in 2003, there was 12 people at UWM, and now we have about 7,200 team members here. But the culture and the family atmosphere has not changed. So we were very small back then, and we're obviously larger now. That is the key and the critical. So obviously with COVID, most of our people are working from home. But when we get everyone back, we can have holiday parties like that again next year and do some great things. But we're still going to celebrate because this was the best year in company history, and we expect 2021 to be significantly better than 2020. And so we're excited about that opportunity. But the culture and the family, you can't change that. That's the secret sauce. If you start changing the family feel, the culture, the team atmosphere, That's the problem. And so we're not changing that. And that's one of the key parts. If we're going public, the key thing is, I'm going to still have the great majority of the shares, and we're going to continue to run the business the right way for our team members, our clients, and consumers across America.
Okay, well, Matt Ishbia, certainly a new chapter for your company today, the CEO of United Wholesale Mortgage. Appreciate your time.
Thanks for having me.
Let's take a quick look at some of the U.S. listed Chinese stocks right now. NIO, the only one that's down in a big way, that is down about nearly 4%, although that's largely on probably delivery numbers that we got yesterday from the company. These moves coming as the House unanimously approves legislation that subjects U.S. listed Chinese companies to the same accounting oversight American companies are subject to. The law is expected to be signed by President Trump, and it certainly could pave the way for a number of Chinese companies to be delisted. We spoke to the bill's co-sponsor, Maryland Senator Chris Van Hollen, yesterday, asking him about the potential for a mass exodus of U.S. listed Chinese companies. Take a listen.
If we allow a country to pass laws that shield their own companies from providing important information to American investors, then other countries would follow suit. Right now, China is the only outlier in the entire world. And so this is a time where their companies are going to have to, find a way to provide this information or ask for their own governments to change some of these rules.
Chris Van Hollen there yesterday speaking to us, Zach, before the House vote, but we have certainly seen it pass unanimously in the Senate and House now. Moving forward, it's going to be interesting to see how some of the Chinese companies read this move. They do have 3 years to comply, but we've already seen names like Alibaba, JD, and NetEase go for secondary listings in Hong Kong this year, raising speculation that maybe they could sort of be laying the groundwork for any potential of an exit from the U.S. But it is worth noting that it is the accounting firms that ultimately have to open the books per se. So even some of the big four names like a KPMG, if they're operating in China because of Chinese rules right now, they can't simply just hand over the books when asked over in the U.S.
Yeah, and I mean, when we talk about kind of the pressure that had been mounting here, it's interesting to see it culminate in this vote just because, both parties really have been stepping up pressure on Chinese companies here. I mean, earlier this year, let's not forget what happened to Luckin too, right? When we think about auditing some of these companies and Luckin and the investigation into that coffee giant there in China, the numbers that seem to be fabricated. I mean, it's one of those things that we've heard from politicians too, not just the senator from yesterday's show, but really this idea that it shouldn't be easier for Chinese companies to access capital markets here in the U.S. and not have to disclose and have the same kind of audits going on for them that's going on for American companies as well, now coming to a head here. But to your point, I mean, I guess it does kind of raise more questions about what the Biden administration is going to want to do here, because as we covered, it seems that he's going to be following similar techniques here used by the Trump administration, not wanting to walk back those China tariffs, at least right away. But still, I think a lot to be learned about how aggressive his administration is going to be here to follow up on what we've now seen pushed through here in Congress.
Yeah, Zach, and I think it's also important to note that it used to be that with these Chinese companies, the main reason to come to the U.S. was largely because all the capital was here. But over the years, we have seen Hong Kong, for example, change their listing rules to be able to attract some of the bigger Chinese tech names closer to home, and they have been able to raise money there in a successful way. And so, there are a number of hurdles for these companies, even if they were to list closer to home because of the regulatory risks that exist in China. But it'll be interesting to see how they toe the line here, or how they sort of weigh the risks moving forward. Let's shift gears here to talk about the cloud space. That is the focus of Influencers this week with our very own editor-in-chief, Andy Serwer. Andy, speaking to Box co-founder and CEO Aaron Levy about how the cloud computing business has fared during the pandemic. He's also talking about his thoughts on tech regulation. Take a listen.
We started our company on the premise that people wanted to be able to work from anywhere and be able to access information from anywhere. We obviously never would have imagined that a pandemic would actually drive the acceleration and ubiquitous sort of adoption of this type of technology. But That's sort of the environment that we've been in, where companies globally have been adopting video conferencing solutions, new communication platforms like Slack and others, as well as more modern ways to manage their digital content and digital information. So there's been a lot of growth in the business, especially in the enterprise segment. At the same time, of course, there's been challenges because you have small businesses that are dealing with a lot of difficulty in their businesses. You have some sectors of the economy that are harder hit and are dealing with the COVID crisis in unfortunately worse ways. So it's been a little bit of a mixed bag, but we have been able to grow pretty quickly with our enterprise customer base.
Oh, interesting. So I want to ask you about cyber security this year and how that threat has influenced the business, and how are you trying to mitigate that? How much is that something that you have to worry about every single day?
Yeah, so cyber is sort of core to what we do. We hold and we manage and we store some of the most sensitive data in the world, from everything from pharmaceutical companies that are working on a new drug and doing clinical research, all the way to banks that are collaborating with their most important clients, to media organizations that are working on film scripts and a new launch to a new film. So our platform has to be able to secure that information, and our companies, the companies that use Box, look to Box to be able to help them really stay secure in the digital age. So security is incredibly important to our strategy.
You guys went public in 2015, I believe, Aaron, and it's been a successful company, a trajectory, although profitability has been a little bit elusive. Talk to us about what you're doing to achieve that.
Yeah, well, fortunately, it's become less elusive over time. So, we did guide this year to double-digit percentage points in operating margin. That was a pretty significant change in our financial profile. We've guided to around 100 million in free cash flow this year. So we're definitely generating free cash flow in the business. We're growing pretty rapidly at our scale. We obviously want to grow even faster. We know that the market is quite significant and there's a lot of opportunity out there, but we want to make sure that we're both balancing growth and profitability as we continue to scale the company.
Let's talk a little bit about some IPOs right now, specifically Airbnb. I think you called their decision to go public recently the perfect market hedge. What did you mean by that?
Well, I think it's interesting because you have I think the market has sort of had this binary approach that there are companies that are either going to do well in COVID or be really impacted by COVID. So the kind of classic examples are, if you're a movie theater, that's a really difficult business to be in. If you're a traditional hotel operator, that's a really difficult business to be in. If you're an airline, that's a really tough business to be in. Conversely, if you're a completely digital company, or a company that is sort of digital but whose trends are accelerated in this environment, like Peloton, then you're going to do extremely well during COVID. And so you've seen the stock market actually have these trades where at the moment there's a vaccine announcement, the companies that have been really impacted by COVID negatively, their stocks go up, and actually the stay-at-home, work from home stocks tend to go down. The really interesting thing about Airbnb is it actually works in both of those environments. Airbnb has found a way to both be compelling for people that want to be able to work remotely, because so many people want to work remotely from new and unusual locations. Maybe they want to be able to go somewhere different for a couple of months. And so Airbnb has been seeing a ton of growth with a very different kind of use case. At the same time, if the vaccine comes out quickly and everybody feels comfortable traveling again, then the company will do very well because they're going to stand to gain a lot of that growth as the hospitality industry is able to reemerge. And so it's one of these stocks where almost no matter what the environment is, they're going to have a lot of great use cases for customers, whether it's because of travel and leisure, or if it's from working from home in a new Airbnb location.
Interesting there too. So big tech has gotten a lot bigger during COVID. Is that something that's good or bad?
I guess depends on if you're in big tech or a very happy customer of big tech. But I think in general, it was almost an inevitability that the leading technology platforms of our time we're only going to get bigger and bigger. Our lives are only becoming more dependent on digital technologies, whether those are social networks, whether those are the mobile devices we use, or the marketplaces that we purchase from, like e-commerce platforms, or cloud infrastructure from Amazon or Microsoft or Google. All of these underlying platforms were only going to get bigger over time. And what COVID did was sort of accelerated that adoption that maybe would have played out over a 5 or 10 year period into a matter of quarters or a 1 year time frame. But I don't think that acceleration is either good or bad. I think that it's going to cause us to ask questions about, how should we regulate these platforms in the digital age? We already knew that these were the most powerful platforms in our lives and in the economy. Now the question is, what type of regulation is going to be required to keep these companies in check, to make sure that we protect consumers, to make sure that there's fair and open competition within these ecosystems. And these are going to be really important questions, obviously, for the Biden administration, for Congress in the coming years. And it'll be really interesting to see, like, where do we actually end up in from a regulation standpoint. I think for the most part, we've sort of treated this as a kind of a one size fits all type of issue, where the conversation is, we break up big tech. I tend to think that that's probably not the right solution for a lot of the issues that we deal with. I think we actually just need modern regulation and modern forms of regulating the digital economy, whether that's in the form of again, marketplaces or social media. But I don't think the issue is necessarily just the size of these companies in terms of their market caps or their revenue. I think it's really the powerful position that they play in our daily lives today, and we need modern forms of regulation to ensure that these platforms are being used appropriately and being run, for the good of consumers.
Welcome back to Yahoo Finance Live. Let's focus in here on some movers today. The Wall Street Journal reporting that UPS is imposing limits on shipments from certain retailers like Gap and Nike, signaling that the strains on delivery networks could be intensifying here as online purchases continue to spike in the pandemic. For more on that, I want to get to Yahoo Finance's Ines Ferre, along with that and some more market moves to be watching today. Ines?
That's right, Zach. And that move by UPS is really to sort of meter the flow of packages during the season. And the limit applies to 6 retailers, as you mentioned, Nike being one of them, Macy's as well, according to the Wall Street Journal. Now, we reached out to UPS, and the company said it has specific capacity allocations throughout the holiday season. And it's also working with large retail customers to ensure they're aware of how much capacity is available to them. Just taking a look at the major averages right now on the Wi-Fi Interactive chart right now, we're looking at the Dow that's up about 150 points, and NASDAQ up about 0.5%. If we just look at some of the Dow movers, you can see Boeing up more than 7%. This is after Ryanair said it will increase its MAX aircraft order of the MAX jet by 75 units. This is seen as a strong endorsement of the MAX. And if you just take a look at a 6-month chart with Boeing, you can really see the movement here. You've got these last few months where the stock was just sort of trading sideways, and it really broke out in November when you had that positive news about the vaccine, and also positive headlines about the MAX and the ungrounding of the MAX. So if you look at a 1-month chart, you can see that the stock is up more than 50%, 56% over the last month. Zach?
Yeah, and as we saw yesterday, that first flight from Dallas to Oklahoma there, and the 737 MAX returning to the air. It's all anybody is talking about here, and clearly it's what investors are watching around the country as well. But Anesfer, I appreciate you bringing us that there. Check in with you later on in the show. We got much more coming your way here on Yahoo Finance Live, including another look at the big jobs report we're going to be getting tomorrow, what today's unemployment update might be hinting about expectations. Stay with us. We're right back after this. Welcome into Yahoo Finance Live. I'm Zach Guzman alongside Akiko Fujita. Want to reset the market action we're seeing play out here on Thursday after we got those initial claims here from the Department of Labor ticking down. In the latest clip here, down to 712,000 last week. That was down by about 75,000 claims. The Dow up by about 0.5% off that news, as well as other news out of Washington, D.C. that Senate Majority Leader Mitch McConnell says that a deal could be within reach, compromise potentially coming out of D.C. on those stimulus negotiations. Of course, President-elect Joe Biden has endorsed that $908 billion bipartisan proposal, and that news giving stocks a bit of a boost here. But of course, we're still watching the latest headlines coming through here day after day on the coronavirus front. Announced COVID fatalities topped 2,700 yesterday, by far the deadliest day yet in the country from the disease, and that comes as hospitalizations continue to set records across the country. So let's start there for what we should be expecting in the months to come as we approach the holiday season. Joining us now is Dr. Hiro Tipernini, emergency medicine physician in Arizona and former candidate for Congress in Arizona's 6th district as well. Dr. Tipernini, it's good to be chatting with you again today. I mean, the numbers are pretty dire here when we talk about hospital staffs being stretched, regardless of whatever community you want to focus in on here. What are your expectations in terms of battling this now and where we're at in this pandemic in the month of December?
Yeah, well, good to be with you, Zach. I certainly wish we were talking about a more positive topic. But that being said, yes, we are in. These are dire numbers that we are seeing. As you mentioned, the national death number was a record. We've also seen a record number of deaths here in Arizona as of this morning. The most recent number, we're almost up to 7,000. We had 82 just reported. And look, we have a vaccine coming, and so hope is on its way. But until then, it's really important that we all do what we can to continue to mitigate the spread, because the numbers are going up. There's no end in sight. And even once the vaccine is out, we have to remember it will take several months before it makes its way through even first administration throughout our population. And obviously, there's still a lot to learn about the immunity it confers and how it allows us to start moving back through our communities safely. So until then, it's so important that we continue to practice these mitigation efforts. Just yesterday here in Arizona, there were clinical leaders of all of our major hospital systems that wrote a letter to our governor asking to implement some new measures to be very clear about the situation we're in and that we are approaching hospital capacity. We will have to implement care crisis standards. And these are all worrisome times. And it's important that we all continue to be very vigilant.
And on that front, we've seen a number of state leaders adjust some of their decision making when you compare it to where things were back in the spring. Governor Cuomo here in New York, for example, saying it's not about the positivity rate anymore. It's about the capacity in the hospitals, and that should be guiding the restrictions moving forward. What are you seeing on the ground there? It feels like we're having these uncomfortable conversations again about who actually should be getting surgery, who should be getting care. Can you give us a little more insight on the conversations that are happening in Arizona?
Yeah, absolutely. I mean, look, you're right. Having capacity is one thing, but our goal really should be not to, consume all that capacity. It should be to keep people out of the hospital, to keep them well. Just because we have beds doesn't mean that we want folks to take up the ICU. We certainly don't always have staffing. Right now, Arizona's Department of Health has requested an additional 500 nurses to come to Arizona to help us with the care. So just having a bed does not mean that we have the capacity. And more importantly, it's really a critical issue that you bring up. We are putting elective procedures potentially on hold. It also, having these numbers in the hospital and in the emergency departments, a lot of times it deters other folks who are truly having other kinds of emergencies from seeking the medical care that they need. Sometimes they're staying home far too long with the illnesses that they have because they are ambivalent about going to the hospital with coronavirus being so prevalent. So there are widespread implications of these numbers rising and rising. We don't want to implement the crisis standards of care, which is what I was referring to earlier, that the clinical leaders of all major hospital systems here in Arizona have told our governor that if we do not see a quick and urgent and decisive action set of actions put into place, then we will have to implement those crises of care, which means we are talking about, potentially making choices, right, of who gets that ICU bed, who gets the ventilator, who gets the extreme interventions to prolong their life. That's something that no medical professional ever wants to have to make those kinds of choices, and we never want to see our hospitals go to that place. So it's imperative that we continue to be very vigilant and keep folks out of the hospital, keep them well. And these guidelines that have been proposed are very reasonable. We're talking about limiting gatherings to less than 25 people, making sure that we have no group athletic events. They're asking for a curfew as well at nighttime at 10 p.m., making sure there's no indoor dining, as well as things like wearing a mask in public, trying to stay home as much as possible, washing your hands, staying home if you're sick, and so forth. We have to do everything we can to mitigate the spread. We are at a very critical point right now all across this nation.
Yeah, and doctor, I mean, when we look ahead to the vaccine rollout, just looking across the pond, the UK, obviously the first country here to approve Pfizer's vaccine to start getting that rolled out. When we've heard from Boris Johnson, he's labeling it as challenging to get it out to the public. And I think here in the US, it'll be much of a similar story. But when you look at kind of demand right now on healthcare staff, I guess silver lining, you'd expect it to improve once we get past Christmas. Moving forward, the IHME model shows that deaths are expected to peak in January here. What are your expectations on maybe the stresses of getting the vaccine out and how it's going to need to be an effort beyond just hospital workers here, but also, I guess, local pharmacists potentially also being called in here? What do you see playing out as we try and get this vaccine out to the public?
Yeah, I mean, this is really one of the most massive coordinated efforts that our country will ever undertake. Whether it's about the manufacturing of the vaccine, of the supplies, of the syringes, the needles, distribution, but then also, as you're referencing, administration of these vaccines, and that takes. Excuse me, that takes personnel, that takes real coordination of understanding which populations are greatest at risk. We have to, yes, vaccinate our first responders, our essential workers, healthcare workers, but the administration of this and doing it in a very timely manner, this is a huge undertaking. It's going to require sort of all hands on deck approach. We need a strong supply chain. We need to make sure that we have a very comprehensive strategy that is fully outlined. And that's why it's so important that we are as, excuse me, clear on these instructions and this sort of roadmap as we can be, because this is going to require all additional personnel. It's going to be very critical that we get folks vaccinated in a very efficient manner. And also keeping track of folks and making sure that we know who's been vaccinated, who is due for, ultimately a second dose, and also monitoring the effects of this, because we have to remember this is a very new vaccine. This is still a novel virus we are still learning a lot about.
And doctor, I want to get back to a comment you made earlier about the state calling for 500 additional nurses. Where are you going to get those nurses from? Are these within state? I mean, we heard some of these stories early on in the pandemic, but at that time, the infections were largely limited to specific states. Now we're seeing an increase across the country. How confident are you that you have the staffing in place to be able to meet the demand?
Yeah, that's a great question, because we're not the only state, right, out there making requests for additional staff. And so, yes, there is sort of some level of competing with the needs of other states, which is all incredibly important as well. So this is not an easy ask. It is something that our Department of Health Services and our director of that department has asked for. And those are expected to be nurses that are not in Arizona already. So it is a question of whether that staffing request can be fulfilled, how efficiently it can be fulfilled. And remember, this isn't just nurses in general. There are different areas of care, right? There's critical care nurses. There might be nurses that we need more for other areas of the hospital because of the shortage and because of the, sort of revamping and sort of directing a lot of our current nurses, say emergency department nurses and so forth, to work more on these critical patients. So this is a challenge, absolutely, as you note, and we are, in the most crude terms, I guess, in competition with other states. Everybody across this nation is looking for additional staffing and resources. This will not be an easy, a request to fill, and we will see how it pans out over the next several weeks.
And hopefully it does improve, but we shall see. We'll be watching it closely. Dr. Hero Tipernini, appreciate you taking the time to chat today.
Thanks so much for having me, Zach. Take care.
I want to shift over back to the market action we're seeing today after we got the update from the Department of Labor. Despite, as we were just talking about, some renewed measures to lock down across the country, initial jobless claims came in better than what we've seen a few weeks ago, falling 75,000 to 712,000. Of course, we're going to get the update in terms of the November jobs report tomorrow morning. But joining us now to break down what we should be expecting on that front, as well as where we go from here into 2021, is our next guest here, Alex Perret, is market strategist and advisor at 930am.com. And Alex, thanks for coming on to talk to us today. Just your initial reaction to what we saw there in the headline number dropping in terms of initial claims, and what your expectations are when we get that jobs report. Economists there expecting 475,000 jobs to be added for the month. Where are you seeing it coming?
Thanks, Zach, for having me. I think that's a great point. What we're seeing now, obviously, is great news, right? It's important news, and it's a great trajectory for the economy and for the market. And we've had the really good news from the vaccine makers, Pfizer, Moderna, AstraZeneca. We had some more news yesterday with Pfizer now being accepted, if you will, in the UK. So it's a great step in the right direction. And now we're getting better than expected, really, unemployment numbers with, as you mentioned, first-time claims are down about 10% from last week. We're also seeing continuing claims fall sharply. And overall, total claims are now at one of the lowest points since the beginning of the pandemic. So, much of this information was priced into the market, but you're still seeing sort of this upside surprise in the markets today. And I think this is really sort of looking at a beginning to what I like to call maybe not a rotation, but more of an expansion of the sectors and the areas of the market that are actually starting to perform very well this year.
Although, Alex, I guess there's an argument to be made that some of those numbers are dropping because those benefits have expired in some of these states. And so I'm curious how you look at all of this in the context of these stimulus discussions that are happening right now. We heard from Senate Majority Leader Mitch McConnell earlier today. He seemed hopeful that some kind of deal could be reached by the end of this year. Feels like we've heard that before. But how big of a catalyst do you think a deal is likely to be for the markets? Does it really matter if the number is not that high?
Yeah, I think you make a great point, right? And so the pandemic unemployment assistance program set to expire at the end of the year is a very important component for the economy to keep to continue over the next sort of 6 to 12 months, right? And that protects obviously certain employees that are, or certain contractors that are not covered by the employee unemployment programs. That's very important for almost 300,000 folks, and so that's a very big component of it. You're also seeing an additional kind of stimulus, if you will, in the form of a bonus that could be added to those unemployment benefits. That's pent up supply, if you will, that can be spent into the economy, that can add jobs, that can help protect jobs, and that can help really consumer sentiment. And consumer sentiment up until the pandemic was one of the biggest component of GDP. That the consumer has shown up and has come back in force in many ways because of the additional stimulus that we've had in the economy. Those are typically individuals that are spending 100% of their paychecks. They tend to get the economy to move along much more quickly. And so we really need to have this kind of stimulus continued in order for the economy to continue to recover. I think there's going to be some concerns, at least transient concerns, if we don't get something done before the end of the year until the inauguration on the 20th. And so that could lead to a pretty sharp kind of drawdown environment, I think, for the market, that any kind of negative news at this point could be seen as a catalyst for a pullback. So I think we need to see the stimulus. The number, I think you're making a great point, does not need to be necessarily that 908 billion. It can be something that's lower, but obviously we would need some sort of stimulus to bridge that gap until the inauguration. 20 days can be a very long time in the midst of this kind of pandemic that we're in, and those new numbers that we're starting to see.
No, and in 2020, 20 days seems like an eternity based on what we've seen play out this year. But Alex Perret, market strategist and advisor at 930am.com. Thanks for coming on to chat here. Want to get to some breaking news that we're getting out of Washington, D.C. here. On that front, we've been watching some of President Trump's picks to the Fed, and we've obviously covered how Judy Shelton's gone here with that one not going the way that he wanted to see. But breaking news as his other nominee, Christopher Waller, winning approval from the U.S. Senate just a few moments ago here. And the latest on that, I want to get to Yahoo Finance's Jared Blickery, who joins us now. Jared?
That's right. The vote came down 48 to 47, so it was pretty close, largely on party lines here. And this is Trump's fourth pick that has made it into the Federal Reserve. Now, Christopher Waller is currently Director of Research at the St. Louis Fed, and he has been a mentor to James Bullard and is responsible, it's said, for Bullard's view on inflation. And so you could characterize Waller as another dove. And so that's going to influence the decision-making at the Fed. And you also made allusions to Judy Shelton. That nomination was just about killed a few weeks ago when a couple members of the Republican Senate came down with COVID, and then Kamala Harris drove into town at the last minute, nixed the vote. So she's probably out. There's still procedurally some possibility that she would be the fifth in line for the Fed under Trump's regime. And pretty interesting because she was considered a possible replacement for Jerome Powell should Trump have remained president, which of course he's not. So kind of a moot point there. But again, fourth pick for the Fed by President Trump here. And Christopher Waller will ascend to that position probably in January.
Okay, yeah, Jared giving us an update there on that vote. We are off for a quick break, but coming up, a remote workplace with a view. Hawaii launching a new program to attract a new type of workforce as the state economy takes a big hit from the pandemic. We'll explain on the other side. Hawaii's economy has taken a big hit all as a result of this pandemic. Unemployment in the state soaring to 7.1% there. The state is now working with the private sector to launch a new program to attract more workers to the state, dubbed Movers and Shakas. The program is offering the first 50 applicants a free round trip ticket to Hawaii. It sounds like a pretty good incentive there. Let's bring in Jason Higa. He's the CEO of FCH Enterprises and the campaign leader for Movers and Shakers. Jason, it's great to have you on today. You know, a lot of people are going to hear this and just jump at it and say, I'm all on board if there's a free ticket to Hawaii. What type of workers are you looking to attract here? And how does all of this lead to a bump for the state's economy?
Right, Akiko, it's not just a matter of anyone being qualified for this program. We want to be very intentional about the type of person that we do attract. So there's what we call a give and get component of this program. We are asking those that will be chosen to really give back to the local community. And what we're asking is that they provide 3 to 5 hours per week to local nonprofits. And really, we're going to match their skill sets with the needs of the local nonprofits and really create a means of them to give back to the local community. But we're also hoping that in that process, they're going to learn about our culture, about our community. And really, I think at the end of the day, we're hoping that it's not about the ticket. It's about the ability to learn about our culture, our people in a very unique way.
Yeah, and it's a unique way, and it's a unique program here too. But Jason, talk to me about what the reception of the program has been on a local level. You know, since I'm sure there's concerns about what could happen with rents or you know, home prices there on the island. What have you seen in terms of that reaction?
Right, there has been an initial reaction, concern about housing, but we're talking about 50 people. Part of the incentive is that the hotel groups are offering very attractive rates for the cohorts that will be coming over, and we're hopeful that they will take advantage of these very reduced hotel rates. So it's not going to affect the local housing market.
Jason, no question, you know, those hotels, anybody that's involved in the tourism businesses, which is really at the center of the Hawaii's economy, looking to get any kind of bump at this time. You have now, I think we're now about a month into flights being resumed to the state. I know you took an initial hit on tourism, not just from the U.S., but from Asia as well. What kind of pickup have you seen as a result of these flights resuming, and how much more do you think needs to come?
Yes, you know, the return of the 7-day visitor has been less than what we had hoped and expected in Hawaii. And really the recovery of the 7-day visitor market is going to take what we estimate to be 4 to 5 years to truly recover to former levels. So this remote worker program is not just a short-term endeavor. We're really hoping that this could be a supplement to the 7-day visitor. You know, having a 6-month temporary resident come to our islands, be ingrained in the culture, give back to the community, while they're earning, you know, their paycheck from a mainland company. And one of the aspects of this program is really bringing back former residents, what we call kama'aina. You know, we have many kids that are working for in Seattle, in the Bay Area, in LA for tech companies, and for the first time, they have the ability to come home, to reunite with their families, continue to work for their mainland employer, but to possibly even raise their families in Hawaii. And that's always been a strong desire for many of our kama'aina, but unfortunately, they you know, have had to leave our islands for the job opportunities that are not available here, but are available on other parts of the mainland. So this is just a unique opportunity that we're hoping could be a long-term change for many of our local kids.
Yeah, I assume the interest is going to be there anytime there's an opportunity to get a free flight out to Hawaii. It's a lovely place. Keep us posted on what progress you see there. But FCH Enterprises CEO and Movers and Shakers campaign leader, Jason Higa, appreciate you taking the time to chat.
Thanks for having me.
We're going to take a quick break here on Yahoo Finance Live, but when we return, digging into the booming gaming sector, video games becoming increasingly popular here in 2020, the size of the economy tied to that sector and what growth we've seen. We'll chat that on the other side of the break. Stay with us. Welcome back to Yahoo Finance Live. We are, of course, in December with the holidays fast approaching, perhaps an important time to remind us all about the holiday shopping scams that might be out there and tips to avoid falling victim to those. I want to bring on Yahoo Finance's Dan Halley with a focus on that in this week's tech support. Halley?
That's right, Zach. The holiday season is here, and it's going to be a little different for a lot of the traditions that we have. But scammers, as you said, will still be active, giving up their usual tradition of taking our money. So there's a few things you can do to avoid them, though. And I think one of the most important is whether you're buying online, which a lot of us are doing this time of year, or shopping in brick and mortar stores, you're going to want to avoid paying with your debit card. Pay with your credit card. It is absolutely one of the safest ways to make payments. And that's simply because if you use your debit card, someone can skim that. Then when they skim that, they can just start deducting money directly from your checking account. If you also have overdraft protection connected to your savings account, they can drain both of those. So don't pay with your debit card. You might get the money back, obviously, from the bank, but it's going to take you a few days. You'll be left high and dry without that cash. Use your credit card instead, because, of course, that money isn't yours. It's the credit card company's. And if you do, as an added layer of protection, use your smartphone's contactless payment software, whether that's Apple Pay, Google Pay, or Samsung Pay. That's even more secure because it has a unique identifier for each transaction. Nobody can skim that. Outside of that, avoid buying things through social media or email ads. And that's just because a lot of times you'll see these ads that seem like they're offering great deals, but in reality, they could simply be malware or ransomware in disguise. So if you see a link on social media, avoid that. If you see an email that you get where it's saying, $50,000 for a Ferrari, that's probably not correct. But avoid that. If it's a website that's saying that it's advertising these deals, go directly to that website. Make sure that it's on the up and up, and then do your shopping through there. Outside of that, there's also delivery scams. This is something that happens anytime you start to see a number of people using delivery services. Obviously, throughout the pandemic, that's been an issue. And what these do is they'll have people send out emails claiming to be from Amazon or FedEx or UPS or USPS and saying that your delivery hasn't been made or your package has been lost, click on this link and update your information, or click on this link to go to a website to input more information. All that's doing is either, if you're clicking on the link, injecting your computer with malware, or if you go to that website and you enter your information, just straight up stealing your information because you're basically giving it to them. So if you do see issues like that in an email, ignore them. Go to the website through which your product is being delivered, or you made the purchase in the first place. That's where you'll be able to get something more concrete. And then my last two tips are, if you're giving to charities this time of year, it's going to be something that a lot of people are doing. Make sure that the charity is on the up and up. You might get phone calls soliciting different charitable donations. You don't know if those are always accurate. Tell the person on the other end of the line you'll give online. And then you can use something like Charity Watch. Basically, that's a service that ensures that the charities are actually charities and not some kind of scam. And then finally, if you see an ad out there giving you an idea of a product that's just too good to be true, an iPhone 12 for $100, and it's not through a carrier or something like that, ignore it. Something that's too good to be true is too good to be true, and you're just going to get scammed. In the meantime, happy shopping.
Yeah, happy shopping as long as you can avoid all of those things, but appreciate you walking it through it. And it's important because it is going to be a busier online shopping season. As we know, we tend to see more opportunities to get scammed as these things shift online. But Howley, stay with us here because we are talking another one of your fortes here in gaming, no doubt, but potentially one of those gifts that's going to be given a lot this year. The sector overall has seen a boost with stay-at-home orders giving more and more people time at home to play video games. But a new report looking at the industry overall shows that growth was well underway even before the pandemic hit. Joining us now for more on that is Stanley Pierre-Louis, CEO of the Entertainment Software Association, which includes members like Sony and Take-Two. And Stanley, I mean, people might not realize it, but from developers to the hardware to streaming now even, you say gaming has become a more than $90 billion industry in the US. So talk to me about where that growth is coming from.
Well, right now, 1 in 3 people on the planet are playing video games, and that's 214 million people in the US. So we've seen a tremendous amount of growth. But what we've also seen is that people are playing together more. What they love is they love the games, they love the innovations, they love playing games together. We wanted to take a look to see what does that mean in terms of economic impact. And what we found was that we have a multiplier effect. So although our industry generated about $43 billion in 2019, we actually had a larger impact of about $90 billion. And when we create jobs in our industry, and it's at about 143,000 right now, again, all those who support that ecosystem count out to about 428,000 jobs, 428,000 jobs. And so those jobs, by the way, that are created in our industry have a family sustaining wage of about $121,000 each, which is more than double the national average. So we find that our industry has really blossomed because players love the games and love playing together, but we also have a positive effect all around us on other industries.
Stanley, this is Dan. I want to ask, when you look at the industry and how it's really kind of prospered throughout the pandemic, and obviously, as Zach had pointed out, it's been on the upswing for some time now. I guess, is there any fear among the industry titans that there will be a pullback once the pandemic is over and we can go back to normal? I mean, look, I play video games all the time, regardless of whether or not there's lockdown orders, but a lot of people may have just gotten in. Maybe they're subscribed to something like Game Pass, which is a great deal for Microsoft, or they picked up the Switch because it's got more casual games on there. Where do you see the end of the pandemic going as far as the game industry is concerned?
Well, a lot of companies really did see a surge during COVID-19. And that's in part because being alone at home can feel isolating. And being able to play those games gave people something to look forward to. But more importantly, it allowed people to connect and play together. Right now, about 65% of Americans play games with other people. They play together, particularly online. And so it provided a social connection. And that really helped fuel the growth, even beyond what we've seen in the previous 5 and 10 years. So we anticipate a lot of growth. Now, this year was a surge. It was a much different year. But I still think it portends for a good year next year when we're talking about people really being sometimes reintroduced to games. If you started off playing Atari or in television as a kid and then came back to it during the pandemic, you saw a huge difference in the kinds of games, in the graphics, in the sound, and in the storylines. And so I think a lot of gamers are going to stick around and play games. And even if it's not at the levels of 2020, it's still going to be a lot of growth and a lot of excitement and still connection for people.
I'm not sure if Dan is frozen there. Stanley, I'm going to jump in here. You were talking about the $90 billion in economic output. How much of that do you think comes from esports? You know, even before the pandemic, we saw these huge gatherings, of course, with massive amounts of prize money. This has really become just like any other sports event. What do you think? What do you see in terms of the growth rate there?
Well, the growth in esports has been one of these great gems in our industry. It's really grown because people love playing together and they love playing competitively. So you've seen the growth of teams and leagues, and it's really an equalizer in many ways because people of any ability can play games. They can play the games that they're seeing others play, but they're also seeing it played at the highest levels, and they can really relate to that. So that's going to really fuel it. And you have even young kids getting into college playing esports for their colleges. And so there are opportunities to grow into the sport, into the professional ranks through college in a more traditional way. So more and more we're seeing that esports is another vehicle in it on the top of all the STEM related fields and all the artistic fields that have been fueling our game. Now esports is a way to really showcase what the games are all about.
Stanley, sorry about that. I want to ask about the PlayStation 5 and the Xbox Series X. You know, their launches have been absolutely massive, but there's also been problems with supply. I think some of the issues have come from bots that are kind of going through different retailers' websites and able to suck up all the units that are available when regular consumers are kind of left high and dry. And then they have these kind of scalping sessions where, you know, a $499 console is going for $1,500. I guess, is the industry doing anything to try to put a stop to this kind of practice? I know it's been an issue with NVIDIA and their graphics chips in the past as well. Do you know if the big players are trying to step up and ensure that something like this doesn't happen around the major releases of games and things along those lines?
Well, certainly we've seen a tremendous growth in games and tremendous demand for the newest consoles. And that includes the Nintendo Switch, which has been around longer, but still sees a lot of growth and growth potential. So I think more and more you're going to see more games produced and more consoles produced so that they can get more to consumers. Ultimately, it's about getting them out and providing more of that product to meet the demand. And certainly we're looking to make sure that consumers have the best and safest experience in buying these new consoles. But I think it's going to be exciting to see how much these not only satisfy consumer demand, but enhance the playing experience for consumers.
Stanley Pierre-Louis, he's the Entertainment Software Association CEO. It's good to talk to you today.
Thank you.
Coming up, we are talking about Bitcoin. Lawmakers introducing a new bill on the Hill to propose regulation for stablecoin issuers. We'll be joined by Jesse Powell, the CEO of Kraken, on the other side of the break. The price of Bitcoin hovering below that record it hit on Monday, but we are seeing some gains today on partially some news coming out of Washington on Wednesday. A group of Democratic lawmakers introducing a new bill requiring stablecoin issuers to obtain a banking charter and approval from the Federal Reserve. Let's bring in Jesse Powell. He is a co-founder and CEO of Kraken, joining us from Los Angeles today. Jesse, it's great to talk to you. It feels like every conversation we have about Bitcoin these days is about how more and more it's becoming institutional, with a lot more institutional investors coming in. We've heard about the PayPal Square effect as well. This latest bill coming through in Congress, and we should point out it's just a proposal. Is that a positive, do you think, for the space? Of course, it sounds like the purists would say, well, no, regulation is not warranted here.
Right. I think that, this is another case of maybe regulators overstepping, and it looks like this bill doesn't have legs. So hopefully it won't be passed. But, ultimately what we want in crypto is financial inclusion. We want access. And this bill seems like it would be reducing access for consumers. And I think it's really unnecessary, overly broad. And I think we can get by without it. And there's not a need to sort of introduce additional barriers toward people participating in the crypto economy.
Yeah, and Jesse, let's talk about the enthusiasm that we've seen playing out here as Bitcoin was kind of flirting with those all-time highs here, approaching that $20,000 level. I mean, when you see accounts on your platform on Kraken, what kind of enthusiasm, what kind of new user is coming around this time, maybe relative to the last time we were trading around these levels?
Yeah, last time the rally was heavily retail driven. This time we're seeing a lot more institutional interest, and I think that that's coming from just getting to be more acceptable because you have people sticking their neck out like Michael Saylor, Paul Tudor Jones, Square. You have large institutions, publicly traded companies buying tens or hundreds of millions of dollars of Bitcoin. And I think the question this time around is more about, how can you justify to your portfolio, to your investors, not having a position in Bitcoin?
And Jesse, it feels like when we go back to 2017, the conversation was about whether Bitcoin is gold 2.0. You've said that there were some calls that it warranted $500,000 price tag. You think it's much higher than that. What do you think is the price that justifies Bitcoin?
Well, I think we're going to continue to go up and to the right for a while. It doesn't seem like the money printing is going to stop anytime soon. I think we're going to see a lot more printing, a lot more businesses closing over the next 6 to 12 months because of the COVID response. So I think you're going to see more bailout checks, more stimulus. And I think that is going to cause more countries to stop using the dollar, more people to stop looking at the dollar as a store of value, more people to move their money from savings into a safe haven asset like Bitcoin.
We talk about it, Bitcoin, so much here, but for the real crypto enthusiasts out there, a lot of attention's been being paid to a lot of the DeFi projects around Ethereum and smart contracts there. Kraken's donated, $500,000 to some of these projects that we've seen pop up. What do you think right now is different, too, as we've moved so far in terms of projects working on those smart contracts using the Ethereum blockchain here? What's different this time around when you look at that kind of space?
So there's a lot more innovation happening. The technology has come a long way. Part of what's really interesting about this space is that it moves so quickly, and there are things happening, now that just were not imaginable a few years ago. And I think slowly we're starting to see the components of the traditional financial system and these middlemen be replaced by smart contracts, by computer code, which is completely reliable, completely auditable, fully transparent, and through that, you have much less counterparty risk. You have less risk that someone is able to steal your money in the process of facilitating your transaction. So I think DeFi is really the way of the future. We're investing in that. And, it's still very early days. There's still some risks. I want to be clear about that. But this is definitely the way of the future.
And Jesse, too, just listening to kind of your explanation on where Bitcoin's price goes, obviously a lot of attention being paid to, spending right now, inflation. Of course, it's kind of where Bitcoin came from. But when we talk about the other side of it, payments catching a lot of intrigue whether you look at PayPal's crypto efforts, Visa's PayPal efforts. Do you think that there's a little bit of a strange kind of double seeing both of these work as Bitcoin looking at as a store of value, but also as payments? How do those work together? And do you think that maybe we've moved on from it maybe being more important in the payment side versus the store of value side?
Yeah, I see Bitcoin today as largely a store of value. Of course, it's still fantastic as a payment method if you're sending larger amounts of money. If you're just buying a coffee, it's a bit cost prohibitive because of the transaction fees, but you can still send a $10 million Bitcoin transfer on Saturday at midnight, and you can't do that with a bank. So it's definitely solving some use cases for payment transfers. In terms of store of value, I think we will see kind of second layer solutions or off-chain payments be used with Bitcoin, where that's Bitcoin that exists in your PayPal account or in your Kraken account, and that can be moved between different user accounts without actually using the blockchain itself. And then, of course, you can always withdraw your coins back to your own wallet, back to the blockchain if you need to. But that dramatically reduces the cost of sending transactions, and you can still have it as a store of value.
All right, we'll see what happens there. Clearly a very exciting time in the crypto space as you're talking about all these projects moving forward. The CEO and co-founder of Kraken, Jesse Powell, thanks again for joining us.
Thanks for having me.
We're going to take another quick break here on Yahoo Finance Live, but when we return, focusing in on the pop we're seeing play out over at Boeing as the 737 MAX returns to air, giving a big boost to the Dow here, up 172 points as we head to break. Stay with us. We'll be right back. Welcome back to Yahoo Finance Live. I want to spotlight the market action we're seeing play out right now in Boeing shares trading near session highs, up by about 7% today after that company is seeing a big boost with the return of the Boeing 737 MAX to the air. We saw that flight yesterday from Dallas to Oklahoma there, and Boeing shares on the move. For more on that, I want to get to Yahoo Finance's chartmaster, Jared Blickery, with the latest. Jared?
Well, we got news on several fronts here. First of all, American Airlines is returning the 737 MAX to the sky. They're going to be the first ones to do it, and they're trotting it out with a big media event, kind of showcasing the pilots and also letting customers view the plane at airports, presumably to make people a little bit more comfortable with the airplane, given everything that's going on here. But also, Ryanair is adding to an existing 737 MAX purchase. They're going to be buying 75 more. They are Europe's most profitable, or at least best run airline by a number of measures. And this would be an additional $9.4 billion for Boeing, less discounts, and there are always discounts, but largely analysts are saying this is a seal of approval. And pretty good news, Dave Calhoun, he's saying in a statement, Ryanair is once again placing confidence in Boeing 737 family and building their future fleet with this enlarged firm order. And we're also seeing some other news in the airline realm. So let's take a look at our travel sector heat map here. We got Southwest up 3%. We got Delta up 5%, saying it's going to return to break even by next year, early next year. Also, Carnival Cruise Lines, for that matter, in the travel industry, up 8%. So the sector as a whole really getting a boost here, guys.
All right, Jared, bringing us the latest on that front. Appreciate that. Let's shift our focus over to a space that has brought perhaps a lot of our viewers out there some enjoyment this year. We're talking podcasts and streaming here. Interesting news yesterday, broken here by the Wall Street Journal, in Amazon entering exclusive talks to purchase the podcast startup Wondery there, potentially at a value of over $300 million. Akiko, I mean, there's a lot of interest in podcasts. I know you like podcasts, me not so much, but this is clearly a space of growth for a lot of these streaming giants out there, or companies like Amazon looking to up their game in that space.
Yeah, I mean, Amazon, you could argue, is jumping in a little late. Apple, of course, have been offering these podcasts for free. We've also got Spotify pouring millions into this space, signing big names like Joe Rogan. And I think that the price tag here that Wall Street Journal is reporting that Amazon's willing to pay speaks to the huge growth and the potential they see in this market. Wondery valued at $100 million in its last funding round. The Wall Street Journal reporting Amazon is valuing the company at $300 million. So that's quite a premium there. U.S. ad revenue for podcasts up 48% to $708 million. And it feels like this is a space that on some days feels at a saturation point. There are so many different podcasts out there, but you look through the numbers here, ad revenue expected to exceed $1 billion by 2021. So there's still a lot of runway. What I think is kind of interesting is how we've seen this space turn. So we've talked about the big names like the Joe Rogans out there who have the daily shows, but also we've seen, documentaries on podcasts. We've seen so many different areas, and a company like Endeavor, for example, getting in, I think last year, a few years ago. And so this is really seen as premium content right now. It's not just about just setting up your audio and talking for 30 minutes. I mean, these are really highly produced products that are just taking off in a big way.
Yeah, I think podcasts in general have come a long way since the days of just everyone kind of setting up a microphone in their garage. But you're absolutely right. I mean, we saw earlier this year Spotify buying Gimlet, of course, a major player in the podcast space, more than $200 million, the purchase price on that one deal in 2019. I don't know. I mean, they don't do it for me per se. Maybe perhaps because I'm more of a visual person or learner out there. And I mean, we saw, I guess, how much buzz was created by Serial, podcasts that had been focused on crime, whodunit, kind of these focused areas. But you're right, it's expanded far beyond that. I don't know. I guess this is a trend that's continuing here, and a lot of people are watching it, despite the fact that we aren't commuting as much as well. And I think that is something we should point out here as well. If you have that strength coming in a spot where you would think podcasts would actually be weaker since we aren't commuting, perhaps it does deserve a round of applause in the podcast space. Perhaps you're onto something, Akiko. I'll follow your lead here in giving them another look. That'll do it for us here in the 11 to 1 hours here on Yahoo Finance Live. For Akiko and myself, want to tell you to keep it here on Yahoo Finance Live, as we got much more coming your way as the Dow trades higher by more than 0.5% today. Thanks everyone for watching. Stay tuned. We'll be right back after this.
Welcome to the 1 p.m. hour of Yahoo Finance Live, checking market action right now. Markets are in the green right across the board right now. The Dow right now up over 180 points, up about 0.6 of a percentage point, boosted by Boeing. That's one of the Dow's biggest components, with the NASDAQ hitting fresh record highs today. The NASDAQ up right now about 0.5 of a percentage point, a level of 12,403 right now. Markets are being pushed upwards by fresh optimism over stimulus. Senate Majority Leader Mitch McConnell saying that he hopes a compromise is going to be reached before the new year. We also have some good news, and this is also helping markets on the jobs front. The initial jobless claims for the week ending November 28th were 712,000. That is better than the 775,000 jobless claims that were expected for that week. Continuing claims fell below that 6 million mark. We now have 5.552 million people continuing to file for unemployment benefits. That is compared to 5.8 million that had been expected. So a bit of a bright spot here when it comes to the labor market, and a good sign before we get tomorrow's jobs report. Taking a look over at some stocks, I mentioned Boeing up right now about 7 8/10 of a percentage point. They're getting a bump today after Ryanair said that it would be purchasing some of their 737 MAX jets. Want to take a look now over at some of the travel stocks that we have been tracking. We're seeing some of the cruise lines all in the green right now. Norwegian up 9%, Carnival up 9%. Taking a look over at some of the airlines, we are seeing Delta up over 6%, United up 7 8/10 of a percentage point, and American Airlines doing incredibly well today, up 10 3/10 of a percentage point right now. We've been seeing as vaccine optimism really abounds throughout this market, investors continue to pour into that sector. Turning now over to Tesla, as you can see right now on the screen, up over 4%. They've been getting a boost after Goldman Sachs actually gave that stock a bit of an upgrade to a buy rating, up right now 4 2/10 of a percentage point. On a sector basis right now, we are seeing energy, industrials, and real estate all in the green, and energy right now is leading the way, up over 2% right now. Utilities is the laggard on the day, down roughly 9/10 of a percentage point. I want to start the show, however, on the coronavirus pandemic. There's now more than 13.9 million cases of coronavirus in the country. So we're definitely going to be hitting more than 14 million positive cases in just a day or so. And the death toll has now risen to roughly 274,000 people. This is all according to the tracker at Johns Hopkins University. Now, this is a huge leap in the number of case totals. If you guys remember, just yesterday, we were hovering around 13.7 million, a little bit under 13.7 million. So this means that for the first time, the United States has hit a case count of 200,000 positive cases of the virus. That is in just one day. Hospitalizations are also soaring. 100,000 people were hospitalized with the virus just yesterday. So this is some very tragic and very sobering records that we have been hitting when it comes to this pandemic. I want to dive more into this. Now we're joined by Suzanne Judd, an epidemiologist at the University of Alabama at Birmingham School of Public Health. Dr. Judd, thank you so much for joining us today. I want to start, given those statistics, with what CDC Director Robert Redfield said. The next 3 months are going to be, and I'm quoting him here, the most difficult in public health. I'm wondering for you, you're an epidemiologist, you work in public health, this is your area of expertise. What does that mean exactly? And why will the next 3 months be so difficult and so deadly?
So we're used to this in public health. It's always a dark time in terms of infectious diseases. People are getting together for the holidays. They're indoors. They are coming in contact with lots of different folks. Kids are getting out of school and going to see grandparents. So this is a normal time that you would see a rise in things like stomach bugs, the cold, flu. But this disease is so different, and we know that. So it's very scary that we already see such high circulating numbers in November. And we know we're going into a time when it's going to be even higher. So that's one of the reasons you keep hearing public health people raise the alarm and say, this is serious, this is going to get worse. Our hospitals are already full. This is going to force our healthcare workers to have to make really difficult decisions about who gets hospitalized, who goes to a different type of care. And it's just going to be very difficult for the public health and hospital systems.
Now, another update from the CDC is also that they're forecasting, I want to get the numbers right here, up to nearly 20,000 deaths the week of Christmas from coronavirus, roughly 9,500 up to 20,000 for that week. I'm wondering if when you hear numbers like that, do you view that as a peak, or do you think it could actually even get worse beyond that?
My guess is it could get worse beyond that. Again, people are going to start getting together that week, those last few weeks of December. They're going to get together for the new year, and they're going to think they're safe. And so cases, we'd expect them to rise in January beyond where they are right now, which means that deaths will rise beyond where they are in December. Actually, I think the peak deaths will occur closer to February or March.
You know, a lot of folks have been doing quarantining. They've been doing tests to get out of quarantine here in New York. In order to leave a quarantine, you have to test negative 4 days after you arrive into the state after previously showing a negative test. And, you know, myself and a lot of the producers were chatting about it a little bit earlier, and it seemed as if perhaps some of these, testing day numbers are a little bit arbitrary, or that there's a lot of wiggle room really for people to kind of slip through these cracks and still actually be positive, even though they've tested on certain days and therefore are appearing negative. Do you see these kind of testing days as arbitrary? Is there a science behind it? Or are you seeing as well that there's a lot of problems with the way we've been approaching testing and receiving negative test results, people thinking they're negative when in reality they're not?
Yeah, you and your producers are spot on. It's not that it's arbitrary. There is data behind it, but you remember from high school math, if you're looking at an average, which is what we use, that means there are a lot of people that are either above or below the average. It may take them longer to become symptomatic, or they may not develop symptoms at all. So we go with what works for the bulk of the population, and generally in public health, that keeps people safe. That's why we don't need everyone to get vaccinated, because if the bulk of people get vaccinated, then everybody else stays safe. But like you said, that does mean it's possible for a few people to fall through the cracks. But again, our hope is if we can keep 80% of the population safe, we can manage cases in the other 20%.
Well, it seems as if they're surging all around the country. So I'm not entirely sure how well we are doing on that front. To that point, Los Angeles Mayor Garcetti said that the city was nearing its tipping point, ordering people to stay home. I'm wondering, from your perspective, how hard is it to fight the spread when big urban centers like Los Angeles are on a knife's edge? And really, tipping into what, really? When we say a tipping point, he said tipping point. I'm wondering, when you hear that, what does that mean? What does it mean when you tip over? If this is where we are now, 200,000 cases, 100,000 hospitalizations, almost up to 20,000 deaths we're looking at for the week of Christmas. Well, then what's on the other side of that? If this is before we've tipped over.
It's what we saw in Italy back in the spring, back in February and March. It's people going to the hospital and being unable to be admitted. That's the tipping point. And a lot of Americans have a hard time imagining that, because they think of themselves getting sick and being at home, and they can't even picture what it would be like to go to a hospital and have that hospital say, "I'm sorry, we're full and you're not sick enough to be admitted." That's what the tipping point looks like. It looks like hospitals that cannot admit people that need to be admitted.
So, Dr. Judd, you're kind of hinting at this like doomsday scenario. I feel like we were talking about a lot back in March, back in April, back in May, where folks were saying, doctors are now going to have to decide who, quote unquote, lives and dies. The hospitals are going to have to, and you're kind of mentioning this, right? That people are going to the hospital and they might be told, listen, you're not sick enough and we just don't have any room for you. Do you think that some of those headlines, that we had been seeing, those fearful headlines back in March, might actually become realities in December, realities in January?
It's very possible. That's why cities like Los Angeles are saying they're on the knife's edge, because they are getting very close to that point that if they see a surge in cases, they can't manage all of those cases with the hospitals. And it's not just the hospitals, it's doctors and nurses and the people that clean the hospitals. There's so many people that are needed to keep a hospital running. And if it's full at capacity, they're not able to do everything they need to do. So yes, it's definitely, I don't know about doomsday. I think that's a bit much, but it certainly gets into that situation where people have to make uncomfortable decisions that we don't like.
I'm wondering, given that you work in public health and that kind of involves the public participating, obviously, with doctors, with epidemiologists like yourself to really all be in this together to fight something like a pandemic. I'm wondering what you make of this disconnect that we seem to be having, where on the one hand, we keep repeatedly saying, I keep repeatedly saying how many case counts we have, how many death counts we have. And yet, on the other hand, it seems as if you were to walk out on the street, you might not even know sometimes that a really deadly pandemic is going on. What do you make of that disconnect? And how do public health officials and public health researchers and folks that are working in this field navigate that?
It's really challenging when you've got an invisible threat like a virus, and say 1 in 100 people have it and are actively fighting it. The likelihood that you actually know somebody that has it and is fighting it is low. So people have, for the last 9 months, been going around living their lives. They say, oh, if this hasn't impacted me, I must be fine. I'm going to go back to my normal life. So we've been trying to actively combat that with messaging that's more simple, I would say. CDC has done a really good job at revising some of their guidelines so they make sense to people and trying to be a partner with the public. But you're right. Right now, it's really challenging to communicate to the public in general, especially because this disease has become politicized, which is very normal for public health diseases. HIV was highly politicized in the 80s. But it's a huge challenge, and we have to rely on our psychology colleagues and our health behavior colleagues to help us develop messages that explain what's going on and why, even though you may not know somebody that has gotten COVID and been very sick, it doesn't mean that you still yourself couldn't get sick or someone else couldn't get sick. Those are the messages we have to continue to repeat to people over and over again and let them know, wear a mask, stay 6 feet apart. Don't go places where you're eating because your mask is going to come off. So try not to eat in public in large gatherings. Those are the kind of messages we have to continue to repeat over and over again.
I only have about a minute left here with you, but this has been a pretty, I think, sobering conversation. So I'm going to try to inject a little bit of optimism here to at least end on, Dr. Judd. So we obviously have this vaccine coming out, and there is that pretty glib phrase, however, it's always darkest before the dawn. I'm wondering if you do see the light at the end of this tunnel, if you do think that this might be the last final painful push through before sunny skies up ahead, we have the vaccine and we can really put this behind us.
Without a doubt. I think that we can see the light at the end of the tunnel. It's unfortunate it's falling right in the middle of our holiday season, because people would love to have the light right now when it's really turning into our darkest hour. But again, the light is there. There are several vaccines that look good. And by summer, we should really have control of this virus, providing it doesn't mutate or do anything that is beyond what we expect. But we certainly can see the light. It's just that right now we're going through the darkest part of the tunnel. So we can't focus on the light. We've got to focus on getting through this next 3 months.
All right, focus indeed, but a little bit of a nice bit of optimism to end on there.
Definitely.
Dr. Suzanne Judd, epidemiologist at the University of Alabama at Birmingham School of Public Health. Thank you so much for joining us.
Thank you for having me.
All right, well, coming up, markets right now remain in the green. The Dow up 0.5 percentage point. We're going to be talking jobless claims and market moves next. Welcome back to Yahoo Finance Live. Taking a look at the markets right now. All three of the major indices are in the green, with the Dow the leader on the day, up about 0.5 percentage point. The Dow being boosted by one of its largest components, Boeing, up 7.5% right now. I want to bring on Kim Katakis, head of investment strategy at Martin Currie, now to chat some of these market moves, but also the jobless numbers that we got a little bit earlier today. So Kim, we have the job report out tomorrow. The ADP figures, they weren't great, but these jobless claims are beating expectations today, obviously creating even more optimism in the markets. Wondering what you're expecting tomorrow, and if you think that the coronavirus surge that we've been seeing all across this country is going to be appearing in tomorrow's report.
Look, I can't answer the last bit, but I would be surprised if it doesn't appear in the next few weeks anyway, and then, over the next month or so, because clearly the numbers that you were mentioning in the section just before, was it 200,000 just yesterday and 100,000 hospitalizations? These things absolutely have an impact on the economy. Look, we're coming from quite a good place in the sense that although it's just one number, it's better than expected. Yesterday, that's good. It bodes well, and this is why the market's excited for things like consumer spending, et cetera, which has been, albeit not shooting the lights out, it's been coming back steadily. October's manufacturing numbers were better as well. The economy is clearly trying to bounce back. But as we said, the last time you had me on, we were discussing a similar subject. The outlook is cloudy because you need to get COVID-19 beat before you can actually start to have confidence in forecasts. There is one little fly in the ointment, and that is that, some economists have been drawing attention to the fact that the numbers you're talking about from yesterday, the jobless claims, cover the weekend or the holiday period, Thanksgiving. So typically that's a bit anomalous, it may delay some numbers coming through. But I think overall, I wouldn't worry about it too much, take it with a pinch of salt. The direction we know is upwards, and that's probably what's feeding through to the market.
I want to ask you now about stimulus. Senate Majority Leader Mitch McConnell saying that he's hopeful a stimulus deal could get done before the end of the year. Given all of this great news that we've had on vaccine, and we've been talking about euphoria in the markets right now, wondering how much markets need a stimulus news, or if you think that there's enough, enthusiasm out there really to keep this party going.
Look, if you recall, 2 months ago, I was on again, and we talked about how there was going to be a pop of excitement when the news of the first vaccine, that had realistically good numbers, was coming. And I think we're still living that pop. We've seen 3 serious contenders for vaccines. One's actually got approval in the UK government apparently today, and that always inevitably is going to be producing that pop we're talking about. Having said that, we know realistically it's going to take a few months, and I think your previous speaker was mentioning next summer in the case of the US. That's still quite a long way away. So we need that to get out of the way first. In terms of other things to look for, one of the things you mentioned in an earlier segment I was listening to is how energy stocks have bounced. That's a slightly separate issue, and that's to do with things like OPEC Plus having agreed an increase in production of only 500,000 barrels. Now, that's quite important for the markets, not so much in the number itself, but just because we know that they've got an agreement. OPEC is obviously, as you know, the group of oil producing countries, the majority of them. Plus stands for Russia, which is not a member but cooperates, and they had a big fight literally at the weekend. Saudi wanted to cut back production for another 3 months to keep it going upwards, and the others wanted to increase production by 2 million barrels per day. They've got to a compromise today, 500,000 barrels. There was a slight pop, I think, in the oil price. You got the Brent at about 48 and WTI at 45. Now, the reason I mention that is because I think when investors look at the market as a whole, they're looking for as many signals as possible. And coupled with the decent numbers that we mentioned on jobless, this is another source of optimism, at least for a period.
So Kim, you're hinting at something that I had wanted to ask you about. So what sectors are you liking in 2021? How much do you think tech is going to be under pressure? And just more broadly, really, how should investors really be navigating through the next year? The next 3 months seem to have a lot of downside risks still out there, but there's a lot of reasons to be optimistic into next year.
Yeah, look, I mean, you don't last very long as an investment professional if you're not optimistic. I think the fact of the matter is, there are absolutely grounds for optimism. Let's not underplay the risks, and the risks are not just near term. The risks are there all the time. It just so happens we've got this big elephant to deal with, which is COVID-19. And until we get enough vaccinations literally done, we're not really going to be in a position where we're able to develop that confidence. Now, in terms of sectors, I mean, you mentioned some of the ones that have already moved, the bombed out ones, cruise lines, et cetera. Those are the ones that you'd expect to pop first on the news of a vaccine. There's a long way to go before numbers of people going on cruises is back to, where it was 2019. So I would suggest there's no rush really there. I don't think technology is overcooked. I think selectively valuations are demanding, and we would need these companies to deliver. I think one obvious cloud in the horizon for technology companies, especially the big, the FANGs, is that they are all companies that are, how shall I say, spectacularly profitable, don't need debt. And, a lot of people are paying attention and saying, well, actually, they may be not paying the tax they ought to. So it's not just the European Union wanting to get some tax out of them. I think it's, congressmen and senators are also thinking similarly. So I think there may well be an increase of tax. And if you are going to look around for sources of revenue for next year, if you were sitting in the White House, you would look at these companies because literally they're just oozing cash, right? That's right. Just a short-term kind of. This doesn't mean that you wouldn't go there. I would go back and look at abroad as well. I would look at the European green energy sector, and I think we've talked a little bit about that before. I think that the European Union's position as being in the vanguard of legislation that's going to govern trade and goods coming into that, the biggest consumer market in the world right now, that's going to drive a lot of activity in that direction, and that's going to be fruitful for investors to pay attention to.
Lots of good insights as always. Kim Kategas, Head of Investment Strategy at Martin Currie. Always great chatting with you. Thanks so much for joining us today.
Thank you for having me.
And coming up, optimistic signs of a stimulus deal. We'll be talking that right after this quick break. Welcome back to Yahoo Finance Live. Let's talk stimulus. After shooting down that $908 billion bipartisan package, Senator Mitch McConnell now says that compromise is within reach. He's resumed talks with House Speaker Nancy Pelosi on economic aid for all Americans. We have Yahoo Finance's Rick Newman here to talk about this. So, Rick, I know that you say that there's not going to be one big package, but you think instead that there's going to be piecemeal legislation. Talk us through that thesis.
I think that's just a more realistic expectation at this point. I mean, look, we've been talking for seems like 6 months about how big is this one single number 4 stimulus bill going to be. And it now seems quite possible that it's not going to be one big bill, that it could be some smaller pieces of legislation. For one thing, Congress does have to pass spending bills next week. That's just to keep the government running. If assuming they do not reach agreement, and I don't think they're going to in this latest round of negotiations, what you could see is a few provisions, such as continuing some of the unemployment assistance programs, which are scheduled to run out at the end of December. You could see that, for example, attached to the spending bill that Congress has to pass next week. With the two real sticking points here seem to be preventing a big bill that covers everything. And that's, should there be a liability shield for businesses, which Republicans insist there should be and Democrats don't like. And then should there be a lot of aid to states and cities, which Democrats insist on and Republicans say, how about no? So I just don't see them coming to terms on that in the next few days.
All right, so it has been a lot of will they, won't they over the last couple of months. I think I know your answer. You and I have been chatting long enough that I think I can pretty much get a good read. So likelihood that it's going to happen by New Year's, yay or nay?
A big bill, I'm a nay on that. And look, we still have to get through these two runoff elections in Georgia for the 2 Senate seats, which are going to determine the ultimate composition of the Senate. And honestly, I think Mitch McConnell just thinks he has the leverage to hold his ground. My guess is that if you voted on this so-called bipartisan package for about $900 billion, I think if the Senate actually voted on that, if Mitch McConnell let it come to a vote, I think my guess is it would pass. But McConnell doesn't want it, and he's got a handful of conservatives in his corner, and he gets to call the shots. So that's my reasoning for saying I don't think we're going to see a big bill by the end of the year.
It is the smallest package that we've seen, and we know that Republicans like that, they've always been sparring over that headline number. Really quick, Rick, what then do you think of the chances that perhaps a President Biden will say, hey, my predecessor used executive action when it came to, giving a little bit of relief and some stimulus to folks. I'm going to do the same.
I don't think he's going to have very much success in terms of dollar amounts. He can certainly do some things with regard to like the national stockpile and protective equipment and do some things differently than Trump. He can set different guidelines. His version of the CDC will probably be different from Trump. But in terms of economic aid, there's just not very much Joe Biden can do. And by the way, Trump tried to roll out some economic aid through executive action, and that didn't really work out either. So I don't think Biden's going to have better luck.
All right. Yahoo Finance's Rick Newman with some of those updates and a little bit of negative news on stimulus. I think folks were really hoping
Just
to
the
tune
messenger.
in and hear you say some good news, and you didn't give it to us, Rick. All right. Thanks so much for that. As we've been talking about stimulus, cities have also been seeking economic aid, as Rick was just highlighting. As a part of stimulus package, as budgets are strained and municipalities are really struggling to keep up basic services. One of those cities is Washington, D.C. Yahoo Finance's Jessica Smith is here to chat with us about her conversation with the general manager of the D.C. Metro. Hey, Jess.
Hey, Kristen, like so many other transit systems across the country, DC Metro is in a pretty desperate situation right now. It's facing a nearly $500 million budget deficit for the next fiscal year because ridership has just plummeted throughout the pandemic. So now Metro is proposing pretty massive cuts in response to try and fill this gap unless Congress steps in with more stimulus. They're proposing to totally eliminate weekend service. They're closing 19 rail stations, significantly reducing weekday rail service and cutting bus service down to 45% of pre-pandemic levels. Metro's also proposing 2,400 new job cuts on top of the 1,400 Metro's already seeking for this fiscal year. All told, that's about a third of their workforce. So I talked to the Metro general manager and CEO, and he told me he has never seen anything like this, but he has to balance the budget, and to avoid what he calls unimaginable cuts, Congress really needs to step in. Let's watch.
They're the ones out there every day, particularly our bus operators and our train operators, moving people that have to be moved to keep everything that we have barely going. And they're the ones that are doing it. At the same time, we're sending them the signal that, well, thank you for all that. Thank you for putting your life on the line for us. Thank you for being out there. But unfortunately, now I have to take your job away. I mean, what type of messaging is that, right? I mean, that is not what we should be doing for these people. If anything, we should be building them up now. I mean, you helped us during our greatest time of need. Now let's help you. Why are we now going to basically change your livelihood or put you out on the street?
Now, that bipartisan bill that was unveiled earlier this week does have money for transit and for state and local governments. But again, the future is very uncertain when it comes to that proposal. Some of Metro's proposed cuts could be rolled back if there is eventually stimulus. But the situation here right now is dire, and Metro just doesn't know what Congress will or won't end up doing. Kristen.
All right, Yahoo Finance's Jessica Smith with all of those updates. Thanks for bringing us the details of that conversation. Yahoo Finance Live will be right back after a quick break. On the other side, we'll be looking into the future of accessibility and how tech is impacting the lives of the blind and visually impaired. That's next. Welcome back to Yahoo Finance Live. Checking market action right now. All three major indices remain in the green, with the Dow, the leader on the day, up over 0.4 percentage point right now. The NASDAQ had hit fresh highs a little bit earlier today. The Dow getting a boost from one of its biggest components, which would be Boeing. Boeing right now up 7.4 percentage point. That is on the news that Ryanair will be purchasing some of their embattled 737 MAX planes. We will be chatting that a little bit later in the show. On a sector basis right now, we are seeing energy leading right now, up 1.6 percentage point. We heard Kim talking about that sector a little bit earlier. It had been hammered throughout this pandemic and has been getting a boost amid optimism on the vaccine, but also from news from OPEC, essentially, on how they will be holding back some of their oil. Well, let's talk now about the future of accessibility for the differently abled. Our friends over at TechCrunch spoke to the nonprofit Lighthouse for the Blind and Visually Impaired about how self-driving cars are going to be impacting accessibility. Take a listen.
As a blind person myself, I can't independently get into a car and drive. So right now I have to get into TNC with a person who may or may not have a status with COVID. Autonomous vehicles offer the chance to have no COVID exposure. That's going to be with us for a few years. So I think first and foremost, that's what people think of. And there are a couple of other advantages. Despite what we like to say, there's still a lot of discrimination against the almost 10,000 blind Americans who use guide dogs. Autonomous vehicles will not have that discrimination. Anyone gets in the vehicle. And maybe most profoundly, there's a kind of deeper social equity. Sometimes we just don't, as blind people, we don't want another person to be in our business. We want to just go somewhere. We don't have to answer questions. We just want to get there, be independent. And so the equity of being able to go just like anybody else on a mission is really profound and will be a huge advance.
Mark, I'm wondering what your viewpoint is. Are there accessibility barriers that you think that autonomous vehicles are in a unique position to remove?
I think with all technology, when we had first speech, text-to-speech software, it was, clunky and what have you, but technology has brought it, leaps and bounds over the last couple decades. And I think with autonomous vehicles, the technology is going to move very quickly, and any problems that do come up with accessibility, I think that technology will be able to solve. I mean, it's the ability for just putting the features that some of these autonomous vehicles are doing, which is like a beeping, the ability of the rider to beep the car's horn so they can find the vehicle, for the braille inside the vehicle, for the vehicle to explain to the rider where they are at any given time, how far they are to the distance. All that is progressive. So they keep adding these features as they get feedback from riders, but also just from the community in general. And a lot of those features, to be quite frank, are just as helpful for sighted people. Being able to find your car by touching a button on your iPhone is pretty global. And so those features are great. And I think one of the most of the things about autonomous vehicles is just the safety factor. You really aren't getting in a car with a stranger, and we all love ride hailing, and it's been a great transformation, but you're still getting in a car with a stranger, and some people that's very uncomfortable with, and they don't know that person. They can't, especially if you're visually impaired, they can't identify that person later. And so I think it's the non-driver could be a big safety factor.
So why don't you, Clem, walk us through how Waymo has approached not just the design of its vehicle, but importantly also the ride-hailing app, which is known as Waymo One in the Chandler area, to make it accessible to all user groups, and in this case specifically for blind and low vision users.
For sure. Yeah, that's a great list, Brian, and definitely a number of things that we've thought about and you and I have discussed as well.
Yes.
So we do think of, our overall approach is not to think of, here are a couple of features that we're going to build just for low vision users or for users with other disabilities. It's about thinking about the entire user journey from the first time you install the app and start onboarding with Waymo to getting dropped off at your destination, and every step in between, and thinking about what the needs are at those different points in the journey. And different people are going to have different needs, and we want to make sure we meet those throughout. So a number of things that Brian called out, like finding the car at pickup, finding the destination at drop off, really massive challenges. And we found that in by doing user research with users with a diverse abilities, we're able to pick out certain needs and build certain features that then help everyone. So for example, the honking the horn feature that Mark called out, this was something that we did build. We were more originally, hey, this is something that we know that low vision users are going to need. So we built this out and we tested it. And we actually were running a separate usability study, a totally different feature for all sighted users in the study. And they were trying to find the car pickup just as part of the flow. And we accidentally left the honk horn feature on. It was just in prototype phase at that point. And the person saw it and was like, oh, I need to find the car. They honked the horn and the car was pulled up around the back of the hotel where we were testing. And it was a huge light bulb moment for me where it was like, oh yeah, obviously this is going to be helpful for everyone. And we've seen that time and again in a number of different features we've built where we'll think of more extreme needs that people with certain disabilities may face and brainstorm features around them, but then realize, hey, this is something that affects everyone.
All right, well, coming up, there are many challenges to getting out a vaccine, and fake news is one of them, says the Red Cross. We'll be chatting with them next. The president of the International Federation of the Red Cross has labeled misinformation as another pandemic, one that could slow down the fight against coronavirus. Here to talk this and more, we're joined now by Dr. Emanuele Capobianco, Director of Health and Care for the International Federation of the Red Cross. Doctor, so the president of the Red Cross said misinformation needed to be combated. I'm wondering from you, how difficult do you think fake news, as we like to call it here in the U.S., is going to be making vaccine distribution?
Well, fake news have been problematic from the beginning of this pandemic, and now are becoming even more difficult when new vaccines are planned to get into many countries in the next weeks or months. And I think on one hand, we need to combat fake news by bringing forward the positive news, the right information, to keep people really on top of what is happening in a fairly rapidly evolving scene. And the other one is trying to also understand what is driving the fake news and try to listen to the concerns that are being raised and respond to those concerns so that we can hopefully address many of them and bring those people that are on the other side of the fence on what is probably the right side of the fence.
So, Doctor, speaking about some of those concerns, the UK has already approved a vaccine from Pfizer, which has been met with, some criticism and pushback, at least here in the United States, from Dr. Fauci. Let's take a listen to what he had to say.
If you go quickly and you do it superficially, people are not going to want to get vaccinated. We have the gold standard of a regulatory approach with the FDA. The UK did not do it as carefully. They got a couple of days ahead. I don't think that makes much difference. We'll be there. We'll be there very soon.
So some pointed words there from Dr. Fauci that the UK went a little bit too fast when it came to approving this vaccine. I'm wondering if you think that the United Kingdom went a little bit too fast, and if you have any concerns about this vaccine and about rolling it out to hundreds of millions of people.
So let me just start by saying that having vaccines potentially available within a year from the discovery of a new virus is something extraordinary. Having a vaccine that potentially has an efficacy, as has been reported, above 90% or 95% is another very good thing. Now, what we need at this moment is to have regulatory authorities all around the world certifying these vaccines independently in terms of safety and efficacy. And that is what is happening in the United States with the Food and Drug Administration process, what is happening all around Europe through the European Medical Agency, that it will be reviewing extremely carefully these files, and only after careful review, the vaccines will be allowed to go out and be provided to people that need it. And so we need to trust these independent systems that have been there, established, and have been reviewing plenty of drugs and vaccines that have come to us. And once we have that clarity, then we'll have to confront the new challenge of bringing the vaccines to the people who need them. And that is going to be quite a massive feat that will take a lot of efforts throughout 2021 and possibly beyond that.
I'm really glad that you mentioned those challenges, because the Red Cross, by its nature of responding to international crises rapidly, deals with huge logistical challenges all the time. I'm wondering what you see it is needed for a country like the United States to roll out a vaccine to hundreds of millions of people. And I'm wondering if the Red Cross is going to be involved in the distribution of vaccines, either here in the United States or in other countries around the world.
Well, thank you for the question. First, the first obstacle is ensuring that we have enough doses for the people who need them. And, for some countries that have been procured in advance, the vaccines, doses will be coming in the next few months. There are a lot of countries, particularly poor ones where the Red Cross operates, that have not been so lucky and that really risk to remain behind. And we are very concerned about that. There are some international mechanism like the COVAX facility that can actually support the procurement and distribution of vaccines in poor countries, and we hope to have that more financed in the next few months. Now, the second problem is then once you have the vaccines to really distribute them through the population, that's going to be a massive logistical effort, particularly for vaccines that require cold chain facilities that can preserve the vaccines at minus 80 degrees. It has been done. We have done it in Congo with Ebola, but it is a difficult task, particularly because we are not talking about a few hundreds, thousands of people to be vaccinated. We are talking about millions, billions of people to be vaccinated. And the Red Cross will be there providing support in many countries. We are doing a lot of advocacy. We're going to do a lot of social mobilization of people in countries to fight exactly that vaccine hesitancy that we talked about later, and then we will be there to support the vaccination efforts. And right now, our national societies in 192 countries are actually, in talks with authority to see how our 40 million volunteers can help in the best possible way the national efforts that will be run and led by governments in the different countries.
So looking here at the United States, Doctor, obviously we have a federal government, but we also have states and local governments. This provides its own challenges, right? When it comes to an effort as large as vaccinating hundreds of millions of people, 330 million people here in the United States. Just based on your expertise of, rolling out, vaccines across a country, do you think that an effort like this really needs to be something that is handled on a national level instead of, handed out to states to tackle on their own?
It's difficult for me to respond to a question specific to the United States, but I would say that in general, what you want is national plans that then are adapted to the regional or provincial levels in order to get all the steps lined up and prepared very carefully. What is needed at this moment is preparedness plans that are actually written and developed at all levels, so that when the vaccines come, things can proceed smoothly. And we know that all vaccine will not be coming at the same time, so there will be a progressive increase that will hopefully give us time to get ready in the US as in other countries. So we're not going to have 280 million vaccines tomorrow, unfortunately. They will be coming slowly, and that's why the authorities are now prioritizing who should get them first, starting with the healthcare workers, frontline workers, and then the people, the oldest people in home cares.
Right. Well, some good logistical insight there. Dr. Emanuele Capobianco, Director of Health and Care for the International Federation of the Red Cross. Thanks for joining us today.
Thank you very much.
And coming up after the break, we are going to be chatting Boeing as Ryanair decides to purchase some of its planes. That's next. Welcome back to Yahoo Finance Live. Let's talk Boeing now. Ryanair says they will be ordering some of Boeing's 737 MAX planes. We have Alexis Keenan here now with more details. Hey, Alexis.
Hi, Kristen. Actually a lot, 75 more 737 MAX 8 aircraft that Ryanair has agreed to buy from Boeing. So that's a major boon for Boeing that has really struggled to get this aircraft sold and out of its lots, basically. That brings Ryanair's total commitment for the MAX to 210 airplanes. Its CEO, Michael O'Leary, said today that the company also plans to accelerate the deliveries to get this aircraft into service as soon as this summer. The announcement was made at a joint event attended by both Ryanair executives as well as Boeing executives in Washington, D.C. today. Now, you could argue that these purchases are kind of a gamble for Ryanair, given the uncertainty surrounding passengers' willingness to really get on board and fly on this aircraft, yet to be tested, of course, and that's after the 2 crashes that killed 346 passengers and led to that worldwide grounding that in the US lasted for 20 months and is still pending around the world. Now, to give you an idea of just how reliant on the MAX Ryanair intends to become, take a look at this. Over the next 5 years, the fleet will grow from 400 to 600 aircraft, with the MAX representing 36% of its total fleet by 2026. O'Leary said that he is not concerned about whether passengers will avoid this aircraft. He emphasized that in the end, it will be the most audited aircraft in history. As for Boeing, we got a little tidbit from David Calhoun, who said that Boeing could probably shorten the time frame that it was estimating to roll these planes back into service, and that's because of COVID-19 vaccines. He said the progress there is promising for Boeing. It had previously said it would take 3 to 5 years to get this MAX program back into service fully. Kristen?
All right, thanks so much, Alexis. Boeing right now up just over 6%. Yahoo Finance Live continues with Alexis Christoforous in the 2 p.m. hour.
Hi, everybody. Welcome to Yahoo Finance Live. I'm Alexis Christoforous. Stocks are pushing higher and their record run continues after some new reports today show the economic recovery appears to be intact. We've got the services sector expanding in November for the 6th straight month, a sign that activity held up despite the rise in COVID-19 cases. Also, the number of Americans applying for first-time unemployment benefits unexpectedly fell for the first time in 3 weeks, coming in at 712,000. That reflects a moderate improvement in the pace of recovery at the labor market. The monthly jobs report, of course, will be released tomorrow. Also, possible progress on a long-awaited stimulus package out of Congress, helping to lift stocks higher today. Senate Majority Leader Mitch McConnell said on the Senate floor this morning that an agreement was, quote, within reach, but still we know big differences remain between these competing proposals. House Speaker Nancy Pelosi and Senate Minority Leader Chuck Schumer backing a bipartisan $908 billion relief package as a starting point for another stimulus deal, but McConnell has pushed for a much smaller bill of about $500 billion. Here's how all that is shaking out on Wall Street right now. We've got the Dow Jones Industrial Average up about 88 points, so off its highs of the day, but still in record territory, and the broader market has just turned mixed. We've got the NASDAQ up about 40 points. The S&P 500, though, is right near the flat line and actually is just moving down about 2 points, so backing off of that recent record high. I want to check in with Jared Blickery now for a look at big movers today, and boy, oh boy, is Boeing one of them, leading the Dow higher after that big news from Ryanair. Looks like Ryanair is going to be buying up some of their beleaguered MAX jets.
That's right. Nice day for Boeing. It stocks up actually 11.7% over the last 2 days. And we'll get to some more charts in a second. But first, the Ryanair news. Now, this is seen by analysts as a seal of approval from Europe's most valuable airline. They're going to be purchasing 75 more of the 737 MAX jets. And that's in addition to a previous purchase order. And also, I should say that American Airlines is now going to be the first airline to fly the MAX in the sky, and it's also going to be the first to receive an additional delivery that was been postponed by about 20 months for now. And American Airlines are going to be flying around their executives, staff, media on these planes, just kind of to gin up support and make people more confident about the 737 MAX. And they're going to let customers see it at the airport. So hopefully that does lead to increased confidence, which is much needed, especially in the airline sector right now. And just to get to the chart real quick, I just want to show you what they've done year to date, because they are now taking out their June high. And so this is an important technical development. Looks like Boeing is well on its way to recovery here.
Wow. I want to talk more broadly, though, about airline stocks, Jared, because they're actually moving up, even though there's a bunch of negative news piling up. Delta says it's going to burn through more cash. And I know Southwest warning that there are going to be more furloughs coming.
That's right. But as you said, the stocks are doing very well today, part of that reflation and reopening trade. So first, Delta, they're seeing a minimum cash burn of about $12 to $14 million per day in the fourth quarter. That's a boost up of $2 million. So more cash burn for them. Not the most positive development, but the CEO, Ed Bastian, still very positive on reaching a break-even point in the spring. That might be what's keeping some of the confidence up. And then you mentioned Southwest. That's up 2.8% here. And you can see year to date, still underwater, but slowly climbing and making up some of those losses. Southwest sent warning letters to 6,828 employees, warning of additional furloughs. So total, this could mean a reduction of up to 13% of its workforce, and notable because if this came to fruition, these would be the first involuntary job cuts in its 49-year history.
Wow, they need that relief so quickly. We'll have to see if there's any of it for them in a new stimulus package. Want to hit on these software companies, Jared, because they're going through the roof today. A lot of them hitting record highs after banner earnings. I see Okta, CrowdStrike, Snowflake having a pretty awesome day.
Yes, they are. And so let's just start at the upper left here. You can see Zscaler is up 25%. A lot of positive analyst commentary on all these names you just mentioned, especially given the results for the field. And software itself has been kind of going sideways over the last few months, but you can see Zscaler here has now broken to the upside. Let's take a look at CrowdStrike, because that is now broken to the upside too. And if you take a look at Snow, best day ever in its short history, and it has now just marginally overcome that record high from only last week. Now, contrasting that is Splunk. Now, they seem to have some execution problems, and you can see a really big drop here, especially notable over the last 2 days. That is their worst day in history or thereabouts. So not the best day for Splunk, but a good day for software overall, Alexis.
For sure. And actually, tomorrow, Jared, we're going to be speaking with the CEO of Okta, Todd McKinnon, about those spectacular results and what he sees in store for 2021. We'll check in with you a little later on to talk oil, okay? Let's bring in Jana Shoulders now. She's managing director at Mariner Wealth Advisors. Jana, good to have you here on the show. I'm curious what you are doing now in these final weeks of 2020 as you prepare portfolios for the new year. Are you moving things around and making any big changes?
I think at this point, there's a big focus on doing any loss harvesting that you haven't already done so that you can use those losses against realized capital gains, or even if you don't have realized capital gains yet, banking those for a carryover to next year. We're also optimistic that value may be coming back. You know, we've seen such a huge push with growth stocks this year and such a wide outperformance that people have wanted to abandon value investing. And we're holding tight and really believe that a balanced approach and a value play in your portfolio is important, especially if yield is important to you.
Where can you go for some yield nowadays if it is important to you, especially when you look out to Q1 and you know the start of a new administration in Washington?
Right. And I think the idea that lower longer is in place, certainly with Janet Yellen being the pick, tells us that bodes well for dividend paying stocks. We also know that a lot of those beaten up value stocks have high dividends, and there are a lot of reasons that international stocks, many of the telecoms, the utility-oriented ones have high dividends. So that also bodes well for people placing money to work overseas. So I think that a dividend portfolio is going to be a nice place for people to seek some yield. I know that we're also cautioning people not to be so far-reaching that they impact their liquidity. There are a lot of investments that are not liquid that may not fit in a portfolio. So we caution our clients to be careful about that search for yield, that it isn't taking you to places that you are really not appropriately suited for.
What about some other sectors? I know that infrastructure is something on President-elect Biden's bucket list, perhaps even in the first 100 days in office, to try to make some movement there. Are you looking at infrastructure as a possible opportunity for investors in the new year?
Yes, we are, for the reasons that you just articulated, which is that it does seem to have bipartisan support. And we certainly know that we have a global need for that. And that is one of the asset categories and classes, infrastructure globally, especially, that we are adding to in our clients' portfolio. And most often that generates yield as well as expected future growth and total return.
Jana, what are your overall feelings on market behavior? Because we're coming off a spectacular November. It seems like those gains are bleeding over here into December. All the while, we have a rise in coronavirus infections. We do not have a stimulus package yet. What is buttressing this market? And are some sectors here looking a little too bubble-like for your taste?
Well, I think people have stopped focusing on wanting to buy those stocks that have to do with working at home and technology focused only. So we're encouraged that we see the broader market performing a lot better. If you look at that, how much that gap has narrowed in what the market indexes that are cap weighted or not, that has narrowed, which tells us that this rally is broader. And it is a little concerning to be trying to put money to work in some of the most frothy sectors like technology. So I think that that's going to drive people into some of the other areas. And there's a little of that, Tina, there is no alternative for yield. So I think that bodes well for the stock market and frankly, even high yield bonds, which have a high correlation to the stock market.
All right, we're going to leave it there. Jana Shoulders, Managing Director at Mariner Wealth Advisors. Thanks for being with us. Coming up, we speak with the hosts of the Hulu hit Small Business Revolution. Ty Pennington and Amanda Brinkman are up next. Welcome back to Yahoo Finance Live. Small businesses across the country are struggling with the new realities brought on by the COVID-19 pandemic, and they're holding out hope that the next stimulus package provides some desperately needed relief. Season 5 of the hit Hulu series Small Business Revolution is now streaming, and this season they visit Fredonia, New York to help small business owners adapt during this unprecedented time. And joining me now are the show's hosts, Amanda Brinkman of Deluxe Corporation and renovation guru Ty Pennington. It's so great to have you both with us. Hey, Amanda, I'm going to start with you because I know you had started just filming in Fredonia, New York in March when the lockdown started to happen. How did the show have to quickly pivot to make this season a reality?
Yeah, well, first and foremost, we had to move to virtual capturing of the production. We were very blessed that we were able to meet the businesses ahead of time, meet the community, and select the business that were going to be featured in season 5 before the pandemic hit. And then we just got to work with helping these businesses survive this unprecedented crisis. I think people are recognizing that COVID is affecting small businesses disproportionately. And so the work that we do every year on the show and in real life was more and more important to helping these businesses not just survive the crisis, but truly thrive.
Ty, I'm curious what you saw there on the ground. How are these businesses surviving this new reality right now?
Well, this was definitely a very special season because we were able to get into Fredonia, meet the business owners, really see them in their element, and realize, what their struggle really is. And then we went back, put our heads together. The Deluxe team got all the experts together to, figure out a plan of attack. And that's when COVID hit. And to be honest with you, I think it's one of the best seasons ever because not only does the show Small Business Revolution shine a light on the struggle that small businesses face every day, but we're talking about a season where these small businesses are facing it during COVID. And the crazy part about it is you really see these real lives, the fact that these aren't just business owners, these are people raising families. You really connect and you understand exactly sort of all over America what people are dealing with. But what I was truly amazed about is not only the resilience of the business owners, but also a way for the Deluxe team to figure out how can we do this virtually? How can we do the physical transformations by going in when the business owners aren't there? You had community, other businesses helping other businesses at the same time. We had to do this virtual communication through screens and using technology in ways we haven't. But I have to say, I think it's probably the proudest season I've ever been part of, just because to be able to make a difference every time we do this with small business, but especially during a pandemic, because these guys not only have sort of persevered, in many cases, they've actually done better because we've shown them ways to find other outlets.
I think that is so important, right? I mean, everybody just sort of has to pivot when something like this happens. So, Amanda, what were some of the things that you did with these businesses that you can share with us? Some tips or advice you gave them to make it through this difficult time?
The number one thing we worked with them on was their marketing and communication. So again, I think people are recognizing how hard this has hit small businesses, and people really want to support the entrepreneurs within their community. But as small business owners, we need to make that as easy as possible. And marketing and communications is one of the most effective ways to do that. So communicating with your customers about whether you're open or closed, if it's a hybrid approach, how you've maybe changed your operations model. Are you doing curbside, pickup, delivery? Have you changed your hours? And so for those who aren't familiar with the program, it's essentially a business makeover show, but done with heart. And we always help them kind of with marketing, financial, and operational pieces. But it was really important that we help them figure out how do they still meet their customers' needs during these, again, unprecedented times. So marketing was a huge part of how we help them, continue to stay in front of customers, communicate with them, and bring people in.
Ty, did any one thing, I guess, inspire you most about this season, or did you see sort of a thread throughout all of these business owners while you were shooting?
I would definitely say, I would just say this: you will become connected, you will be affected, just like I was when you experience what this show is. There are a couple of episodes, especially when you talk about Mike from Nice and Clean. This is a guy who is really a self-made guy. He was literally working in a factory, metal factory. We're talking, intensive heat, etc., steel. And then he started moonlighting, trying to create his own business, and that was auto detailing. Um, and he's trying to really like provide for his family and his kids. And this is a guy who just didn't believe that money ever goes to anybody except money. As he said poignantly, he's like, money always goes to money. And it's the people like me that never really see any of the fruits of their hard labor. And what was really wonderful to see is by him connecting not only with the team from Deluxe, but also experts that also are in his field, he realized there's a whole other section of his work that he was missing out on that he developed and found a way to finally not only have his business succeed, but he could finally lose that other job. So and just focus on what his dream has been. And so what this show really is, it's the American dream, and you really see what it takes to live that dream. There's another episode that's Fresh and Fancy Florist, which is a mom and a son team, and you're seeing challenges that you didn't even realize existed for somebody as simple as just a town florist. But what I love is the resiliency that no matter what they're faced with, they're not giving up on this dream. And let's face it, like these small businesses in small town America, that's what makes the charm of America. That's why we live in these little communities, so we can have walk streets to see shops that you don't see on the interstate in the big malls. And so it's just such an important show, and it's such an important I would say, window into America that we sometimes forget how important the small businesses are. But I think because of this pandemic, it really has shined a light on how important it is for all of us to chip in and save these guys any way we can, especially during the holiday season.
Yeah, talk to me about that. How can we all show our support and our love for these small businesses? As you say, they're the charm and the backbone for many small communities. I mean, they put so many people to work.
Yeah. I mean, look, one thing you can do during the holiday season is gift cards. In fact, I believe, Amanda, I think they still do it. If you go to smallbusinessrevolution.org, you can sign up to win a gift card that you can use in any business in your community. But I think what's great is people are really realizing the importance of it. Whether it's ordering, with a delivery service or ordering pickup, support those local restaurants that won't survive without you. But it's not just the restaurants, you got to remember it's the dog groomers, it's the specialty shops, it's all the people that run sort of that mom and pops. Like, this is our passion, this is our dream business, because it is really tough to maintain and to survive in this sort of economic world we're in, not to mention in a pandemic. So this holiday season, let's give as much as we can to the small businesses, because we want them to be there next year. And that's really up to us to make sure they are.
Amanda, what would your message be to lawmakers who are trying to hammer out a stimulus package right now in Congress as it relates to small business?
I think all of us want to see small businesses get to the other side of this. And so I think we need to use all of our resources available to make that possible. I think it does come down to us, though, as consumers. First, so few of us have a direct control over how some of these laws and stimulus packages are put together, but we can control how we support small businesses. So I think it's about everyone finding creative ways to support those entrepreneurs within your community. As Ty said, we want to see them be here on the other side of the crisis. I think it's about making sure we're all following safety protocols so that these small businesses, some that have been forced to close, can reopen as quickly as possible. So I think it's just about supporting small businesses right now, and gift cards are a great way to do that around the holiday season and continuing to support those small businesses. We started this not just to make a show, but to truly create a movement to inspire more people to understand the importance of supporting small businesses. And I think we're all recognizing that right now. We want to see these small businesses that make our neighborhoods and communities so special and great be there on the other side.
Gotta love your small business. Again, the name of the show is Small Business Revolution. It is streaming now on Hulu. I want to thank Amanda Brinkman and Ty Pennington. Great to see you guys.
Thank you.
Thank you.
Be well. Bye. All right, coming up next, a conversation with Senator Mike Lee, chairman of the Joint Economic Committee. We'll be right back. Welcome back. Yahoo Finance's Rick Newman recently spoke with Utah Senator Mike Lee for the latest episode of Yahoo Finance Presents, presented by T. Rowe Price. And they spoke about stimulus and the senator's own coronavirus diagnosis. They began the conversation on Lee's work around what's called social capital.
Well, we all know that there's a whole lot more to life than dollars and cents. There are families, there are marriages, there are community organizations and neighborhoods. These are the things that really make us and define us and lead to human thriving. And all of these things make up the network of relationships that we call social capital. The Social Capital Project is something that I started as chairman of the Joint Economic Committee. This is a multi-year research effort that has been investigating the current state of these relationships. And what we found is that even before COVID, a lot of our communities were struggling with the challenges that come from isolation. And isolation can come about as a result of addiction, family breakdown, and COVID has, of course, made a lot of these issues worse. Take marriage, for example, which even prior to COVID was at a low point. And that is something that could be getting worse. And when those things do get worse, it leads to more deaths of despair and more addiction, more unemployment. It's one of the reasons why we focus on, government can't and shouldn't ever try to force or coerce people into getting married. That's not the role of government. But what we can do is look for ways in which government might be making matters worse, and we can take off some of that burden.
There's a lot of research along these lines, including a lot of research on wealth inequality and income inequality, which has generally been worsening for about 40 years. And this is a tough problem. There are no easy solutions to what you might call the fraying of American culture. Are you finding solutions in any of this work? And does this lead to any kind of legislative initiatives?
Yeah, it does. And that's the whole point of the Joint Economic Committee. It's kind of an internal think tank within Congress. If you look, for example, at what some of our federal welfare programs are doing to families, they're tending to discourage people from entering into marriage to begin with in sheer economic terms, and in terms that end up having more of a toll on poor, lower income Americans than on others because of simple dynamics. Like take, for example, a couple where one partner earns, say, $24,000 a year and the other partner earns $20,000 a year. We've estimated that if that couple chose to get married, that couple would stand to lose $10,500 in benefits from the government. There's no reason why our federal welfare programs should have to discourage marriage like that, especially since we know that marriage has a close correlation to upward economic mobility. And so I'm working on legislation that would undo some of those penalties and would at least stop the government from discouraging marriage.
Congress is split at the moment with Democrats controlling the Senate, Republicans controlling the Senate, Democrats controlling the House. Still not clear if that will be the case after those two runoff elections in Georgia, but whatever the case, whatever the outcome, there's going to be very narrow control of the Senate for one party or the other. We have the new Joe Biden administration coming in. He has proposed a lot of things to make the economy fairer and to address some of these issues, wealth and income inequality. Do you see any areas for possible bipartisan legislative work over the next 2 years, let's say?
Sure. Look, there are lots of things we can do. There are plenty of areas where the parties are at odds with each other. Plenty of areas where they're not. Take, for example, the child tax credit. This is something I've been working on for many years, something I worked on with the Trump administration to increase the per child tax credit and thereby decrease what I call the parent tax penalty that's inherent in our system. The way our tax code and our senior entitlement programs interact sometimes hurts people who have kids. I've got a lot of Democratic friends who like the idea and who have approached me on it. This is one of many ways in which I think we could work together, particularly in developing pro-family policies that would help America's poor middle class.
What's your advice to Joe Biden as he, takes office in a few weeks in terms of how to approach Congress with some of these priorities? So, do small standalone things such as you just mentioned, a child tax credit, or bills that have something for everybody, or how does he get some of his ideas passed?
You know, I've come to believe that we would do a lot better, and we'd have a lot more bipartisanship and bipartisan success if we legislated at a slightly more granular level. That doesn't mean that we have to be dealing with things that can always be put onto one page, but it should, in many instances, result in us focusing on a single, fairly narrow topic. I think that would be a confidence building exercise, and one that would allow us to realize that there's a lot that can be done if we don't tie everything to everything else.
Congress is still trying to get a fourth stimulus bill passed. I mean, we've been asking every member of Congress we interview about this since August. So, I mean, people just want to know, like, is there any chance we are going to get another stimulus bill, or could this be something that doesn't even happen?
You know, bottom line is I'm not sure, but we have to remember that Senate Democrats have, for the last few months, been blocking us from even beginning debate on COVID relief bills. Now, I didn't like everything in these bills, but I voted to begin debating them so that we could start to amend them and make them better and figure out where compromise could be achieved. But Democrats wouldn't allow that. And so until such time as their unwillingness to begin debate it transforms into something else, that seems unlikely.
I mean, a lot, we know from our audience and a lot of people, they don't care about the blame game in Washington, who is holding up what. They just need help, or they know people who need help. I mean, what is the realm of the possible at this point? I mean, do you think we'll have a stimulus bill of at least $500 billion by January 31st, let's say?
I think that's entirely possible once we get into the new Congress. But I really don't know, in part because we don't know who's going to be in control of the Senate. We don't know what strategy that Democrats are going to be deploying. But I want to get back to your point a moment ago about the fact that people who need relief don't care about the blame game. I understand that. I get that. This isn't about blame, but this is about the fact that in order to pass something, you first have to begin debate. And while neither party is perfect, and while neither party is without blame generally, in this circumstance where we're talking about COVID relief bills over the last few months, it is in fact Democrats who are refusing to allow us to begin debate on them. That does matter, and they should have to answer for that.
Congress does need to pass another spending bill by next week, I think, is the deadline for that, just to keep the government functioning. Is that going to go through smoothly? Is that something Americans need to be paying attention to, or can they just trust that that's going to get taken care of?
I strongly suspect that something will be passed. I can't imagine that there's going to be a shutdown. I don't think either party wants a shutdown or could benefit from a shutdown right now. So I think what's likely to happen, assuming that an omnibus isn't negotiated, the latest rumor I'm hearing is that there might be a continuing resolution taking us into perhaps mid-February.
Is there any likelihood that stimulus gets rolled into that spending bill next week, or is that just too complicated and too short of a deadline to make that happen?
It seems unlikely at this point. Obviously, a lot could change in the next 10 days. We've got until December 11th is when the spending deadline hits. So yeah, it's possible. Seems unlikely.
Senator Lee, you contracted COVID-19 in October, I believe. Yes. Can you tell us what that was like? Was that relatively painless experience, or was it more difficult than that?
I didn't require hospitalization. I was really tired for a week or 10 days, and had to get a lot of sleep. Caught up on rest and watching TV. It was not pleasant, but got through it just fine.
What did you binge?
I ended up binge watching a fair amount of 30 Rock. I don't know why I was drawn to that. During this whole experience for a while, I felt lousy enough that I didn't feel like reading. And watching long movies was sometimes tedious. So watching something with rapid fire comedy was a nice diversion for me. So yeah, I went through a lot of old episodes of 30 Rock. It was
like
fun.
You didn't have to think too hard.
Yeah, exactly.
Did that experience change the way you think about coronavirus?
No, because my experience with the virus was roughly as it had been described. by a lot of people. So I can't say that it changed it. Certainly helped me have more empathy for those who have had it. But then again, I've been aware for some time of what the virus was like, and it was roughly as advertised, not particularly fun.
I would imagine not particularly fun. Well said. That was Utah Senator Mike Lee speaking with our own Rick Newman. Major oil producers are starting to slash spending. We've got details for you straight ahead. OPEC and a group of Russia-led oil producers have agreed to increase their collective output by 500,000 barrels a day. For a look at how that is playing out in the oil pits, let's check back in with Jared Blickery. Hey, Jared.
6 basis points just closed.
You're good.
Can you hear me now? All right. Well, we just settled for the day. Great. And we are over $45 a barrel. OPEC Plus now finally has an agreement, and they're going to slightly increase production in January by 500,000 barrels a day. And then each month thereafter, they're going to reconvene and potentially increase production more. Now, why is the market up with all this extra supply? I think markets have gotten a little bit pessimistic that there wouldn't be a deal done or that things would be delayed even more. So this is kind of a compromise. We've seen this get dragged out. We were supposed to have a decision Tuesday, but now we have it, and the markets are just kind of running with it. If you look at the price action, so this is today, you can see steadily getting more bullish throughout the day. Over the last 5 days, really just choppy action, but notably, we're still by these highs that are the highest since early March. So that's very supportive. And as we've been remarking all week, the market really didn't sell off that much when it became known that there was some internal divisions within OPEC Plus. For now, we have an agreement. Market seems to be liking it, and it's running with it.
All right, I want to stay with oil now and bring in Robert Grissoff. He is energy practice leader at Embark. Robert, you just heard what Jared had to say there about OPEC Plus. What do you believe that policy decision, what do you think the impact of that policy decision will be on oil overall?
I think it's hard to say what the impact will be overall. Clearly, there was a compromise that took place. There were reports coming out that certain players wanted to remain with no increase in output, while others wanted to increase output much more substantially. You got a compromise. I think one of the key things, though, that you saw there was the group agreed to review production every month and decide whether or not to increase production. I think this seems a clear sign of the uncertainty in the shape of the demand recovery.
What are your predictions for the range that we might see oil trade in? We saw it blast through $45 a barrel this past week. I mean, what do you see sort of as the top for prices in the short term?
I think as you look at the futures market, you can tell that it's very flat. So I think short of significant demand recovery, it's going to be very difficult for us to have significant price appreciation. There's certainly some optimism around the vaccines and the good news that's coming as a result of the vaccines, which ultimately should be able to drive some demand increase as well.
Wanted to get your take back to the OPEC Plus alliance in general. Given the fact that we didn't see the market really sell off that much in response to the delays, and also given the fact there could be some leadership changes at the Joint Ministerial Monitoring Committee, is OPEC Plus still relevant to the market? How important is it?
Well, I think OPEC Plus is obviously still very relevant. I think as we all saw in March, they're very much a player in the global commodity prices, particularly in a time where demand has been damaged significantly by the effects of the pandemic. In a higher growth and demand scenario, the impact may be muted a little bit, but in the current environment, I think OPEC Plus is definitely the dominant player.
What are your thoughts on the Biden administration and what some of his policies on energy might do to the overall sector and to prices in 2021?
Yeah, absolutely. So, based on the campaign cycle and the discussions with our clients, it's clear that the expectation that the Biden administration will not be as friendly to the oil and gas industry as the current administration. That being said, we've seen high prices and low prices during years when the sitting administration was very friendly to the industry, and at times when the administration was not as friendly. So, certainly domestic policy impacts production. However, it truly is a global market, and global demand and geopolitics seem much more likely to impact global oil prices than U.S. domestic policy. What we were talking about earlier, what will OPEC do with regard to supply? Will we see a geopolitical price war such as what we saw with Saudi and Russia earlier this year? What will the global demand look like when we see a real recovery in travel? I think those are really the things that are going to drive commodity prices. One of the things that's been top of mind and created a lot of headlines is the fracking versus permitting on federal land. So there were a lot of reports of Biden pursuing a fracking ban and some of the confusing remarks Biden made about hydraulic fracturing. So in spite of the headlines, there does not appear to be a written policy and plan a written plan to ban fracking. There is a proposal for banning new oil and gas permitting on public lands and waters, which would limit the ability of current holders of federal leases to drill new wells. Speaking to our clients and others in the industry, there will be a lot of opposition to any such plan. The industry and others will fight this using likely every tool at their disposal. This would likely include litigation from leaseholders and states that will be impacted by lost revenue, as well as industry organizations such as API and others. Obviously, a highly politicized information campaign would include citing concerns such as job losses, state tax revenue declines, energy independence, energy security, among others. What I would say is I think there's a big gap between a proposal that was likely circulated to appeal to a base of voters and the ability to enact that plan and an attempt to enact it.
All right, Robert Grissoff, Energy Practice Leader at Embark. Thanks for sharing your insights with us today.
Thanks for having me on. I appreciate it.
Thanks, guys. Coming up, what small cap stocks are telling us about the market in 2021. We'll be right back. Welcome back, everybody, to Yahoo Finance Live. I want to get you a check of the markets here because we are higher across the board in record territory once again for the major indexes. The Dow up 158 points, back above 30,000. We've got the S&P 500 up about 5, and the NASDAQ Composite up 53. And not to be left out, those small caps, the Russell 2000 up yet another 1% today. It's been quite a year for the small caps, and I want to bring in Nick Santiago now to talk about it. Nick is founder and chief market strategist at In the Money Stocks. Nick, the last time you were here, we talked about the Russell 2000 index. Do you believe that there is more room to run, and are these the stocks to watch in 2021?
I do believe there's more room to run, probably sometime into the first quarter of 2021. The last time I was on, I had talked about the Russell and said the Russell looks like it wants to break out. It's showing better relative strength than the NASDAQ, which is the big winner of the year. And the Russell took off to the upside. And I do think it's probably going to trade north of 1900 now. So the Russell's looking very, very good. That represents small cap companies in the United States. And when the small caps move, that's the market's way of talking to us.
Okay, then what's the market telegraphing us when they do buy up the small caps the way they are?
Well, the market's telling you that there's more room to the upside. In the past, it really has been just the big NASDAQ names that were moving the market, the Googles, the Amazons, the Apples. If you notice, Apple's not making new highs anymore. Now it's the Russell 2000 that seems to be making a new high every single trading day. The negative is when you get to 2021 and sometime in that first quarter, if the Russell starts to die out, that's going to tell us 2021 could be very problematic. But right now, there's no problems. I think there's more upside to go, probably into the early part of the holidays, maybe into at least into the new year.
Do you think that those small caps are getting a little too frothy right now? And how do valuations look? I mean, if somebody wants to get into that space now, have they in essence missed the boat?
They have missed the boat, but there are still a lot of other equities that are really, really performing well. The one thing I would say is just use it as a barometer. Once the Russell turns south and you start to see a big reversal, then you really want to be careful with everything. As long as the Russell's holding up, I mean, there are a lot of equities that still can have some more upside, and there are a lot of good patterns out there still.
I want to talk about some of the specific stocks you like right now, and some of them are in the pharma sector. Surprise, surprise, especially with the vaccine news coming fast and furious. So right now, you say you own Sanofi. Tell us why you like that stock.
That's right. I just got into Sanofi yesterday, and the reason why I like it is a lot of people were very excited over the vaccine makers, the Modernas, the BioNTech, NVax. All of these companies were the big runners. But what people don't understand is Sanofi is going to be manufacturing the vaccine. So will GlaxoSmithKline. So I'm looking to get into GlaxoSmithKline. I have owned it in the past. I'm looking to get into it again. But right now I own Sanofi, and I think that's positioned really well because you're going to see that's going to be one of the vaccine manufacturers going forward, especially in Europe, where I believe they're going to start to distribute the vaccine very shortly.
Do you own any of the companies that are actually making these vaccines, like a Pfizer, like a Moderna?
I have in the past. I don't own them any longer. Like I said, I think that news is done. Those stocks have already made their move. The market is very, very efficient. It always looks forward. But what the market is not looking at is who is going to manufacture these vaccines. And I think that's a positive for Glaxo and as well as Sanofi, which I am an owner of.
All right, let's talk about the broader economy now. And we got some better than expected news out today. Hard to believe that better than expected means that unemployment claims dropped to 712,000, but that's where we're at right now. What are your expectations for the job report tomorrow? And do you think that we're going to see a steady improvement in these weekly claims in the weeks and months ahead as these vaccines make their way into the hands of the public?
Yeah, I think tomorrow you're going to have a pretty good job report. The reason why I think you will is just simply because of seasonality. You have the holiday upon us. There's a lot of hiring for that. But I don't know about going forward. When we look out into January, February, you have a lot of lockdowns that are taking place right now. A lot of businesses are being forced to shut down. So that could hurt the job number going forward. But I do think we're going to get a pretty good job report tomorrow. ADP came out on Wednesday, the ADP report. That was pretty decent. So tomorrow we'll get the BLS non-farm payroll report. I have to think, I think it'll be pretty decent just because of seasonality and a lot of hiring going into the Christmas and New Year season.
All right, Nick Santiago, founder and chief market strategist at In the Money Stocks. Thanks so much for being with us. And coming up, Facebook promises to remove misinformation surrounding the coronavirus. We've got details for you right after this. Welcome back, everybody. We have got our eye on Facebook today. That stock is actually not participating in the rally. It's down about 1.5% today. Lots of news surrounding Facebook, the least of which is a new lawsuit brought by the Department of Justice accusing Facebook of discriminating against U.S. workers. And we have our tech editor, Dan Howley, here to fill us in on this and other news making headlines for Facebook today. Dan?
That's right. According to this complaint, it's a 17-page complaint filed by the Department of Justice and their Civil Rights Division, essentially saying that there were 2,600 positions advertised by Facebook between 2018 and 2019 that were inadequately advertised to U.S. citizens, and instead were advertised more heavily towards H-1B visa holders. Those are high-skilled visas for foreign workers here in the that would come here to the U.S. And essentially what would happen was the companies have to then sponsor these employees to work in the U.S. So this is something that I think we're going to hear a lot more about. Obviously, we had a lot of backlash from the Trump administration's moves on immigration, and a lot of the backlash came from the likes of Silicon Valley tech giants saying that there aren't enough positions here, or rather there are too many positions to fill and not enough skilled workers in the U.S. to fill them. And so they would need to use immigrant labor. But here, essentially, the Department of Justice is saying that while they did seem to hire these workers on H-1B visas, they weren't looking to American workers first. And that's something that they have to prove that they did. But according to this complaint, the allegation is that they didn't.
All right, I want to get to the other news Facebook is making today. It's coming out and saying it's going to take care of misinformation on the platform regarding the coronavirus, I guess particularly surrounding the vaccine. What are they going to do exactly?
Yeah, it's something that they've been doing for a while now, as far as the coronavirus in general. But now with the vaccine itself, what they're going to be doing is taking down anything that would lead to real world harm, and that's kind of the minimum standard that Facebook has for taking down any kind of content. And in this case, it would be anything related to, as you said, the vaccine, whether it says that, there's something in the vaccine that isn't actually there. They have people put out conspiracy theories, I guess, saying there's computer chips in vaccines. That is not the case. We would probably know about it by now if we didn't. Some shadowy cabal wouldn't. But I think, when we see something like this from Facebook, it does give them a PR win, because it makes it seem like they're doing a lot more as far as limiting the spread of misinformation. But this is one issue, and it's kind of laser focused on the vaccine and whether or not people are able to post.
All right, we're going to leave it there. Thanks a lot, Dan Howley, for bringing us the Facebook news today. That's going to do it for this hour of Yahoo Finance Live. Stay with us, because coming up, Adam Shapiro and Shauna Smith will take you through the final hour of trading on this Thursday. Thanks for being with us.
A new reading on the labor market, jobless claims falling for the first time in 3 weeks. Moody's chief economist Mark Zandi weighs in on whether new COVID restrictions could jeopardize the recovery. Los Angeles ordering residents to stay home as the U.S. reports more than 200,000 new daily cases and 100,000 hospitalizations for the first time. We've got the latest on the rapid spread. And jewelry buying making a comeback. Signet Jewelers posting a surprise profit on a strong start to the holiday shopping season. CEO Jenna Drosis joins us to discuss the strong quarter. Welcome back to Yahoo Finance Live for the final hour of trading. I'm Shauna Smith.
And I'm Adam Shapiro. We are watching markets as we head towards the closing hour. Let's jump right to it. We never want to be late or delayed. So let's take a look at some stocks which are really on the move today. And among them, first, let's take a look at Snowflake. Look at this, up right now about almost 12%. Shares were up 15% after their first earnings report yesterday. That's the first since they went public back in September. Revenue jumped in the quarter 119% to $159.6 million. Product revenue was 148.5 million. That represented 115% year-over-year increase. Snowflake did post a per share loss of $1.01. That was wider than what analysts had expected, but they're getting some favorable upgrades here. Morgan Stanley is raising its one-year price target on the stock to $265 from $220. They're saying that their forward guidance is in the midpoint, nothing too spectacular. Piper Sandler, a little bit more optimistic. They raised the one-year target to $312 from $264, impressed with triple-digit revenue. Then there is CrowdStrike. Now, their third quarter of fiscal 2021 report was better than the street had been expecting. The revenue for the quarter, $232.5 million. That's an 86% increase compared to what it had been in the third quarter fiscal 2020. And you can see that shares of CrowdStrike now up about 12%. Some other news regarding them. For the fiscal fourth quarter, CrowdStrike is forecasting revenue of $245.5 million to $250.5 million, and an earnings per share of roughly 8 to 9 cents a share. Shauna?
And I'm taking a look at Boeing. It's one of the top performers in the Dow, second to only Walgreens today. But Boeing stock up just over 6%. And here's why. Ryanair announcing the biggest order for Boeing 737 MAX planes since this aircraft was grounded just around 20 months ago. Now, it's a big boost of confidence for Boeing. We know the stock has been under a tremendous amount of pressure over the last couple of years. So Ryanair adding another 75 planes to their order. This brings their total MAX order to 210 planes worth just around $22 billion. We also got some news today. United saying earlier this afternoon that it expects to be the first airline to receive a 737 MAX delivery, and they expect that delivery to take place next week. We heard United say earlier this week that it plans to use 737 MAX planes in 2 of its largest hubs starting next year. And Adam, another stock that we are closely watching into the close is Tesla. And we need to keep an eye on this name over the next 60 minutes because we could possibly be looking at a record close if we get a little bit of a boost here in the final hour. Now, this move to the upside that you're seeing with the stock up just around 4% now, so well off the highs of the day, but it comes on an upgrade from Goldman Sachs, the company boosting its rating to a buy, a new street high price target of $780 a share. That's about a 30% jump from where Tesla closed yesterday. Now, Goldman is getting more bullish on the EV space, thinks that Tesla is going to continue to be a dominant player there. Another positive catalyst that Goldman sees for Tesla is battery adoption, some of that acceleration taking place there. Now, this call from Goldman coming ahead of Tesla joining the S&P later on this month on December 21st. Year to date, the stock has been a massive outperformer with the stock up just over 600%. So certainly a name to keep an eye on over the next 60 minutes. But first, we want to get to the latest down in Washington and talk about those stimulus talks. We heard from Senate Majority Leader Mitch McConnell earlier today saying that a compromise might actually be within reach. Jess Smith is always, as always, keeping a close eye on where the talks stand for us. And Jess, I guess, should we be a little bit more optimistic about where talks stand today?
I'm nervous to say optimistic, but the fact that McConnell and Pelosi held talks today, that they actually had a conversation, is a good thing, I would think, seeing as you really haven't heard about them talking much throughout these negotiations. Speaker Pelosi has largely dealt with Treasury Secretary Steven Mnuchin, but now we know that she and McConnell did have a phone call today. McConnell did say on the Senate floor that he had seen some hopeful signs over the past few days. And again, he did say that compromise is within reach, but then he went on to list some of the differences that still remain. He is pushing for a more targeted relief package that Democrats don't like. There is more growing support for that bipartisan plan that we saw rolled out earlier this week, that $908 billion plan. We know Republicans who are backing that plan did meet with McConnell today to walk him through the proposal that they're putting together. Still not clear if McConnell would change his mind and back that, and it's not clear if the president would actually sign that bill. He did say today that he thought they were getting close to a deal, but he didn't say which proposal he would support there. We know Mnuchin had said that President Trump would sign McConnell's targeted relief bill. So we'll see which one of these proposals that are floating around, if any, leads to some progress. But it sounds like lawmakers are hoping to put some of these proposals in a spending bill to keep the government funded. next week. That funding runs out on December 11th. So they're up against this deadline, and they may be able to include some provisions in that package. But there are still some remaining differences, as we've talked about for months. State and local aid and liability protections, those two issues don't seem to be really going anywhere. So we'll see if it can work out those issues. We know that bipartisan plan, it's not an actual bill yet, but we do expect to see the final bill at some point early next week. So we'll see if that moves the needle at all in these talks.
Jess, do we know if on both sides, because there are two different proposals for all of this, where the airline the payroll support program numbers fall? I've seen as high as 25 billion and as low as 17 billion. Is it all still in there?
You know, things are still very much in flux. And like I mentioned earlier, the $908 billion proposal is still being worked out. We don't have the final legislative text on that yet. I know there was 45 billion initially marked for transportation, some of that going toward airlines. So it's not quite clear what the final number that they're going to put in this bill is quite yet.
All right, Jess Smith, as always, thanks so much for giving us the latest when it comes to the stimulus talks. And I'm sure that we will talk to you once again tomorrow. All right, Jess Smith, thank you. We're going to take a quick break, but when we come back, we'll have more on the markets with this final hour trading. The Dow holding on to gains up just around 154 points. S&P up around 0.2%. The NASDAQ, one of the outperformers along with the Dow, up nearly 0.5%. We'll be back in just 2 minutes.
And welcome back to Yahoo Finance Live as we head towards the closing bell in roughly 50 minutes. Want to check where we stand with stocks. A lot of people also looking at Tesla right now. So much more to talk about. Jared Blickery, what have you got?
Well, we got the S&P 500 up just barely, but enough to make new nominal record highs. NASDAQ in the same situation. Let's take a look at a couple charts here just to see where we stand for the day. You can see it's been pretty choppy in the S&P 500. Take a look over the last 5 days, and you can see just steadily climbing here toward new highs. And that's kind of the way December tends to go, just that climbing that wall of worry. Everybody wonders, will the Santa Claus rally work this year? Usually does, and when it doesn't, it fails spectacularly. Well, let's take a look at some of the other markets here. We got the dollar down fairly strongly. Now, there has been a lot of short positioning in the dollar, and contrary to history, it's actually correct right now. A lot of the retail and speculator crowd tend to get it wrong, but we are at multi-year lows for the US dollar index, meaning the euro is either at or close to multi-year highs versus the US dollar. Also taking a look at crude oil, that's up 1% after an OPEC plus deal was made, but to increase production slightly beginning in January. I think the markets are just happy that a deal was done. Now here's a look at the NASDAQ 100 heat map. We got the big guys under a little bit of pressure. You can see Apple just fluctuating around the unchanged line there. Microsoft and Amazon down about 17 basis points. Alphabet about unchanged, and Facebook down 1.5 points after the initiation of potential antitrust proceedings against it. Now we're taking a look at Tesla, as you mentioned, Adam. It's up 4%. And let's just take a look at the EV space. Goldman Sachs seems to love Tesla with that street high price target on it. But we also see some strength in some of the other guys that have shown weakness recently. Workhouse, which was down pretty considerably yesterday, is up 11%. You can see over the last 2 days, still down about 9.5%. Also seeing some strength in Nikola. That's up about 2.6% over the last 8 days, and it's just reaching those highs right now, up about 8%. Now we got to take a look at the movie theater spectrum, because Warner Brothers has announced that they are going to release all of their movies simultaneously in theaters and on HBO Max. Theater chains not liking that. You can see here Cinemark holding down 18% today, AMC down 17%. And we'll finally take a look at the banking sector. Now, kind of mixed here, but some of the big names we have seen performing well recently, like Wells Fargo and HSBC. Those are each up greater than 1%. All right, now the sector action here, we have energy and real estate leading up 1.9% and 1.09% respectively, guys.
Jared, thank you very much. A lot of what drives markets recently has been progress on COVID-19 vaccines, but there are steps backward as a lot of municipalities look at further lockdowns. One of them, Los Angeles. We want to bring in Melody Hom for the latest on what's happening on the West Coast with the spike in coronavirus and COVID-19. Melody?
Yeah, Adam, it has been a confusing 24 hours to say the least. LA Mayor Eric Garcetti yesterday reiterating the same exact mandate that us here in Los Angeles County had received to be implemented on Monday of this week, essentially a targeted safer at home order. While many folks are confused because it sounds like the language of a lockdown, there are 10 pages of exemptions. So retail stores are still open, outdoor dining is banned, but takeout is still a go, movie, film production still a go, TV sets are still open, as well as public parks, beaches, tennis courts, golf ranges, all of those are still open. So what is the change? Nothing at all. To your point, though, Adam, the situation here is quite dire. Nearly 12% of COVID tests are coming back positive. That's a surge on a surge after the Thanksgiving holiday. Of course, that's up from 7% just a week ago. LA County did report a total of 2,400 people hospitalized for the virus yesterday as this order came about. That's more than any other day during the coronavirus pandemic to date. And folks are, of course, expecting an additional surge as we enter the Christmas holiday season. This, of course, is merely echoing, right, that different households should not be engaging in socialized activities. Unfortunately, with LA weather still very much open and bright, a lot of folks are still gathering and going on group outings and hikes. I don't necessarily think these exemptions will preclude people from doing a lot of these things that they have been doing.
Hey, Mel, what's the feeling on the ground there, just in terms, because we've heard about other regions or other parts of the country, there's been significant backlash when some of these restrictions have been imposed, or when we hear policymakers make these kinds of demands or implement these sort of restrictions. Has there been any backlash in the LA area yet?
Yeah, it's interesting, Shauna, because in just 15 minutes, California's Governor Gavin Newsom will be hosting a press conference to provide an update. Of course, he himself has been on the receiving end of that backlash, right? A lot of it comes from hypocrisy where, okay, you're going to a dinner at the French Laundry, but you're telling folks that they have to stay at home, otherwise they will get fined. We know there are utilities on the line. Public utilities have been snipped off at some of the TikTok houses here, as you may recall, specifically because they were hosting gatherings. So there has been backlash, but to be honest, it's because a lot of those fines have not been implemented, right? Especially if there are 10 pages of exemptions, you can say, hey, I have this essential activity. Hey, I'm going to see my mom. This person actually is my roommate. There's so many ways to get around these restrictions. So I do feel as though all the caveats, all the asterisks actually are helping consumers in one way, but also hurting because unfortunately the behavior is not safe at this point.
Melody, we appreciate the update. Want to let everybody know with roughly 43 minutes till the closing bell, S&P 500 is up right now, and it's up by about 9 points. The Dow is up 180 points. NASDAQ is up about 62 points. The Russell 2000, we've been talking about the rotation from some large cap into the small cap stocks, and the Russell 2000 is up 18 points right now, almost a full percent. We're going to be right back after this.
Just around 40 minutes here from the closing bell, and stocks getting a boost following that better than expected jobless claims number out this morning. As it stands right now, S&P and NASDAQ both on track for a record close. Earlier today on Yahoo Finance Live, we spoke with legendary investor Paul Tudor Jones about this rally that we've seen in the market and the disconnect that we're seeing when it comes between Wall Street and Main Street. Let's listen to what he had to say.
Well, we've obviously got this huge disconnect between Main Street and Wall Street. And there's so many data points along us. I mean, we've since July, I think we have 8 million more people in poverty than we had just in the last 6 months, despite the recovery that we've had. Those that are the most vulnerable have suffered the most. And until we get the vaccine, we'll probably continue along that path. So, listen, the private economy is 20 trillion, and then the government's 4.5 trillion, and then public philanthropy is probably 350, 400 billion. So private philanthropy, so the corporate sector, the private sector's 40 times the size of philanthropy, and it's 4.5 times the size of the U.S. government. So if we're going to have true social change, it has to start in the private sector. That's where you're going, I think, to actually begin to deal with wealth inequality. Of course, at Just Capital, we poll every year and ask the Americans, what's the most important thing to corporate justice? towards making a company good, and the answer comes back year after year after year, number one thing is, do you pay a fair and living wage? Do you pay someone a wage that allows them with a partner to raise a child and not struggle, but thrive, not strive, but thrive? So I think we've labored under this. I think it's a false god and a false belief that we have to pay low wages in order for companies to survive and to prosper. I think actually if you raise the wage level across all workers, it's quite possible that the whole pie gets bigger and that we have the same level of profitability for companies, but we have a much stronger and more productive economy than what we have now. So we started this initiative called the Financial Wellness Audit, which we're encouraging companies to do. And here's a statistic that I don't think everyone really knows, which is of the 20 million workers for the 1,000 largest companies in the United States, 10 million of those do not make an income with their partner working part-time to be able to support a living wage for a family of three. And that just, again, I don't think that's really what the American dream's about. So one thing we're encouraging companies to do is do a financial wellness audit, find out how many of your employees are making below a living wage. And then when it comes time every year to allocate the revenues, how much of corporate revenues should go towards dealing with employees that you have making less than a living wage versus how much should be allocated to shareholders. And that's a really, I think, important moral question that every board should deal with, that every shareholder should deal with, which is, if I'm not paying someone a living wage, and certainly if I'm not paying them a poverty wage, which would be it'd be a subset of that 10 million number, probably 3 million number, probably 3 million to 20, then who is paying for that? Well, who's paying for it, Julia, is you and I, taxpayers. Companies are actually using taxpayer subsidies to be able to generate their own profitability. And again, there's a large question as to whether that's either good economic policy and whether that's really morally correct. So I think the first most important thing is for everyone to know how many of your employees don't make a living wage, and then what's your responsibility to them along those lines. I think it's a great question for every board, every person in senior management. Aren't our workers who are actually allowing us to provide these products and services, aren't they the most important lifeblood?
Mm-hmm. You know, Paul, I'm a millennial, and you were mentioning you're a father of millennial age children as well. And you know our views, broadly speaking, as a generation, I'm sure you've seen the polls on the views of capitalism. And I do want to kind of ask you about the consequences. And the reason I wanted to have this conversation, it goes back to a TED Talk you gave 5 years ago. And if you don't mind, I'm just going to quote you really quickly. You said, quote, "Now here's a macro forecast that's easy to make, and that the gap between the wealthiest and the poorest, it will get closed. History always does it. It typically happens in one of three ways, either through revolution, higher taxes, or wars. None of those are on my bucket list." What is your macro forecast for that today? And are we headed in the right direction?
Well, this election obviously was it looked like we were at one point along the way for a revolution. Who knows what's happening with the election? And certainly the stuff that we saw on the streets this summer was unlike anything that we've seen since the late 60s. And then, of course, if you look at the Biden tax plan, which for all we know, come January 6th, may ultimately get enacted. And the Biden tax plan takes an absolute dead-eye bullseye on the 1%. And does a great job of redistributing that to the rest of Main Street. So I don't know what the economic consequences are. I know what the distributed properties of it are. So we could be along that path of high taxes. We won't know until January. And then as far as wars go, again, these are crazy times where politicians seem to be jumpy, where things seem to be so discombobulated that who knows what the future brings. And again, a war can be a consequence of a variety of things. It's possible a war could be a consequence because there's so much divisiveness at home. Is the easiest way for whoever the politician in charge is to get people to look the other direction. So I still think, again, that gap's going to be closed. It's probably going to be one of those three avenues. Which one, I can't pick. If I had to put my money on one, well, look, we're 50-50 on higher taxes. So that could literally be, well, we'll know more in January.
Can we kind of double click on that just a little bit? I just kind of philosophically, how do you think about the deficit and higher taxes?
Deficit? Who ever talks about that anymore? I mean, it's funny. I haven't heard the word deficit. The only time I hear the word deficits when I talk to all my macro brethren who simply will sit there and say, it's just a matter of time before we pay the piper for the egregious debt levels that we built up nationally as well as internationally. So far, though, it seems like the trees can go to the sky, that there is no limit. Certainly, debt to GDP globally continues to make new highs year after year after year. And now we've given up even trying, I think, to have any semblance of fiscal responsibility in terms of tackling it. So at some point, I guess the markets will find there'll be some weak point, there'll be some grease of the future that creates enough systemic shock to where governments will have to deal with austerity budgets. I don't know when that's going to be. We've been on this path literally for 3 decades, and it continues to do more than I thought was even remotely possible in terms of people's tolerance for fiscal impropriety.
Just over 30 minutes left in the trading day. Dow and S&P right around the highs of the session. Coming up, we're going to talk to Moody's chief economist Mark Zandi. He'll weigh in on the jobless claims report that we got out this morning and where we stand in the economic recovery as COVID cases surge. We're back with that in just 2 minutes.
Just under 30 minutes until the closing bell. The S&P 500 in record territory. It's up right now 12 points. Dow is above 30,000. It's up 212 points. The NASDAQ is up over 65 points. And as we consider all of this, we want to invite into the stream Jose Rasco. He is head of investment strategy of the Americas at HSBC Private Bank. Good to have you here. And one of the questions I think a lot of investors have right now is this market getting ahead of itself? We still don't have approval in the United States of a COVID-19 vaccine, but a lot of people seem to think that stocks are going to go up, up, and away because of all the pent-up demand. What do you think?
No, we're in agreement with that. And I think if you look at where we are, clearly we've seen the market move a lot of gyrations in the market in the last couple of weeks, and a lot of change in leadership from defensives to cyclicals to going back to the COVID economy. And so, but we're firm believers that at some point in the next 2 to 3 months, we're going to see something, not just on the vaccine side, but as well antimicrobials and therapeutics. And I think it's that trifecta that's really going to have an effect. And whether we get a stimulus plan now before the end of the year, or we get it in the first quarter, or both, we think there's going to be an injection of capital into the economy. And as a result, we think that's positive for what we call the reopening of America. So we're pretty positive on it.
So when you think about leadership in the market and how you've changed your investment strategy from what we were doing 6 to 8 months ago, where are you seeing opportunity now?
Well, we were more defensive back then. We were focused also on Asia a little more back then. Now we've broadened that out to include the U.S. as one of our main overweights, and we have become a lot more focused on the COVID economy. And now we're more focused on this reopening, where we're going to focus on more cyclical names. We're becoming more pro-cyclical as we hit 2021. Don't forget, as we hit the first quarter, you'll also see temperatures begin to rise as we head towards spring. So we think that combination is going to be pretty positive. And keep in mind, you still have the Fed in play with low interest rates and their policy, the QE policy of trying to keep the yield curve low and flat and providing liquidity. And we don't think we'll see those tax hikes anytime soon, because the Biden administration, I think, is pretty much aware that we need to get the economy back to functioning at full capacity or close to it before you can begin to raise the specter of higher taxes, either on the corporate or personal side.
Jose, help us understand when you say overweight in the United States. We've had other guests who talk about you're going to get a better yield if you look at, for instance, Europe or even emerging markets. Can you put that in layman's terms for someone like us, like me?
Mm-hmm. Sure. I think, well, there's two ways to look at this, right? We have investors who are income-oriented investors. And so next year is going to be a very good year where cash flows are going to expand. The economy is going to be reopened, not just in the U.S. We're hopeful that we'll see a lot of activity in Europe, or a pickup in activity variables as well in Europe. And therefore, if you're an income investor, you could see a lot of companies raise or reinstitute dividend policies, which means that dividend yield, that total return, will go up. So income investors can look in that area. If you're a growth investor, which a lot of our clients are, then you want to focus on that reopening. And the reopening we've seen in Asia, it's worked very well, where the reopening has been very strong. And we're seeing that in the US, it's happening in fits and starts. And clearly, we have the unemployment rate is still higher than it should be, but we think it's going to continue to drift lower as we head towards spring in particular. Keep in mind, we just did our Navigator survey where we talked to corporate clients, and 74% of companies feel that they will be expanding next year in terms of revenues, and 70% of them think that profits will be at or above where they were pre-COVID. So there is some optimism as well in the corporate landscape, which is good.
Hope is always good. We appreciate your joining us today and want to say thank you very much for sticking with us. Jose Rasco, Head of Investment Strategy for the Americas at HSBC Private Bank. All the best to you and your team. Somebody else whose opinion we value greatly here at Yahoo Finance is Mark Zandi. He's joining us right now, coming into the stream. You know him. He's Moody's Analytics Chief Economist, talking about the economy and the jobs preview. We get the big jobs number tomorrow. Good to have you here, Mark. What's the headline, do you think, going to be tomorrow? Hey, Mark, I think you might be muted. Can you start over and unmute the phone? Is that a control you have? We're doing it, I think, via Skype. *6 is, I think, the key. You got us, Mark?
Hi, can you hear
Mark, you
me?
there? Hey, gotcha. Listen,
Can
I
you
mute
hear me?
myself every day, so you're in good company. Hey, can you give us the headline for tomorrow, Mark?
Yeah, I just told you the meaning of life. I'm sorry about that. You missed it, so I apologize. It's a soft number. The economy is losing momentum. The job market is throttling back. Well, I think we'll get a gain in employment, but it'll be small. You know, a couple 300,000 jobs, which in any other time wouldn't be bad. That would be pretty good. But you know, given that we're still down about 10 million jobs from the pre-pandemic peak, that's pretty disconcerting. And given the way the pandemic is going, and given the fact that we're not going to get any help from Washington, at least not over the next few weeks, I suspect we could see some job losses in December and into January.
Mark, how are you incorporating that into your forecast, just in terms of the recent vaccine news that we've gotten and also balancing that with the rise in COVID cases, the fact that we still don't have a stimulus deal? Have you adjusted your U.S. growth forecast at all?
Yeah, it's a bit schizophrenic. I mean, I expect the economy to struggle more in the near term. I think early 2021 will be, well, between now and let's say February, March, I think it's going to be pretty uncomfortable. I mentioned the loss of jobs. It just feels like the economy is going to struggle here. But, you know, we've got some really good news on the vaccine front. If in fact everything kind of sticks to script there, hopefully by the spring. And on top of that, feels like we're getting better news out of Washington. We should get a package, if not in December, maybe January, February. So by spring, I think we'll be kicking back into gear. So the very near term, very uncomfortable, but hopefully get on the other side of it and things turn out much better as I would expect.
Then there's that song from 100 years ago, Ain't We Got Fun? The rich get rich and the poor get children, because there's nearly $1.4 trillion that have been saved, as you point out, as of October. But the people who've been able to save that money, that's the upper what percent of this economy? And what's going to happen when that money comes in? Is it going to help the people who might be in the bottom 50%?
Yeah, good point. I mean, you know, obviously there's big winners in this pandemic economy and some really very serious, significant losers. You know, the winners have been able to save. They work from anywhere, work from home. They have stocks. They own their own homes. Have enjoyed everything we've been seeing on Wall Street. But then we have a large number of Americans, tens of millions of Americans who are unemployed, underemployed, have suffered pay cuts, have lost their jobs permanently. You know, they face rental eviction if we don't get an extension of that moratorium. A lot of debt payments that are coming due. So it's going to be a significant struggle for them. You know, hopefully, you know, once we do get on the other side of the pandemic, we don't forget that we're still got all these millions of Americans that are struggling and will need help. And I think that does require that lawmakers, Congress, and the next president, you know, provide additional help to try to get those folks back up and running, to get back to full employment as fast as possible.
And Mark, what do you make of the Treasury's decision? We heard Secretary Mnuchin, he came under criticism, faced some criticism, I should say, during a Senate hearing this week for his decision to wind down some of those Fed credit facilities. What did you think of that? And what kind of risk could this potentially pose here to the market and to investors going forward?
Yeah, I totally perplexed. I didn't get it. I just don't understand what he's thinking. You know, the credit facilities were slam dunk successes. They were so successful that the Fed didn't really need to enter into the market and buy many securities. Just the fact that the Fed told investors that they had their back was enough to convince investors that life was going to be okay and they would continue to provide credit, and interest rates remained low, and it was just a slam dunk success. It was kind of sort of the image I have in my mind. It's like a firewall between the chaos in the economy and the financial system. You know, very, very big difference between what happened in the financial crisis when we didn't have those credit facilities, at least not early on, and the problems in the economy undermined the financial system and, of course, exacerbated that recession. Even worse, made the subsequent recovery that much weaker. So just a slam dunk success, not at all costly. There's no downside to keeping them in place. So why? You know, if everything kind of sticks to script and I'm right, and we get the economy comes back after we get those vaccines, then no big deal, no harm, no foul. But you know, if things don't stick to script and things are challenged and we get into back into a risk-off environment, you know, it's going to be a scramble. I mean, I think the next Congress administration will appropriate more money and will resurrect those facilities, but why go through all this? So totally confused by the whole thing. I just don't get it.
Mark Zandi, we appreciate your being here. And just want to remind everybody that Mark is the chief economist at Moody's. Always good to have you here, Moody's Analytics chief economist. We'll see you next time, Mark. All the best to you.
Yeah.
When we come back, strategist Brent Schutte on why the markets have room to run, but leadership will shift. What he's actually telling his clients to rotate into right after the break.
Just around 15 minutes left in the trading day. And as you can see, we are well off the highs of the day. The market coming under a little bit of pressure following some headlines that we're getting. Pfizer cutting its 2020 vaccine rollout target by half. This is according to Dow Jones. We're also getting some headlines that California is going to restrict non-essential travel statewide. So you can see the Dow holding on to gains, S&P though flipping into negative territory, the NASDAQ still up just around 0.25%. For more on this and what exactly this means going forward for the markets, we want to bring in Brent Schutte. He's a chief investment strategist at Northwestern Mutual Wealth Management. And Brent, you can see just a couple of headlines can totally flip the direction that we're seeing in this market. But we do still have stocks at near record highs, yet we're seeing this rising COVID case count, new restrictions being implemented. How are you viewing some of these near-term risks?
So I tend to take a longer term scope than some people who worry about the next 3 or 4 months. And I think as you look into 2021, you are going to see a broadening economy. And so there's been a lot of talk about the winners and the losers during COVID. As we've gone through it, as the economy has reopened, more parts of the economy are participating to where now COVID is really impacting a small subset of the US economy. And so if you think about that commentary, as you move into 2021, there will be broader economic growth. It will be more inclusive. You will see continued fiscal stimulus. I do believe we will get a package. You'll see the Fed continue. You have pent up demand and you have the virus continuing to lessen it on those last 10%. And so as you think about that in 2021, you have a market that will move higher, but with different leadership that reflects more broad economic growth. Think the rotation that we've been talking about every time I come on the show. It's underway right now, and it will continue into 2021. Think value, think small cap, think emerging markets.
Brent, can you put that into context that we can help us all understand? When you say think value, a sector where I might find value in the past, I would have thought real estate. But that seems so risky right now, especially in major cities, because when you get this kind of vaccine volatility news, who wants to take a chance on a REIT?
Yeah, I mean, I think it's price versus take a chance on something. So what's the price that you're at right now? And some of these asset classes have been beat up and reflect some pretty dire consequences. I'd focus more in the near term on small cap stocks. Those are more leveraged to broad economic growth. Those have their earnings grow quite fast when the economy reopens, and they've already begun to do so. And next year, they're expecting 75% earnings growth, which I think will attract people away from the tech stocks, which were the only game in town prior to this from an earnings growth perspective. And so that would be the area I'd focus on. And then you can think of some of the traditional value sectors like financials, industrials, things of that nature, where a broad economy is more conducive to them actually growing and making earnings.
But how about the uptrend that we've been seeing in the 10-year yield, getting closer to 1%, pulling back just a bit today? But are you confident that the equity market can handle higher yields at this point?
As long as it reflects increasing economic growth, which is still happening. I hear a lot, and I heard the prior guest talking about the economy. You are not seeing an economic fall off. Sure, it's going to slow down from 33%, but the Atlanta Fed GDP now is still at 11%. The two ISMs this week were in the mid to high 50s. And I guess one more thing to kind of drive home this broadening economic growth. There are 36 industries represented in each of the ISMs, so the manufacturing and the non-manufacturing. Of those 36 industries, 30 are reporting growth right now. In April, it was 4. At the end of Q2, it was 27. It got to 31 at the end of September, and now it's backed off 1 to now 30. And that's because the services sector, which is where the impact still is, saw a decline from 16 down to 14 out of the 18. And those segments are real estate, educational services, leisure and travel, and things of that nature. And so that, I think, kind of paints a picture of while we wait for a virus, or a vaccine, I should say, the US economy has adapted around the COVID, and companies have learned how to serve their clients during this time period. There still are impacts in some parts of the economy, but they've narrowed.
All right, Brent Schutte, always great to have you on the program. Brent Schutte, Chief Investment Strategist at Northwestern Mutual Wealth Management. We want to take another look at the market here because as you can see, we're well off the highs of the day. S&P now in negative territory. Dow, it was up over 200 points not too long ago. Now just holding on to gains, up around 80 points. We got these headlines from Dow Jones. Pfizer slashing its COVID-19 vaccine rollout target. They're facing some supply chain issues, supply chain obstacles, they're calling it, saying that they will now only be delivering, they only expect to ship half of the COVID-19 vaccines that they originally planned for this year because of those supply chain problems. They do, though, still expect to roll out more than 1 billion doses next year in 2021. We'll be right back.
All right, 9 minutes until the closing bell. Want to let you know that the Yahoo Finance program, Influencers, is moving to 4:30 today. We want to invite into the stream our editor-in-chief, Andy Serwer, who hosts this program, because today's guest is Box CEO Aaron Levy, and he's got quite a bit to say about tech regulation, right?
Yeah, that's right, Adam. Aaron is the CEO and co-founder of Box, which is an enterprise cloud storage company he and his partner founded when they were undergraduates at USC in 2005. He was a wunderkind of California, Silicon Valley, and the Southern California tech scene. And he's very outspoken as well. That's sort of one hallmark of Aaron, is that he's big on Twitter. And so I talked to him a little bit about tech regulation proposed coming out of Washington. And the conversation sort of went along the lines of, well, one size does not fit all, and the Congress does not necessarily get that. Take a listen to what he said.
I think the part of the issue is that if you look at how these congressional hearings have played out, they've combined companies like Amazon, Apple, Google, and Facebook into one conversation. And the reality is that the issues that each of those companies are dealing with from a competitive standpoint or their position of power are completely different, right? For Facebook and Twitter, the issue is around the information that we see, the censorship or lack thereof in some cases, and how do we make sure that we are ensuring that the right kind of information is being spread on those platforms, and we don't get disinformation, and we don't end up having harmful information spreading on those platforms. The way you would regulate that is entirely different from how you would regulate, Apple or Amazon, because of the success that they have as a at-scale marketplace. And so, for instance, probably in something like Facebook or Twitter, we need regulation that maybe looks more like when we had seatbelts become law. Like, what do we do to protect consumers, and how do we have guardrails in these platforms, as opposed to somehow breaking up these companies is going to be the solution to this. So I think on social media, we need one set of regulations to deal with the spread of information. In terms of large marketplaces, I think the question is, are these platforms so powerful that they can stamp out competition in an unfair way that would obviously raise antitrust concerns? And what are the rules then of how those marketplaces need to be regulated and governed? And I think what we need is modern digital approaches to that, as opposed to taking laws that were written for the 1800s or the 1900s and trying to apply them to the 21st century.
They're all tech giants, but they're all different. So says Aaron Levy, CEO of Box. Adam.
Andy, thank you. And remember, you can watch Andy's entire interview with Box CEO Aaron Levy tonight at 4:30 p.m. right here on yahoofinance.com. Closing bell right after this. Just about 3 minutes until the closing bell. Let's bring into the stream Jay Jacob, Senior Vice President, Head of Research and Strategy at Global X ETFs. Also, Kevin Nicholson, Riverfront Investment Group, Global Fixed Income Co-CIO. Let me start with you, Kevin. You say you are risk on, even with this market pulling back slightly on that Pfizer news. Isn't it a bit expensive to be buying in right now? Shouldn't you wait for a bigger dip?
Well, we've been risk on pretty much all year. And I think that going forward, you have a couple things that are tailwinds for the market. It looks like that we're going to get some fiscal stimulus prior to Biden taking office on January 20th. That wasn't expected in the marketplace. And it seems like that, Washington is finally starting to come to an agreement. We know that we're going to get a vaccine. Vaccine distribution is being talked about now, and that's what's been priced into the market. And there's a positive earnings outlook going forward. And so we think you put those three things together, and we think that you're going to get a Santa Claus rally, especially if we get stimulus prior to Jan 1.
Jay, what do you think? Do you think we'll still get a stimulus, or do you think we'll still get a Santa Claus rally, even if we don't see some sort of stimulus before year end?
Well, I think in order to get a strong rally without any stimulus, we have to see just a absolute, crushing holiday spending season. I mean, 70% of the U.S. economy comes from consumption. We've seen some early numbers that suggest very strong Black Friday sales on Cyber Monday. But the problem is we've seen a little bit of a decline in confidence among the consumer as COVID cases have risen heading into the holidays. So in order to stimulate the economy without any sort of official fiscal stimulus, consumers have to take on that responsibility on themselves. I think so far, at least within the e-commerce space, we've seen a lot of strength, but this needs to continue for the next few weeks to continue to power this rally heading into year end.
All right, Jared Blickery, we were looking at potential records until that Pfizer news. What are you watching as we head to the closing bell?
Well, I'm just looking at the tape right now, and I want to go straight to the Wi-Fi Interactive to look at the price action over the last hour, because it's been simply incredible here. We made new highs here at just about 3:15, and then 30 minutes later, we were making new session lows, came back up to about 50% and sold the halfway back to make even newer session lows here. In the grand scheme of things, we're talking about the equivalent of 200 Dow points. You look at a 3-month chart, still well within this upward rising trend here. So I think this is going to be kind of a one-off, maybe a small buying opportunity, but we're going to see more news like this going forward, and we're going to get more hiccups in the vaccine distribution process. But I think the good news is going to outweigh the bad news, especially in this month of December. As long as we're climbing this wall of worry, nothing probably bigger to be feared. S&P goes below 3,600. That kind of changes the game here. Now let's take a look at what the stocks are doing. We got the NASDAQ 100. Facebook had been under a bit of pressure, now down over 2%, but we're still seeing some strength in the names that were leading earlier. Tesla up 4%. Now that's also kind of a safety stock, if you can imagine it, a defensive play. So maybe not surprised to see it up even more on the news, but heading into the closing bell right now. So let's see where the markets settle, guys.
And that does it for the trading day today. Again, you can see us closing right around the lows of the session. The Dow holding on to gains, though, up just around 86 points as we shake out the final trades. S&P ending the day in the red, off just around 2 points. The NASDAQ, though, also holding on to gains. You saw the NASDAQ and the Dow, both the outperformers for most of the trading day. It's a record close here for the NASDAQ that you're looking at, 12,377. Kevin, I want to bring you back into this. And as you see, some of the leadership in today's market has been some of those travel names, the names that had been beaten down. American Airlines, one of the outperformers in the S&P, Carnival, Norwegian Cruise Lines, also gaining today. Are you seeing any opportunity in some of those reopening trades, especially when it comes to travel? Or the headline that we got from Pfizer on a day like today proves that it's a little bit too early to be betting on some of those names?
I think it's a little bit too early to be betting on some of those names. There's definitely been a rotation in the marketplace, and we have started to rotate our portfolios accordingly, having a little less growthy type names in the portfolio and adding a little bit of value. However, we haven't gone to those consumer discretionary names like those travel stocks that you mentioned.
So, Jay, when you take a look at where we're headed with all of this, and you look at opportunities that we could be heading to, you talk about the Internet of Things and 5G. Should I be looking at traditional tech companies, or should I be looking at those who are going to be building out 5G? Because with the new administration, who knows what's going to happen with Huawei?
Yeah, absolutely. Well, what we've seen is a lot of the network service providers and some of those telecom names really weren't the winners of 4G. 4G was a astronomical launch forward from 3G, which was to allow for people to use their mobile internet to upload photos, upload videos, shop online, really engage in social media. But the winners were not, the AT&Ts and Verizons of the world. They were actually the chip manufacturers and the device manufacturers. They were able to take advantage of this 4G infrastructure and launch completely new services that we never had before. So we think similarly with 5G, this is not a play on AT&T and Verizon again. It's probably a play on the chip makers that are making the chips that connect, the new iPhone to 5G. But also, what are the new companies and new themes that are going to be built on top of this 5G technology? Autonomous driving, which is going to require massive amounts of data being sent and transmitted from autonomous vehicles. Augmented and virtual reality, which is going to be, immersive experiences either in shopping or gaming. These are the areas that right now, just don't have the architecture to really be built on 4G, and an entire new world of technology can start to emerge when 5G is built out.
Kevin, I want to ask you just about what we're seeing play out in the bond markets and specifically the 10-year. It's not too far from 1%. We've seen it well off the lows that we saw several months ago. How big of a threat, or do you view it at all as a threat to equities and something that could potentially stop this upward momentum that we've been seeing in the market?
No, I don't. I think that one of the things that you're going to see in the fixed income market is that the 10-year is going to be pretty range bound. I kind of see it as being in about a 20 basis point range. And so therefore, once you get above 1%, it's only going to go up slightly. You're going to have the Fed more than likely step out on the curve with its buying program. And I think that that's also going to put a cap on how high rates can go. And also, when you look across the world at the negative yielding debt, there's about $16.6 trillion worth of negative yielding debt worldwide. Most of that is coming from Europe. And so therefore, it's going to incentivize foreigners to buy treasuries because there's a big yield advantage still here in the U.S. And so I don't think that you're going to get interest rates rising enough to dampen the equity trade right now, because equities out yield the 10-year by quite a bit at this point.
When I hear that kind of stuff, Kevin, I wanted to ask you, this huge amount of money sitting on the side that isn't earning any interest, even when we get above 1% on the 10-year, it's still not going to be earning a whole lot of interest. So are we going to see this rotation out of money markets and fixed income? And it's going to have to go to, I can't imagine anything else other than equities, right?
Right. I mean, when you look around, you're starting to get, well, you have had asset inflation for quite a while, and that asset inflation has come in the form of buying of bonds and equities. But when you look at it, and if you look at it on a relative basis, equities are so much cheaper than fixed income right now. A lot of times we like to say that the multiples on equities have gotten outrageous, trading 23, 24 times earnings. However, when you look at it on a relative basis to other assets that can be bought, that it's actually not expensive at all. And so this is why we believe that the equity markets are going to continue to rally. And that's why we have been bullish for so long.
All right. We are going to keep an eye on these markets, but we want to say thank you right now to Jay Jacobs, the Senior Vice President, Head of Research and Strategy at Global X ETFs, as well as thank you to Kevin Nicholson, Riverfront Investment Group Global Fixed Income Co-CIO. We look forward to when both of you join us again. Jared, as always, you keep us in the know. We will see you a little bit later on. But we have to go to Alexis Keenan right now because there is big news regarding Boeing. Where do you want to begin? We had that flight yesterday with American Airlines, but today we're talking about delivering the 737 MAX, right?
Yep, promo fight yesterday with journalists on board. But today we learned through a press conference held jointly by Boeing and Ryanair that Ryanair has agreed to put on 75 more 737 MAX 8s to its fleet. That brings the company's total MAX commitment to 210 aircraft. And this is Boeing's first new MAX order since the FAA approved that plane to return to service. Now, Ryanair's CEO, Michael O'Leary, he said that the company also plans to accelerate the delivery of these aircraft and get them into service as soon as this summer. Also, you have to just look at how much of a gamble that this purchase agreement might be for Ryanair, because it remains to be seen whether passengers will have the trust to get back on those planes after 2 crashes killed 346 people and led to that worldwide grounding that is most abbreviated in the US at 20 months. Now, to give you an idea of just how reliant on the MAX Ryanair is committing itself to here, over the next 5 years, you can see there the fleet will grow from 400 to 600 aircraft, with the MAX representing 36% of its total fleet by 2026. Now, O'Leary said that he's not concerned that passengers will avoid the plane. He emphasized that this indeed will be the most audited aircraft in history. As for Boeing's part, its CEO, David Calhoun, said that Boeing can probably now look at shortening its estimated time frame for the MAX program to recover, really. And he said that's due to the progress with the COVID-19 vaccines. The company had previously said that it would take about 3 to 5 years to get that program fully back online. Adam?
Alexis, thank you. We're going to take a bit of a break, but want to let you know it's the time of year when Yukon Cornelius on Rudolph the Red-Nosed Reindeer sings silver and gold. Well, it's silver and gold and jewelry and diamonds. Signet Jewelers, a big winner today. Shares soared on surprise profit and revenue growth in the third quarter. It's been part of a strategy they've had for quite a while. CEO Jenna Dressos on why jewelry buying is making a comeback right after this.
Signet Jewelers posting a big beat on earnings. The numbers this morning showing a very strong start to the critical holiday season. Comp sales, one of those metrics that outperformed, jumping just over 15% during the quarter. For more on this, we want to bring in Jenna Dressos, as she's the CEO of Signet Jewelers. We're also joined by Yahoo Finance's Julia LaRoche. Julia, take it away.
Thanks so much, Shauna. And Jenna, thank you so much for joining us again to discuss the latest results. As Shauna was referencing, comp store sales growing more than 15% in the third quarter. And of course, I always enjoy our conversations because you get a nice read as to what's going on. And of course, during COVID, during quarantine, I imagine there are a lot of consumer trends you're seeing, more engagements. Tell us what you're seeing in the jewelry business today.
Well, sure. Hi, Julia. It's great to be on again. We were very pleased with our third quarter results with comp sales, as you said, up over 15%. Our e-commerce sales were a strong story, up over 70%, and we also saw positive sales in brick and mortar. We actually saw that across all parts of our business. So bridal was very strong. We had anticipated this. Our customer research indicated that of couples who were within 18 months of getting engaged, more than half of them were deciding to quarantine together. And we also knew that 93% said that their relationships were equally as strong or getting stronger. So we anticipated more engagements and got out in front of that with great new bridal lines, beautiful product, more customization options, and targeted marketing to couples who are in the stage of their relationship. We've also seen those strong sales in fashion jewelry. And I think that's a function of two things. One is, people are expressing their style with earrings and pendants now, not with shoes when we're all on a Zoom call like this. So we're really seeing a surge in those two elements within our business. And finally, we knew that customers would be shopping longer this holiday season. More than 60% of jewelry customers said that they would be in the market starting as early as August or September. So we've really changed the way we think about holiday. It's not just a fourth quarter phenomenon. We've been thinking about the third and fourth quarter together as the holiday season.
And Jenna, as long as you and I have known each other, we've talked about the transformation that you have going on, your path to brilliance, and technology has been a huge component of that. As you're just referencing the e-commerce numbers looking strong, using some of those virtual consultants. We're talking about a huge trend going on across retail in general as it relates to technology. And, historically, folks have avoided buying big ticket items like jewelry online. Would like to understand a bit more how you're using technology to kind of change the game there. And a two-part question here, how you're using technology to kind of gain more share when some of your competitors have really experienced some weakness, including kind of losing talent, closing, and then you have more, space to bring in more customers. How are you using technology to do that?
Well, Julia, you're right. I mean, this is not a reaction to crisis. This is a strategic and intentional effort to build a significantly better digital business at Signet. We've been on the path to brilliance transformation for now in our third year, and we've been making investments in platform technology. What's unique this year and what's really allowed us to accelerate is bringing technology to our field team and creating virtual selling as an important part of our offering. We've added a lot of new tools also for visualization. When customers buy jewelry online, the two things they're looking for is advice and a trusted relationship and being able to visualize the product. And that's where Signet has really excelled. Now, it's the combination of that and our optimized store footprint that I think is the real long-term competitive advantage for us. For example, we know that most of our e-commerce sales come within 30 miles of a store. So jewelry, it has been very slow to become more digital, but I think it's really an omni-channel story, and that's where Signet can win. As to
Jenna, talking about that omni-channel. Just talking about the omni-channel story, I mean, it's interesting because we've seen a number of retailers, not so much in jewelry, but a number of retailers slimming down their brick and mortar presence. And I know you tend to be doing that. You're moving out of malls, but you still, as you point out, in order to drive some of those sales, especially in e-commerce, a lot of that coming in within whether or not you're within a certain distance from an actual brick and mortar store. What do you see that landscape looking like when you look 5 to 10 years down the road in terms of your strategy?
Well, I think we're creating the tools now that are allowing customers to feel much more comfortable making a big ticket purchase online, but there's no replacement for that relationship that they have with one. We've empowered more than 3/4 of our field team to be virtual sellers. We now have over 700 virtual sellers who are dedicated just to that, but we have over 20,000 of our jewelry consultants and store managers across the country who are selling virtually. And that's great. They can have a clientele of customers that they meet with physically and an entirely separate clientele of customers that they serve primarily virtually. So that's a breakthrough, I think.
Quick question for you. Do you keep data on what percentage of deals are bought, for instance, without the customer actually trying on the piece of jewelry or physically seeing it? And is that something you can share with us?
Well, we believe that some of the virtual tools that we're providing to customers actually do give them a sense of trying on the product. For example, you can now take a photo of your hand and upload it to our website and try on rings that way. And we also show the size of earrings on a person so you can get a sense for that. But it's hard to know precisely how many people are in a store and then buying online, or who searched online and bought in a store. What I can tell you is that of all categories, apparel, electronics, et cetera, jewelry is one of the categories where people have the most integrated journey. I did want to come back and answer Julia's question that I missed before. We're also using data and analytics to target customers in trade areas where other stores are closing. So unserved jewelry customers, we can now go after in a geo-targeted way, and we're also hiring talent when their jobs are cut. So it's really a wonderful competitive advantage for us, the way we're able now to use data and analytics in the jewelry category.
All right, Jenna Drosa, CEO of Signet Jewelers, and Julia LaRoche, thanks so much for joining us this afternoon. We'll be right back.
Thank you.
Brendan Coughlin is the head of consumer banking at Citizens, and we're inviting him into the stream because a lot of us want to know, what is the status of consumers right now? We keep hearing about great savings rates and people paying down debt, but somebody like Brendan can tell us in real world experience what's happening out there. So what are you seeing?
Yeah, well, thanks for having me. The consumer's actually been, surprisingly very resilient so far through the pandemic. While there's certainly some pockets of stress out there, without question, we're seeing a lot of underlying metrics that would suggest the majority of the U.S. is landed on their feet or is still on their feet. So a few examples of that. Debit card spending measured by dollars is actually up 12 to 15% year on year, and transaction purchases are up 2 to 3%. So at the trough in April and May, we saw that down almost 35%. So there's been a massive rebound from May all the way through today, and it's really been holding in quite well. So we're pretty confident that of where the consumer sits today. When you look at some credit metrics in the bank, we had about 8% of our consumers that went into what's called forbearance, which means you're going to skip a payment or two for a period of time. That has now migrated down from 8% to about 1.5% over the course of the last 90 days. At the same time, our delinquency rates, which means you haven't been able to make your obligation of payment, has been actually down. So it's sort of counterintuitive. These customers raise their hands saying they might have stress as they come back in to make payments. The vast majority of them have landed on their feet. And so we're quite confident in the state of the consumer's health right now.
Brendan, speaking of just the consumers and some of these trends that we've seen accelerate because of the pandemic, how has it changed the way that customers really just interact with their banks on a day-to-day basis? We know more and more banks have been investing in technology, kind of migrating towards that. But to what extent has the pandemic accelerated that?
Yeah, it's accelerated a dramatic amount, and we're have a pretty much of a seminal moment here in the banking industry. These trends have been around for a bunch of years, where consumers have been engaging more and more digitally for quite some time. Branch transaction has been coming down at about a clip of 7% a year, and we see this as a major step change acceleration of these trends. So our digital metrics have been up 25 to 30%. Year over year. Our branch transactions at one point were down 50% year over the year. Those have rebounded, now down about 25% year over year, but we think that's going to stick for a period of time. So you're seeing a massive transition to digital banking, where transactional banking is now happening on your phone, and you're really going into brick and mortar for advisory-based conversations or those big life moments that matter for you. So it's really changing the way banks think about their distribution around their people, around their capabilities. And we've got a very significant investment plan to really reposition the bank for a tech-forward organization.
Very quickly, Brendan, I'm curious because a lot of us use digital banking, but the mega banks, the large banks, seem to be favored by the regulators. Are the smaller banks putting up a good fight to maybe change some of that?
Yeah, look, I'm not sure I would necessarily agree that the regulators have the large banks in favor. Many of the regulators were, through the financial crisis, really rooting for the small guys, the really micro small guys. But I think the super regional banks like Citizens are in a really unique position where we're big enough to matter. We've got the scale to build these great technical capabilities and these great digital capabilities, but we're local enough that we really care about our customers, and we can really provide that unique advice where we really get to know them, that customers aren't just a number. So we feel really, really good about how we're positioned. We're more agile, we're more nimble, we can make decisions faster. We're moving very, very fast. We don't have a big, huge bureaucratic organization to get on board when we want to make a big investment in technology. And so we feel quite confident about our position at the moment.
And a lot of people seem to be more comfortable with those super regional banks in some cases. We appreciate your being here and want to let everybody know that Brendan Coughlin is the head of consumer banking at Citizens. Look forward to your next visit with us. Let's turn our attention to what's happening in the movie world, because there was news today about HBO Max and Warner Brothers. Let's bring in Allie Canal to explain to us where you're going to see your next flick. Allie?
Yes, a bombshell announcement from Warner Brothers that sent the major theater chains cratering. If we look at how some of the major theater stocks ended today's session, we'll see IMAX off over 8%, AMC finished the day down nearly 16%, Cinemark down over 22%. And the reason was this announcement from Warner Brothers. So basically what's going to be happening is Warner Brothers came out today and said that all of their 2021 films, that includes big titles like Dune, In the Heights, Matrix 4, they will be available on HBO Max the exact same day that they are in the theater. And these are very buzzy titles that people really thought would help theater chains get out of the misery of 2020 and hopefully enjoy some sort of profitability in 2021, especially with the potential vaccine. But if it's all available on HBO Max for that first month, it's only going to be on HBO Max exclusively for 1 month, and then we'll continue at the theaters. But there is this question of, well, if I'm a consumer, I might just pay $15 for that HBO Max subscription rather than paying 15 plus every time I want to see a movie. So it's certainly a devastating blow for theaters. Although it's a bit of a surprise, I think it's something that maybe we shouldn't have been so surprised about. The writing has been on the wall when it comes to how production studios have been handling this pandemic. We saw Disney decide to go direct to Disney Plus with Mulan as a $30 PVOD offering. Earlier on in the pandemic, Trolls World Tour completely bypassed the theatrical experience and went directly on demand as a PVOD offering. That, of course, leading to that historic deal between AMC and Universal. So it's something that, we're watching closely, and hopefully it's not the end of theaters.
Allie, we only have about 30 seconds here, but is this exactly what HBO Max needed? You hear about Disney Plus all the time. You hear about Netflix. You don't hear about HBO Max as much.
I think it's certainly what they needed, and that was exactly the goal. They want to drive consumers to go and purchase an HBO Max subscription. If HBO Max wants to compete with the likes of Disney Plus and Netflix, they have to have the content, and this is certainly going to set them up well.
Ali Canal, we appreciate it. When you mentioned Dune, by the way, the answer is for he is the Kwisatz Haderach. All geek losers out there like me and tech sci-fi people will love that reference. It's the old movie, the 84 movie. All the best to you, Ali. Thank you very much. Want to let you know we've got the jobs report tomorrow coming up. You can tune into Yahoo Finance live starting at 8:25 in the morning. Jobs report's going to be a very important one. We're going to get the November number. Now, of course, it's looking backwards, but still, it sets up a lot of where we're headed. Influencers is up next.
Tech has never been more important to our lives, but its future has perhaps never been more uncertain. Top companies face withering criticism at home and rising competition from abroad while they wait for President-elect Biden to make his first moves. Aaron Levy operates right in the middle of all of it. He's the CEO of Box, a nearly $3 billion data storage company that's much bigger than a startup, but much smaller than one of the giants. More than 100,000 companies use Box's software, including the likes of Morgan Stanley and Coca-Cola. In recent years, Levy has become one of the most outspoken CEOs in Silicon Valley, driving discussion on issues from immigration to big tech. On this episode of Influencers, Aaron Levy joins me to talk about the secret to Airbnb's success as it nears its IPO, how Washington might regulate Facebook and Twitter, and what business leaders really think of Donald Trump. Hello, everyone. Welcome to Influencers. I'm Andy Sherwer, and welcome to our guest, Aaron Levy, co-founder and CEO of Box. Aaron, great to see you.
Hey, good to see you, Andy.
So first of all, for those people who aren't familiar, why don't you tell us a little bit about Box, what you do, and how you make money?
Yeah, so we started Box 15 years ago, really with a very simple premise, which was we wanted to make it easy and secure for people and businesses to access all of their data, all of their information from any device, anytime, anywhere. And so we built this secure platform to help enterprise manage their most important digital assets and content. And we've been now doing this for about 15 years. We have over 100,000 customers globally. We're in about 70% of the Fortune 500, and enterprises pay us a monthly subscription fee or annual subscription fee to be able to use our software and store and secure all of their data.
So subscription business, people love that.
Yes.
How's it been during COVID-19? Are you one of those stay-at-home trades, or how's that working out?
Yeah, so I think it's been an interesting journey. We started our company on the premise that people wanted to be able to work from anywhere and be able to access information from anywhere. We obviously never would have imagined that a pandemic would actually drive the acceleration and ubiquitous sort of adoption of this type of technology. But that's sort of the environment that we've been in, where companies globally have been adopting video conferencing solutions, new communication platforms like Slack and others, as well as more modern ways to manage their digital content and digital information. So there's been a lot of growth in the business, especially in the enterprise segment. At the same time, of course, there's been challenges because you have small businesses that are dealing with a lot of difficulty in their businesses. You have some sectors of the economy that are harder hit and are dealing with the COVID crisis in unfortunately worse ways. So it's been a little bit of a mixed bag, but we have been able to grow pretty quickly with our enterprise customer base.
Oh, interesting. So I want to ask you about cyber security this year and how that threat has influenced the business, and how are you trying to mitigate that? How much is that something that you have to worry about every single day?
Yeah, so cyber is sort of core to what we do. We hold and we manage and we store some of the most sensitive data in the world, from everything from pharmaceutical companies that are working on a new drug and doing clinical research, all the way to banks that are collaborating with their most important clients, to media organizations that are working on film scripts and a new launch to a new film. So our platform has to be able to secure that information, and our companies, the companies that use Box, look to Box to be able to help them really stay secure in the digital age. So security is incredibly important to our strategy.
You guys went public in 2015, I believe, Aaron, and it's been a successful company, a trajectory, although profitability has been a little bit elusive. Talk to us about what you're doing to achieve that.
Yeah, well, fortunately, it's become less elusive over time. So, we did guide this year to double-digit percentage points in operating margin. That was a pretty significant change in our financial profile. We've guided to around $100 million in free cash flow this year. So we're definitely generating free cash flow in the business. We're growing pretty rapidly at our scale. We obviously want to grow even faster. We know that the market is quite significant and there's a lot of opportunity out there, but we want to make sure that we're both balancing growth and profitability as we continue to scale the company.
Let's talk a little bit about some IPOs right now, specifically Airbnb. I think you called their decision to go public recently the perfect market hedge. What did you mean by that?
Well, I think it's interesting because you have I think the market has sort of had this binary approach that there are companies that are either going to do well in COVID or be really impacted by COVID. So the kind of classic examples are if you're a movie theater, that's a really difficult business to be in. If you're a traditional hotel operator, that's a really difficult business to be in. If you're an airline, that's a really tough business to be in. Conversely, if you're a completely digital company, or a company that is sort of digital but whose trends are accelerated in this environment, like Peloton, then you're going to do extremely well during COVID. And so you've seen the stock market actually have these trades where at the moment there's a vaccine announcement, the companies that have been really impacted by COVID negatively, their stocks go up, and actually the stay-at-home, work from home stocks tend to go down. The really interesting thing about Airbnb is that it actually works in both of those environments. Airbnb has found a way to both be compelling for people that want to be able to work remotely, because so many people want to work remotely from new and unusual locations. Maybe they want to be able to, go somewhere different for a couple of months. And so Airbnb has been seeing a ton of growth with a very different kind of use case. At the same time, if the vaccine comes out quickly and everybody feels comfortable traveling again, then the company will do very well, because they're going to stand to gain a lot of that growth as the hospitality industry is able to reemerge. And so it's one of these stocks where almost no matter what the environment is, they're going to have a lot of great use cases for customers, whether it's because of travel and leisure, or if it's from working from home in a new Airbnb location.
We're going to take a quick commercial break. We'll be right back with more from Box CEO Aaron Levie. Welcome back. I'm here with Box CEO Aaron Levie. Big tech has gotten a lot bigger during COVID. Is that something that's good or bad?
I guess depends on if you're in big tech or a very happy customer of big tech. But I think in general, it was almost an inevitability that the leading technology platforms of our time were only going to get bigger and bigger. Our lives are only becoming more dependent on digital technologies, whether those are social networks, whether those are the mobile devices we use, or the marketplaces that we purchase from, like e-commerce platforms, or cloud infrastructure from Amazon or Microsoft or Google. All of these underlying platforms were only going to get bigger over time. And what COVID did was sort of accelerated that adoption that maybe would have played out over a 5 or 10 year period into a matter of quarters or a 1 year time frame. But I don't think that acceleration is either good or bad. I think that it's going to cause us to ask questions about, how should we regulate these platforms in the digital age? We already knew that these were the most powerful platforms in our lives and in the economy. Now the question is, what type of regulation is going to be required to keep these companies in check, to make sure that we protect consumers, to make sure that there's fair and open competition within these ecosystems. And these are going to be really important questions, obviously, for the Biden administration, for Congress in the coming years. And it'll be really interesting to see, like, where do we actually end up from a regulation standpoint. I think for the most part, we've sort of treated this as a kind of a one size fits all type of issue where, the conversation is, we break up big tech. I tend to think that that's probably not the right solution for a lot of the issues that we deal with. I think we actually just need modern regulation and modern forms of regulating the digital economy, whether that's in the form of again, marketplaces or social media. But I don't think the issue is necessarily just the size of these companies in terms of their market caps or their revenue. I think it's really the powerful position that they play in our daily lives today. And we need modern forms of regulation to ensure that these platforms are being used appropriately and being run, for the good of consumers.
Aaron, can I ask you to drill down into that a little bit? Do you have any specific ideas as to how that can be accomplished?
I think the part of the issue is that if you look at how these congressional hearings have played out, they've combined companies like Amazon, Apple, Google, and Facebook into one conversation. And the reality is that the issues that each of those companies are dealing with from a competitive standpoint or their position of power are completely different, right? For Facebook and Twitter, the issue is around the information that we see, the censorship or lack thereof in some cases, and how do we make sure that we are ensuring that the right kind of information is being spread on those platforms, and we don't get disinformation, and we don't end up having harmful information spreading on those platforms. The way you would regulate that is entirely different from how you would regulate Apple or Amazon because of the success that they have as a at-scale marketplace. And so, for instance, probably in something like Facebook or Twitter, we need regulation that maybe looks more like when we had seatbelts become law. Like, what do we do to protect consumers, and how do we have guardrails in these platforms, as opposed to somehow breaking up these companies is going to be the solution to this. So I think on social media, we need one set of regulations that deal with the spread of information. In terms of large marketplaces, I think the question is, are these platforms so powerful that they can stamp out competition in an unfair way that would obviously raise antitrust concerns? And what are the rules then of how those marketplaces need to be regulated and governed? And I think what we need is modern digital approaches to that, as opposed to taking laws that were written for the 1800s or the 1900s and trying to apply them to the 21st century.
One defense the CEOs of these companies make, Aaron, is that, boy, if you fetter us in any way, hinder us in any way, we won't be able to compete against China. And so it's in the national interest to leave us the heck alone. Do you buy that?
Well, I'm of two minds on this issue. I actually think that I think it's a great example of American ingenuity and of capitalism that you actually have trillion-dollar companies that have been able to build amazing products that we all love and that we consume every day. It's the reason that we can do this Skype call right now. It's the MacBook that it's the Mac that I'm using. It's the cloud technology from Microsoft that we're using. It's the internet and fiber that was built out because of people wanting to invest in that infrastructure. So I actually think that the size of these companies isn't really the problem. The only question is, in the digital age, what types of modern forms of regulation do we need? It's the same reason why we've had regulation over many years. There's the media is regulated, cars are regulated. The networks that we are transport on in the air or on the ground are regulated. So there's a question of should digital platforms continue to be completely unfettered in how they work and how they operate and how they can compete, or should there be some guardrails that are meant to protect consumers as well as ensure fair competition? And I do think that it's a real risk if we don't create an environment where you can build massive companies. Then I do think that China and India will be more significant threats for us. But again, I think this is something that requires a surgical approach as opposed to broad-based solutions like let's break up these companies. I don't think that will actually accomplish much, and I think that's more of a distraction than the underlying issue.
Do you have any idea of how the Biden administration is considering moving forward on this front, both with regard specifically to the tech companies and with regard to that relationship to China?
Well, I think from the limited interactions that I've had with with parts of the team over there, the thing I'm very optimistic about is the thoughtfulness of the approaches that the Biden administration will take. I think we've been in an environment for 4 years where we've only had these very heavy-handed and again kind of blunt force types of solutions to global trade, to internet censorship, to things like immigration. And when I look at the Biden administration, already the team that has been assembled, as well as just I think the general thoughtfulness that Biden has, as well as Vice President Harris has on these issues, I think we're going to see a very, very different kind of approach, one that is much more nuanced to these topics, one that takes in more feedback and collaboration from the tech industry, as well as other industries that are impacted. And I think we'll end up, having again much better either legislation or policies that are enacted. If you just take, for example, the immigration issue that we've been facing, the Trump administration has really dealt with immigration in a very, very archaic type of fashion that doesn't really take into account the fact that America needs talent coming in from all around the world to come build amazing companies and to work at our amazing companies. And Trump has set us back many, many years in terms of being able to bring talent into this country. And that's just an example of these small decisions seemingly on the administration side that end up have a massive ripple effect over time, where the next Apple, the next Google, the next Facebook doesn't get created here. It gets created in China or India or another country. And that is going to set our economy back many, many years if we're not able to accelerate some of these solutions. So again, I have a lot of faith that the Biden and Harris administration will be much more effective at dealing with these issues.
We'll be right back with more from Box CEO Aaron Levie right after this. Welcome back to Influencers. You haven't been afraid to be critical of President Trump. And I'm wondering, A, do you think he's really ever going to concede? And B, do you think the business world should be prepared for him to run again in 2024?
Well, I think we're going to all have to probably have a new definition of what conceding looks like at this point, and I think we probably shouldn't anticipate that there's ever a moment where he accepts that he lost the election. I'm guessing that he's going to claim that the whole process was fraudulent until the very end. So I don't hold out much hope, nor do I really care whether he officially concedes at this point. I think businesses. What's been interesting about this environment is I think the market generally recognizing that policy and business go hand in hand. Immigration policy is what created the ability for Silicon Valley to exist and for Silicon Valley to be at the forefront of technology globally. So you can't have an innovation economy without thinking through immigration, without thinking through internet and privacy and encryption policy, without thinking through global trade. And so, a lot of people say, well, why do companies have to be so political? Well, no company wants to be political, but policy impacts our ability to build successful companies, our ability to hire and retain, talent in our country. That is where policy ends up intersecting with the economy. And so I think what businesses want, and even over the past 4 years, even when in public, maybe a lot of business leaders wouldn't have been as comfortable to say these things, in private, business leaders, I think, were incredibly frustrated with just the level of volatility that was happening and the level of chaos that was occurring within the Trump administration. This is not, you want to be able to trust that your government is thinking over many, many years or many, many decades in terms of the policies that they're enacting. Not that you're going to wake up one morning and all of a sudden you're going to have a new trade war with a country that now is going to impact your own ability to execute your business. And so what I think business leaders want is that stability, that consistency, that thoughtfulness of policy and approach. And that's and whether that's Democrat or Republican, I think matters a lot less than just the ability to have a much more stable political and governance environment.
Yeah, but you're out there. I mean, you're outspoken. I'm just looking at another laptop here. We got 2.4 million followers on Twitter. And you're not shy about making your opinions known. And so I'm wondering what you think about those CEOs who privately convey their feelings to you, their displeasure with what happened. Are those people cowards?
No, I don't think so. I think it's probably more of just a personality trait that I have, where I feel comfortable, saying random stuff on the internet. But I don't fault anybody for not making public statements when they don't feel comfortable. I think it's I think that I'm very happy to see so many companies and CEOs and other business leaders that will stand up for important issues, whether it was the immigration ban, whether it was for Black Lives Matter. I think that was great to see. But again, I don't think it's an expectation that we have to have for all CEOs that they have to stand up for these issues, or there's cowardice.
Did you take any heat from any customers or potential customers, Aaron? I love to be a Box customer, or I was, but then I saw what you were saying, and so I'm not going to do that anymore. I'm not going to do business with you anymore.
Maybe there's a couple examples here and there, but for the most part, I saw the opposite. We would see a lot of customers either publicly or privately reach out saying, thank you for taking a stand on this issue. This is super important to us, and we appreciate that there are voices in Silicon Valley and the tech community that are driving this. What's interesting is we think about Silicon Valley as sort of this isolated region that has its own set of political views, and we're in a bubble, and frankly we are in a bubble. There's no question that we have our own kind of universe out here. However, the issues that are impacting technology companies, let's say immigration issues, social issues that we have within our communities, these are issues that every organization, every company is going to be facing. When I talk to an industrial company or a large bank or an automotive company, they care about immigration as much as a tech company does, because what they recognize is that in the 21st century, their businesses are going to be defined by their technology strategies. So if Silicon Valley is having a hard time, bringing in amazing technical talent from all around the world, you can be sure that Detroit and New York and Chicago and other epicenters of other major industries, they're going to be facing the exact same issues because they need amazing engineering talent. They need to make sure that we've got modern privacy regulation and global trade figured out from an internet standpoint. And so the issues that we think of as our tech industry issues, these are issues that are going to affect every single industry. And so what I hear from a lot is that, CEOs and other business leaders will say, we're glad that the tech industry is stepping up for these types of topics, again, immigration reform and otherwise, because these are the exact issues that go and impact their own businesses outside of Silicon Valley.
Okay, Aaron Levy, co-founder and CEO of Box. Thank you so much for your time.
Thanks, Andy.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.